Good morning, everybody. A very warm welcome to the 53rd Annual Conference of the Österreichische Nationalbank. Together with SUERF, it's a great pleasure to welcome you all here. It's a great pleasure to have this conference. It's my first time to open this conference as the governor of the Austrian Central Bank, the Österreichische Nationalbank. Let me start by welcoming a few guests. And first of all, it's a great privilege and honor to have the Managing Director of the IMF, Kristalina Georgieva, with us. Thanks for coming, Kristalina. I also, of course, welcome the President of our Supervisory Board and in German Generalrat, Johannes Hahn, former Commissioner of the European Commission. And it's a great pleasure to have one of my predecessors here, the former governor of the Austrian Central Bank, Ewald Nowotny. Thanks for being here. And there are so many guests of honor, so if you agree, I would welcome, of course, the senior members of the staff of the IMF, the Directorate of the Austrian Central Bank, the Vice Governor, former members of the Directorate, governors, Vice Governors, all the members of the staff, of course, clearly all the speakers, panelists that are here, that are joining us here, but also, of course, everybody joining us online, the members of the academic and colleagues from other central banks. It's a great pleasure to have you here and to start a conference that is concerned with heterogeneity. Let me just start with a few thoughts on heterogeneity and monetary policy. Across liberal democracies, diversity, heterogeneity is usually celebrated as a source of strength. The European Union has even made it part of its political identity. United in diversity, in varietate concordia. In European public life, heterogeneity is therefore valued and protected very well. In all of European public life, you ask, not quite. One small monetary policy village, not in Gallia, but on the river Main, has long held out against the general enthusiasm. Over the last 2 decades, the inhabitants of this village, policymakers of the European system of central banks and their watchers, have acquired a killjoy reputation for viewing heterogeneity with some concern. In their defense, the villagers are suspicious of specific forms of heterogeneity, namely those believed to thwart the adequacy, the functioning, and the transmission of monetary policy in the euro area. The aim of the speech is to take a closer look on the village, inside the village, to clarify where precisely the gloomy view of certain heterogeneities come from, and which respects it is justified, and why some of the villagers may be taking their resistance a little too far. Let us begin by putting the conventional narrative to the test. Is this villagers' killjoy reputation merely an unfounded myth? Evidence based on the ECB's own speech record suggests otherwise. Between 1999 and 2026, more than 330 speeches by members of the ECB's executive board contained the words heterogeneity, heterogeneities, or heterogeneous. Comparing these 330 statements with the remaining corpus of about 2,400 speeches by the executive board since 1999 reveals a pattern. Speeches referring to heterogeneity are systematically associated with more negative interest rate surprises than other speeches. Stock prices also tend to decline more in response to speeches about heterogeneity. These market reactions are consistent with what monetary economists would call a negative central bank information surprise. Put more simply, when one part of the village, the euro area policymakers, speaks about heterogeneity, the other part of the village, financial markets, predominantly hear concern. Now, why is this the case? We can comfortably rule out the first candidate explanation. Excessive heterogeneity of the ECB's main decision-making body, the Governing Council, is unlikely to be the culprit. This point is quickly made. Decision-making by committees has become the modern standard in monetary policy making. Heterogeneity across committee members is a key prerequisite for committee decision-making to trump one-person shows in monetary policy. Intuitively, under the condition that all members pursue the same overall goal, for example, a common, clearly defined inflation target, the classic benefit of diversification applies. If one resorts to common theorems of committee decision-making for tasks that have an ex post evaluation criterion on their quality, the larger and the more diverse the committee is, the better are the decisions, as long as the cost of decision-making is not growing more quickly than the benefits of size. So we have to look at other aspects. Since it is not about the committee's composition, according to economic theory, it may be heterogeneity in structural macroeconomic conditions that unsettles market most. An issue of concern also to the International Monetary Fund, and we'll talk about that later on. For currency unions, we usually focus on unsynchronized national business cycles. After all, this form of heterogeneity can imply trade-offs for the ECB monetary policy. It causes decisions taken to meet an aggregate composite target to be temporarily inadequate for some of the member countries. Are the trade-offs implied by structural heterogeneity a convincing explanation for the apprehensions that the term is associated with in the context of euro area monetary policy making? I do not think so, for at least two reasons. First, this is a bit yesterday's news. Monetary policy always faces trade-offs. Trade-offs are the very bread and butter of monetary policy making. Even a hypothetical, fully homogeneous currency area cannot escape the mother of all monetary policy trade-offs or dilemmas. That's the short-run trade-off between inflation and unemployment embodied by the Phillips curve. Second, structural heterogeneity is anything but a surprise. No existing currency area is perfectly homogeneous, let alone optimal in the textbook sense. Even small countries display meaningful differences across relevant structural dimensions, differences that citizens often value rather than lament about. You would be hard-pressed to find a person born in Salzburg, as I was, who embraces the idea that Vienna's more accessible housing market fully compensates for Salzburg's natural beauty. While Austria may not be the most dominant player in the world economy, for sure, very similar arguments hold true for different regions in the US, China, or the UK. Heterogeneity in structural economic conditions is therefore not a pathology unique to the euro area. I would even argue that it is not a pathology, and I take pathology here under inverted commas, at all. It is simply part of the euro area's DNA. Besides, common monetary policy and the introduction of the euro have gradually diminished the relative weight of this part since 1999. The correct macroeconomic performance benchmark for the euro area is not a hypothetical currency zone with perfect structural homogeneity, but rather a counterfactual Europe that remains fragmented across many separate monetary policies. So now we're turning to the third explanation, or candidate explanation, and to the core of monetary policy, heterogeneity in euro area that is inherently linked to the uneven transmission of monetary policy. So heterogeneous transmission can transform a policy decision that is in principle appropriate for all members into a blurred signal of varying strength across countries, regions, sectors, or even economic agents. So heterogeneous monetary policy transmission in the currency area is indeed a key challenge. First, it can amount to taking economic hostages. When this form of heterogeneity takes hold, the value of monetary area membership may fall for some constituencies. At the same time, the euro area offers little room to escape such adverse shifts. Living in the currency area is virtually impossible for sub- or transnational regions and would be connected to high political, economic, or social costs for countries, firms, and households in the entire monetary union. Second, when uneven transmission turns monetary policy into a cacophony of different signals, the communication of decisions become increasingly challenging. Breaching uniformity offers little reassurance when the impact of our decision is perhaps felt to differ across the currency area. Third, in severe crisis scenarios, heterogeneity in transmission along national borders can turn into fragmentation. When differences in financing conditions are no longer justified by fundamentals, but instead reflect self-enforcing perceptions of breakup risk, the singleness of monetary policy in the euro area may come under threat. In short, uneven transmission may well be the spectre we have been looking for. And yet I believe it is time for the market people in the village to reconsider whether this gloomy assessment remains justified in 2026. Let me briefly mention two reasons behind my more positive assessment of the situation. First, given that exit is not viable, is not a viable response to heterogeneous transmission, voice becomes all the more important. And the Eurosystem has been investing heavily in enabling voice. Research into the factors that shape heterogeneous monetary policy transmission provides a channel through which scientific evidence can be heard and taken into account in our deliberations and decisions, and we'll hear a lot about this research today and tomorrow in the conference. The increased availability of confidential, granular and high-frequency data, for example, credit registries, allow us to look at monetary policy transmission under an even more powerful microscope. The ECB's CHAMP research network, short for Challenges for Monetary Policy Transmission in a Changing World, is a great example for this strand of analysis. For instance, thanks to the research conducted by CHAMP members, and several members of CHAMP come from the Austrian Central Bank, we know that on average only half of the variation in the interest rate pass-through to firms' external finance premiums stems from country-level heterogeneity, such as sovereign risk premiums. The other half comes entirely from bank and firm-level heterogeneity that is independent of the national borders. At the very least, evidence-based insights like these allow policymakers from the ECB to be more transparent about the causes and consequences of uneven transmission in our public communication efforts, fostering both credibility and the understanding of our decisions. And second, and this is something you know, the villagers always have their magic potions. Thanks to the existence of the transmission protection instrument and outright monetary transactions, the ECB is well equipped to address unfounded fears of the reversibility of the euro. Recent research even suggests that we may have more tools to address fragmentation than commonly assumed. In particular, narrowing the ECB's interest rate corridor appears to be highly effective in containing heterogeneous pass-through at the short end of the yield curve. Hence, the size of the interest rate corridor can be a potential policy instrument. Let me conclude, ladies and gentlemen. You may take my speech today as an argument for a more optimistic reinterpretation of heterogeneity in the context of euro area monetary policy making. I've argued that the euro system needs more rather than less heterogeneity when it comes to the composition of its main decision-making body, that structural economic heterogeneity involves trade-offs for monetary policy, but the Eurosystem policymakers are accustomed to making these trade-offs, and that should uneven transmission become a serious challenge at some time, we have the tools to address it. Some may claim that there is too much unfinished business left before optimism is warranted. For example, the completion of the banking union and the savings and investment union remain work in progress, and there is full support by the ECB Governing Council for the plans of the European Commission in that respect. Here I want to believe in a mutually reinforcing process. If Eurosystem monetary policymakers do our job if Eurosystem monetary policymakers do our job well, we may be able to strengthen the case and consensus for stronger integration, further reducing structural heterogeneity and the uneven pass-through. And if not, history suggests that some future crisis will perhaps lend us a hand to do the job. Hopefully we don't need them. Others may continue to dream of a fully homogeneous currency area as an ideal, but I would argue that they tend to overlook the price that such perfect homogeneity entails. Alberto Alesina and Enrico Spolaore famously framed the optimal size of a political jurisdiction as a trade-off. Larger jurisdictions allow societies to reap economies of scale, benefits from scale, while smaller ones reduce the costs associated with heterogeneity across many dimensions. Alesina and Spolaore find that democratic societies may tend to create an inefficiently large number of small jurisdictions, because voters do not fully internalize the aggregate efficiency losses of fragmentation. The same logic may also apply to the design of the euro area. Heterogeneity seems a cost worth managing if we want to reap the benefits of scale integration. And I think there is a large consensus in the euro area about these benefits of scale and integration. My point is not that the village should abandon its caution, yet not every form of heterogeneity should be treated as an invading army at the gates. Some forms of heterogeneity are useful. Some are unavoidable, and some represent genuine challenges. The latter, however, can be diffused with the right instruments and institutions. And paraphrasing the chief of the small village back then in the Roman times, one of the original villagers said, "I do not think that we have to fear that the sky may fall on our heads tomorrow." Thanks a lot. I want to ask now the Managing Director of the IMF, Kristalina Georgieva, on the stage. We'll start with our fireside chat on the stage. And we'll start with a short video.
Austria stands at the heart of Europe, a nation defined by stability, innovation, and international cooperation. In this short feature, we are exploring Austria's relationship with the International Monetary Fund and why this partnership has been playing a vital role for Austria's economic strength and global financial position. In July 1944, delegates from over 40 countries came together in Bretton Woods, a town in New Hampshire. The world was still in turmoil and at war, and the goal was to define rules for a new post-World War II international monetary system. One of the key outcomes of the conference was the establishment of the World Bank and the International Monetary Fund. The IMF was created to oversee the stability of the international monetary system, to promote exchange rate stability, and to provide financial assistance to countries facing balance of payments problems. Austria became a member of the IMF in August 1948. In the post-war years, Austria underwent a significant transformation, from a country in ruins to the stable, prospering economy we see today. On the IMF's executive board, Austria casts its vote as part of a constituency which includes Czechia, Hungary, Kosovo, Slovakia, Slovenia, and Turkey. Twice a year, the central bank governors and finance ministers of the 191 member countries flock to Washington, D.C., or another host city, to attend the spring meetings and annual meetings. Back in October 1961, Vienna also had the honor of hosting the annual meetings. In turn, the IMF regularly visits its member countries, mainly for surveillance activities, and makes recommendations from the perspective of a neutral advisor. Vienna is also home to the Joint Vienna Institute, which was founded in 1992. It provides training programs for officials from countries in Central, Eastern, and Southeastern Europe, the Caucasus, and Central Asia. The JVI strengthens institutions, connects officials across the region, and gives professionals from transition countries first-hand experience with advanced market economies. All in all, the IMF plays a vital role in preserving global financial stability, while also serving as an important partner for Austria.
So I think most of the audience know about the IMF. They know you, so I think I don't have to introduce you, the Managing Director of the International Monetary Fund, with a long history of senior policy-making positions in the European Commission in different forms. You have been for a long time now being a very important member of the international community as a truth teller about economic imbalances, and we'll talk a bit about that in a second. This is a fireside chat, we said. That means I ask a few questions in the beginning and then we open up to the audience. We deliberately did not light a fire besides our seats. First of all, it would be dangerous. Second of all, it's warm enough, I think, in summer in in Vienna. Let me just get started right away. Kristalina, you have been speaking in Brussels on June 9th about the need for Europe to respond proactively to what is happening in a more fragmented and more confrontational global environment. So there is shocks, there's more and more shocks coming. Europe is quite vulnerable to these shocks. Why are you, or what are the concerns that are most concerning to you for Europe now at the moment?
Let me first say how happy I am to be in Vienna and to cross paths again professionally with Johannes Hahn. We served together in the European Commission, and now he's in my area of responsibility. I also want to recognize the presence of our executive director, alternate executive director to be precise, representing Austria, Mr. Jus. He's right here on the first row. Above all, express my gratitude for your invitation to talk about where Europe is in the world and where we should be headed. As you said, we live in a more shock-prone world. It is very clear that shocks will continue to come. Building resilience to these shocks is a responsibility of policymakers everywhere. It is also our responsibility at the IMF. And the way we think about the future is recognizing there would be very strong transformative forces in play: geopolitics, technology, dramatically changing the way we work, we live, and climate. So those three in Europe are joined by another one, demography, the fact that in Europe we are an aging population. So we have to think about how we position ourselves to not only withstand these forces, but benefit from them. And that takes me to 3 points I want to make about Europe. My first point is that there is a lot we Europeans can be proud of. The fact that Europe has managed to come together and create the best social invention of the 20th century, the European Union, with its convergence engine, is still not met with a similar transformation of that scale and significance nowhere else in the world. And it has brought tremendous benefits to Europe, but also it has brought benefits to the rest of the world, because there is an example of a region that came from wars into peace and stability. Second, we cannot, however, be complacent and say, oh, well, we have done so much, let's take it easy. Why? Because the world is not taking it easy, and we have to compete. We have to be in a position of economic strength. There is nothing like economic strength to protect people and businesses in a more fragmented world. And well, let's face it, in Europe, we have an unfinished business. It is called the single market. If we are not determined with a sense of urgency to complete the single market, we will continue to fall behind in competitive terms. I want to share with you a very simple fact. I came to the Commission in 2010, as Johannes would remember, as an accidental commissioner. At that time, the European economy was the same size as the economy of the United States. Where are we today? We are 70% of the US. And we need to ask ourselves, how did that happen? It happened because of, relatively speaking, weaker competitiveness of Europe. And the third point I want to make is that it is absolutely paramount for the citizens of Europe to demand that their leaders have the courage and perseverance to bring Europe forward. And in that sense, it is everybody's responsibility to demand it. And I hope that in the audience here, you would be pressing your Austrian authorities. My apologies to the Austrian authorities, but it is necessary. But above all, you would be pressing the European leadership to complete what we have started, and it is not done yet. I want to give you our analysis at the fund. What would it take for Europe to be more competitive again? We have it in the Draghi report, but we extracted 4 actions for Europe that we are convinced, if taken, would change the direction of our union. 1, the 28 regime for firms. 2, the completion of the banking union, and of course the savings and investment union. 3, genuine free movement of labor. Now people move, but they don't move with their qualifications across borders. And 4, and with the Iran war, that became very visible, completing the energy union.
I think there's full agreement in many institutions, especially in those institutions. I think that's our responsibility as well, that have a long-term horizon. And we see ourselves in the Austrian Central Bank as the agent of the long run. And the long run is exactly what you mentioned in terms of becoming more competitive and becoming actually a more integrated region. I think it's very important to explain that a lot because the fears, that the concerns that are raised by many citizens are those you mentioned at the beginning. There are structural changes. That is, of course, unsettling some people. But on the other hand, you have to explain how to create opportunities out of these concerns. Thanks a lot. If you allow, Kristalina, I would briefly talk about, of course, something that concerns central banks most. That's inflation. We have been seeing an energy price shock again with the war in the Middle East. Hopefully, the signing of this interim agreement today leads to a path of declining prices, but the prices will stay higher for some time, clearly higher for some time. And people, of course, are reviving memories of the 2022 energy price shock. So what is your assessment on the impact on Europe? And perhaps you have some thoughts on the developments on the ground. So can we be hopeful for the next couple of months?
Well, we presented our Euro area Article 4 conclusions just last week. And what we had to do, given the developments over the last months, was to downgrade our growth projections for the Euro area from 1.1 to 0.9% and upgrade our inflation projections from 2.6 to 2.8%. This is happening everywhere. Europe is not an isolated case. What we have now is prospects for reducing pressures on energy prices. And I can tell you, I just came from the G7 summit, that there is a genuine commitment of everybody who was there to work towards making sure that the Hormuz oil and gas flows freely again, and that unity of purpose can bring the results that are necessary. But it would take some time. It would take time to recover the flow through the through Hormuz. Yeah. And it would take time to replenish reserves that have been utilized. What buffered us, why it hasn't been worse, what buffered us is that many countries could deploy their oil reserves. For example, China has done it. They have not been putting pressure on the market buying much because they had 1.4 billion barrels of oil. But now everybody who is fearful that maybe there would be another disruption would rush to replenish their reserves, and I would expect that they may even go a little higher, just as precaution. So what does it mean? It means that we are not going to see drop of oil prices immediately. They would be easing, but it would take some time. Next year, 27, we may be in a situation in which there is oversupply and prices really drop, because in meanwhile, many oil-producing countries have stepped up. The US is now the largest exporter, and so are many others that have the capacity to step forward. But for the observable future, there are three things to watch. One, oil prices. They have gone down now under $80, how far they would go. Two, inflation expectations. In the short term, is it still something that we expect to see? Especially, do we expect to see some secondary impact of the increase in energy prices? Very likely there would be some of it. And three, financial conditions. We are in a better place today than we were a week ago, but we are not completely out of the woods. So what does it mean for central banks? You know it very well. Be determined to follow the data and be prepared to act if necessary. At this point, the European Central Bank has taken action. We believe that was the right decision to take because inflation has already gone up. Would it be necessary to take action again? Is to be seen. In meanwhile, the public and the businesses need to have the confidence that should that action be necessary, ECB will take it. And that gets into good communication on inflation. I want to say something that I'm very proud for Europe. When in 2022, Europe was hit by the impact of the war in Ukraine, Russia's invasion of Ukraine, Europe acted with tremendous force to free itself from dependency on Russia. And Europe has also significantly improved energy efficiency. Today, we are benefiting from it. And the moral of this story is very simple. Energy independence, as much as you can do it, renewable energy sources, and integrate the energy system of Europe. It is ridiculous that we live in this world in which energy shocks may continue to come, and we have 27 separate energy systems. The moral of the story is use collective will and resources. We have the European budget. Both Johannes and I have had the privilege to be responsible for the European budget. Use it wisely. Use it for the strength of Europe. And in the energy field, that has direct relevance on how much we should fear inflation in the future.
It's one of the markets, the energy market, where exactly I think more integration would help, especially when it comes to the infrastructure that helps the flow of energy and makes energy prices more uniform across the different countries. Now we have large differences. Let me just add one sentence regarding the ECB. Of course, the ECB is determined to bring down inflation to the 2% target. The uncertainty, of course, at the moment is creating a pressure, and we don't know exactly. That's the reason why we stand ready at any time. We don't know exactly how the memories of the last inflation episode weighs on what is happening now in terms of price increases by firms, but also wage demands by workers. We'll see what's happening. Hopefully, this conflict is not continued.
How many of the people in the audience are on the staff of central banks? Can you raise a hand? So you have my full moral support because your job is very hard. You act prematurely, that throws cold water on growth, you regret it. You are slow to act, inflation picks up, you regret it. So all the power to your collective will to read the data carefully and make wise decisions.
Thanks a lot. I think everybody agrees. It is, of course, the reverse side of the coin of central bank independence that you sometimes have to take decisions that are not popular in the short run. But it's a commitment device to do things that at some stage would be postponed if you hadn't had central bank independence. Thanks a lot. We have a third area of topics that, of course, is of much concern to Austria. Austria is a hub towards the east and the southeast. Our banks, our insurance companies are very active in the entire region. So we always look at the region, we look at development there. We have been seeing a very robust growth there. The region has weathered some shocks remarkably well. But inflation has also picked up a bit. And there's the new shock now that hits, of course, countries that are developing, that want to exceed the European Union more strongly than countries like Austria or countries that are already part of the club. So what do you recommend for the countries that want to join and countries that are towards the southeast of Austria, especially the Western Balkans?
The beauty of the European Union is that we have aspirations to bring in our family those that are committed and take the right policy choices so they can be part of the European Union and they're in the neighborhood. And I want to praise Austria for all you have done to reach out to your neighbors in the early days, in the prior waves of accession, but also as they prepare. Those that aspire to join prepare for it. Two observations from the fund. One, we need to recognize that in many of these countries, if not all, there is still work to be done to strengthen institutions, including central banks. And we are doing this work together. Actually, the Joint Vienna Institute is a big source of capacity development. Many of the central bank governors of some of those countries have gone through here. And therefore, with still ongoing institutional building, the issue of independence is more difficult for some of them. I can tell you I meet regularly with central bankers from the neighborhood, from accession countries, and very often they do share that it is harder to have that recognition in society that they need to be independent and they need to be able to take unpopular decisions. And then I talk to their two presidents and talk to others to say, look, this is so valuable. So we are talking about a period of time whenever there is more uncertainty, these institutions need more reinforcement. And I would urge you to continue to be a source of strength for them. And secondly, they have a harder situation. Yes, growth in these countries on the whole is stronger than it has been in, say, in Austria or in the Eurozone, but their currencies have depreciated vis-a-vis the euro and vis-a-vis the dollar somewhat. And we all know when there is currency depreciation, it fits into inflation. We calculate that for the Southeast Europe region, we might be seeing inflation pressures in the order of 1% more. 1% inflation is not a trivial thing. So when we look into that, how we see it from the fund, we see it as a moment in which we need to be even more forward-leaning with diagnostic, with analysis, with policy advice, and with engagement, so they collectively have more strength than each one of these institutions individually. I'll share with you, I'm not going to say which exactly of the neighborhood countries, but I had a meeting with the central bank governor who virtually burst into tears, saying, it is so hard when everybody is hostile towards you. What do I do? And then I recognize that we have a high responsibility to speak on behalf, to be present, to back up decision makers. Because if you think it is hard on you, it is much harder for these central bank governors in countries with still weaker institutional environment.
I fully agree with you. The ECB governors can always hide behind the ECB Governing Council. The governors there, they cannot hide easily. And of course, there's strong relations between the Austrian Central Bank and the central banks of the region. And I always see that not as an assistant, I see it as mutually beneficial because we learn a lot from them on the developments in these countries. And usually these are the strongest institutions. So backing them up in the countries is important.
Yeah, one thing that I recognize as managing director of the IMF is what an incredibly important role the IMF has played in building central banks and speaking loud and clear about the value of central bank independence, including when it is happening in some of the largest economies.
So thanks a lot. We have about 10 minutes, a bit more left. So I would open up to the audience. I see a raised hand here. Please.
Thank you.
Always introduce yourself briefly.
Yes.
And,
Jakob Lauer, I work for Handelsbanken, a Swedish bank. So it's a lot to talk about how to make Europe more competitive. It would be interesting to hear your perspective on how changing in, for example, banking regulation can be part of the process. So how can Europe make the banks play a larger role in making Europe more competitive? Thank you.
Mm-hmm. Excellent question. So let me step back and say, what is the biggest problem we have in terms of how our savings work for Europe? The biggest problem we face is that our money, in comparison to the Americans, are lazy. They go through, 2/3 of our financing goes through banks. In the US, 2/3 of financing goes through capital markets. In our case, loans dominate. In their case, equity investments dominate. In our case, risk capital is scarce. In their case, it is abundant. What is the result? 300 billion euros of our people's savings are in the United States working for the Americans. And we have so many of our talented people who can drive research and innovation and through it competitiveness in Europe, deciding to go to the US because it is easier to get financing, especially venture capital financing. So when we think about what we can do, one, we need to complete the banking union because we are not using even the banking capacity to the fullest to inject growth and competitiveness in Europe. But frankly, I think everybody in Europe should be recognizing that without deep and liquid capital markets, without the completion of the savings and investment union, we will not achieve the drive that is necessary in today's technological era. It's just not going to happen. And we have it. I mean, in my recent visits, I go to countries and I want to see what is your best AI-linked investment. So in Poland, I went to a data center. In Belgium, I went to see a semiconductor research facility. We have the talent in Europe. Why is it that our talent is not producing the companies that are defining the future of our economies? So I would not stay strictly on what should happen in the banking system in Europe. I would say what should happen in Europe so we have the ability to dramatically increase the attractiveness of investment in Europe to our own people and to the rest of the world. AI is now such a prominent reality. So you look at the US and you look at us. Large AI companies in the US, none in Europe. Cannot continue to be in this way, just cannot. We cannot, as Europeans, we should not have our brain power to be sucked in on the other continent. I mean, I live there, okay. But we have 450 million consumers in Europe. We are so much more attractive as a place to live. You know the term that is used for the European Union? Lifestyle superpower. But we also have to be a technological superpower, and that requires money willing to take more risk.
I fully agree, and cannot agree more actually on that point. Actually, the ECB Governing Council always also mentions how important the Savings and Investment Union and the 28th regime is. We have a question in the second row by Tobias Thomas.
Hello, Tobias Thomas of the Austrian Productivity Board. Thank you very much for your very important remarks, in particular on competitiveness and productivity, and I could not agree more. However, in particular in terms of crisis and geopolitical tensions, trade conflicts, many countries of the world are reacting with short-term measures rather than with structural reforms to long-term improve competitiveness and productivity. How can we overcome this short-termism, and which could and is your institution playing?
This is such an important question because indeed in a more shock-prone world, we concentrate on the urgent, which is soften the impact of the shock that is ongoing, and we lose sight of the long-term objectives of structural reforms that put us in a position of competitive strength. Unfortunately, shocks are not only frequent, but they're very impolite. They don't wait their turn. So we had COVID, and then war in Ukraine, and then inflation spike, and then interest rates up, and then a trade shock, and now the Middle East shock. And that, objectively speaking, makes it so hard to stick to long-term goals. How can you do it? My answer to it is in Europe, for the European Commission, for the leaders of Europe, there has to be one priority: completing the single market. One priority. You wake up in the morning, what is my goal? Completing the single market. You go to bed, what should I be dream of? Completing the single market. And I have been advocating for a single market czar in Europe. Put one person who is responsible to drive it, reporting to the leaders, and of course the president of the European Commission. Similar model to the one Europe chose during Brexit, when Michel Barnier was called to serve Europe as the one single point to avoid noise and confusions and deviations to drive a good outcome for the European Union. We are at this, if not more important point, if we don't recognize that it is a tough world out there, and we Europeans, we have to toughen up, and our toughen up is completing the single market. We will look back in a year or two, we will regret it. This is the moment. This is the moment for us.
Yeah, you have to. I have Peter Niederländer here, and you probably know even for the Savings and Investments Union, there's about 50 or 55 ministers in the European Union responsible for the legal acts, and that speaks into your proposal of having one person.
Thank you very much. My name is Betty Niederland. I'm from the Austrian Central Bank. We speak a lot about the global role of the euro and the role of the dollar internationally, which is weakening. How do you see that? Is that really necessary that we increase the role of the euro in international trade or internationally? What it will bring us and what are the measures to do so? Thank you.
Lovely question. I actually felt bad I didn't say anything during my interventions on that. Where the world is today, obviously multipolar, more centers of relevance, and we are blessed to be one of them. When you look at the currency trajectory, or what we see is in terms of reserves composition, there has been gradual change in which the dollar, the share of the dollar has dropped. It was around 70%. Now it is 50-something. It has gone down. What has gone up? Of course, the appearance of the euro, big impact at that time. But since then, we see more increase of medium-sized sound countries like Sweden, Switzerland, Australia, and gold. We don't see the euro significantly expanding its role in reserves. We also know that there is hunger for more euro-denominated assets, more bond issuance. At the fund, we have taken a very clear position. We think it would be a mistake for the European Commission in the next multi-year financial framework to pay down what we borrowed and not borrow anymore, because there is desire, there is appetite for that. And then we have the trade agreements. What is wonderful is to see how Europe, in this more diverse world, is reaching out to sign trade agreements with many countries. We say clearly we believe in open and integrated global economy, and here it is. We are reaching out to build our links trade links with countries. There is nothing wrong to think about these agreements also as a platform to expand the role of the euro. But let's be very clear. The euro can expand and be very strong if the European economy grows and is very strong. It is the foundation, the fundamentals have to be there. So yes, in the short answer to your question, yes, there is space for the euro to play a bigger role. ECB is now working on digital euro. But ultimately, how far we can go would depend on how strong the foundation of the euro is, how strong the euro area is. Where does that lead us? Complete the single market.
So we always end up there. Jakob Zirm in the third row.
Yeah, Jakob Zirm from the Austrian daily newspaper Die Presse. You mentioned now several times that it's the necessity of completing the single European market and the banking union. As a journalist, I write about this topic for more than 15 years, and all the experts agree on this topic, but it's not happening. So my question is, who is blocking it? Is it the national politics? If you look to Germany, at the situation with Commerzbank and UniCredit, one could get the feeling, but what's your point of view on this question?
What we see now is a recognition that it was important and necessary, and now it is turning into existential for the future of Europe. And that has moved views of leaders in a direction of, yes, we need to get that done. There are now that coalition of the willing countries that are saying we want to drive it, we want to be ahead of it. I hear from the leaders of Europe unanimously now a recognition that this is a priority. What is on the way? What is on the way is first the urgent that comes on the plate of all of these leaders. For example, war in the Middle East pushes energy prices up. It becomes urgent to figure out what to do about it, who to help, how much to help, how to coordinate with other leaders. And that these distractions are going to be with us. And also what is on the way, frankly, is the fragmentation in decision-making on that topic. If you ask who in the Commission is the single market person, you know, they sit in a room and you say, who among you is the single market? And you would have more than one hand in the air. That's a problem. And that also, that sense of unity, of purpose. Different countries see, yes, that is a big priority, but for me, I have A, and I have B, and I have C. I think that you, the media, you can do a huge service of Europe by pressing the urgency to act now. It is easy to hide behind, we have been talking about it for 15 years, we can talk for 5 more. No, we can't. If we don't quickly, by a deadline, and now we have deadlines, finish this work, we will see in relative terms Europe sliding backwards, not anymore standing still, but sliding. Well, we have been sliding backwards vis-a-vis US, sliding backwards even more. We cannot afford that for our people. I don't know what you do with your phones. Usually what we do on our phones is we have a picture of our family, of our beloved on it. I have it on my phone. Every time I'm thinking of what should I do, what is most important, I look at them and I know what I have to do. So kind of my call to our leaders is look at your beloved, get it done. No delay.
That's a perfect remark. We are already over time, so I saw a few more raised hands. So apologies to all of them that we cannot answer the questions. Let me take the opportunity to thank you, Kristalina, for taking your time. We really see it as a privilege and honor to have you at our annual conference. Thanks for your remarks, and you've seen that they were very well received. So a big round of applause for the Managing Director of the IMF.
Thank you. My message to Europe as being a proud European at the helm of the IMF is very simple. It's this.
Thank you.
Jetzt alle nicht zu, so
Wollen wir gleich alle hoch?
Aber du kannst es abtippen. Du hast auch von verschreckten Abbiegerregeln.
Ich glaube, hier ist überall okay. Funktioniert das? Ja, funktioniert. Sehr schön. So, hallo. Good morning, everyone. We are trying to find our seats. So after this excellent kickoff of the conference, I'm very happy to chair the first policy panel of this year's conference. My name is Wolf Reuter. I'm the head of the Economics and Research Department here at the OeNB, at the Austrian Central Bank. In this first policy session, we want to set a bit the scene for the topic of the conference. The title is Fiscal, Monetary, Macroprudential Coordination in a Heterogeneous Union. And let me pick something up that the governor said in his speech at the beginning. He took us to a monetary policy village, a place where heterogeneity is traditionally viewed with a degree of suspicion, where even talking about heterogeneity triggers some concern. But he also said that actually heterogeneity is not a bug, it's a feature. So basically, not all heterogeneity is a problem. Some forms are useful, some are unavoidable. And actually, from a policy point of view, we only need to address some of them, or we only only some of them are truly relevant. So I think for this panel here, the question is not so much if heterogeneity is good or bad in a monetary union, but it's more how should we deal with it in practice? How does it look in practice? And we want to go a bit deeper into what are the practical implications of heterogeneity in a currency area. So we will talk about the transmission of monetary policy in a heterogeneous currency area, trade-offs, the policy interaction. And then, hopefully, in the end, we have time. We will also talk a bit about what would be needed, going forward in the euro area to address those heterogeneities better. Yeah, and for that, we have a great panel, which actually can look at the three domains that are mentioned here: fiscal, monetary, macroprudential, from different perspectives. Let me introduce the panelists. I start with Mariana Kühne. She can bring especially the macroprudential angle. She's the executive director at the Austrian Financial Market Authority. And in this role, she's obviously actively involved in macroprudential policy at the European level. She brings a strong perspective on financial stability and supervision. Then Michael Horvath, he can bring the monetary policy perspective, but also a very strong fiscal monetary perspective. He's the chief economist and executive director at the Slovakian National Bank. And why did I say he brings also the fiscal perspective? He was a founding member of the Fiscal Council in Slovakia, and for a shorter time in 2023, he was also finance minister in Slovakia. For the monetary policy perspective, I don't think we could have found someone better. So Christoph Kamps, right now, Deputy Director General for Monetary Policy at the European Central Bank. And I think in 2 weeks' time, he will be Director General at the ECB for International and European Relations. And he was strongly involved, had a key role in the strategy work at the ECB recently, especially the 2025 monetary policy strategy assessment. And last but not least, but I can't pronounce your last name. Okay, Michal, I tried. Prososa Brzezinski, you will say it? Okay. He's an economic advisor at the Polish National Bank and a professor at the Warsaw School of Economics. And he will probably complement our discussion also more from an academic point of view based on research. Okay, how we want to proceed is we will have introductory statements by each of you. We target 7 minutes for each introductory statement. Then we will have a round of questions among us, the panel, and then hopefully we still have some time for the audience. And I would like to start with Christoph Kamps, to start with the monetary perspective, and then go on to fiscal, macroprudential, and then the overall view. Christoph.
Okay, thank you very much, Wolf, for the kind introduction, and also thank you very much for the organizers for inviting me, in particular Ernest and Maria, with whom I've worked for a long, long time. And I will speak about the ECB strategy and explain how we take the 3 dimensions into account, and I've worked a lot with Ernest, Maria, and many others in this room on this topic. So maybe to also bring back a link to what we just heard from Governor Kocher and Managing Director Georg Eber on heterogeneity. And that, as Wolf said, I don't want to talk too much about whether heterogeneity is good or bad. Probably the answer is, as an economist will always say, it depends. There are certainly aspects of heterogeneity that help the European economy, the diversity, the capacity to absorb shocks, and also benefiting that economies have different structures and can help each other out at different points in time. But of course, we've also gone through deep crises where actually vulnerabilities were exposed, and it was very hard to deal with heterogeneity at that time. But so let me rather take the central banking perspective, which, as you know, is due to our mandate more an aggregate one, which doesn't mean we are blind to heterogeneity, but more explain how it shapes our strategy. So, I mean, one of the fundamental questions central banks often get asked is, why is your inflation target not 0? You have a price stability mandate, and strictly speaking, price stability will mean prices on average don't change. And so what we have established, and a large body of literature has established, is that for the smooth functioning of the economy, you need an inflation buffer. That has several reasons, but one important one is the smooth adjustment of the macroeconomy of different countries, of different sectors to shock. So the ability to absorb shocks is much easier if there is a certain inflation buffer. And what has been established as a kind of industrial standard in the central banking world across advanced economies is that actually an inflation rate of 2% on average over the medium term strikes an appropriate balance in that respect. And that actually helps a lot economies or sectors to avoid falling into deflation when negative shocks hit. Or also, as we know, there are downward rigidities in wage setting, etc. And actually, you would need to force wages to shrink if you hadn't a certain buffer. And so that's one important component. The other component that's also relevant in addressing heterogeneity is the medium-term orientation of policy, which we can see at play also right now. When a massive shock hits, it would be extremely costly to immediately try to bring down inflation in a matter of months, which would require outsized monetary policy reactions. And that is why, again, a medium-term orientation allows to clearly anchor inflation expectations at target, at showing the commitment to bringing inflation back to target, but at the same time allowing the economy to adjust to such major shocks. Now, one of the aspects also the governor mentioned, and what we have learned from 27 years of experience in the euro, is that there are times when the smooth transmission of monetary policy is at risk or in peril. We saw that during the sovereign debt crisis in the aftermath of the GFC. And those are moments where actually when vulnerabilities get exposed and maybe markets start to focus excessively on a particular set of countries or sectors, where actually you can have these self-fulfilling dynamics coming into play that also Governor Kocher mentioned. And actually it's then again for the ECB, and that is part of our core price stability mandate, to have backstops in place that avoid such self-fulfilling dynamics. And Governor Kocher mentioned earlier instruments. He also mentioned the transmission protection instrument put in place in 2022, which some critics say is an instrument that shows the ECB is under fiscal dominance. And I and many others would see it the other way around. Actually, this instrument helped a lot to coordinate the private sector on a good equilibrium where the centrifugal forces are kept at bay. And it allowed us, as the European Central Bank, to tighten monetary policy to exactly the degree needed to bring inflation back to target. And so this is an important aspect, and that's maybe when heterogeneity comes into play and could be a source of vulnerability. Now, another aspect that's very important in our strategy, and that links to also the macroprudential or the broader financial stability dimension, is that what we learned is the pervasive role of macro-financial linkages. Clearly, we saw that at play in the financial crisis in 2008 and its aftermath. And so we have learned painfully that financial stability is a precondition for price stability, but macro stability more broadly. And so that is something the Governing Council takes into account in its deliberations. Twice per year, there is an in-depth discussion on the links between financial stability and monetary policy, and to what extent there are complementarities or trade-offs. And I'm sure Mariana will talk more about that, but we see macroprudential policies as the first line of defense when it comes to financial stability. But of course, the ECB plays a complementary role in monetary policy. And of course, we also have the microprudential leg with the SSM. What Governor Kocher also said, and also the managing director, is of course there's unfinished business on completing EMU. There are still areas that are underdeveloped. And I would put those under the label that 27 years after the foundation of the euro, we still have very imperfect private sector risk sharing in the euro area. Actually, what we know from a broad set of literature is that the degree of risk sharing through capital and credit markets is a fourth of what it is in the United States. And again, that is, if you want, a missed opportunity to address shocks in a more efficient way. And linking to this topic of risk sharing, it's not only about the savings and investment union, about completing banking union, but as also the managing director said, also the energy union falls under the theme of of risk sharing, where actually, because the energy mix is different across countries, that's a very good opportunity to absorb shocks in a more efficient way if you have energy markets that are more interconnected than they currently are. And maybe one topic I didn't talk about is fiscal policy, but I will leave that for the others or for a second round. As Mervyn King famously said, central bankers are actually obsessed with fiscal policy. So let me leave it at that. Thank you, Bob.
Great, thank you. That's the perfect transition. I would say, Michael, it's your turn with fiscal. I just bring you the clicker for the presentation. I would say you can do it from there. And can we see the slides? Perfect.
Yes, thanks, Wolf. And it's great to be back. Always a great event. And so let me share my thoughts on heterogeneity. I prepared slides as well, just to have some visual aid to what I'm going to talk about. So I would also like to echo the words of the governor, who said heterogeneity was great in so many ways. Actually, what makes our lives interesting. And also, it's true that even at small country level, in the context of Slovakia, for example, there's a lot of heterogeneity, not only in terms of landscape, but also in terms of various economic variables. So, and the important question is what institutions actually make this work at that level, and which institutions we are lacking at the European level. And I guess we will get to that later today. From a monetary policy perspective, I think heterogeneity really matters if it somehow threatens our ability to deliver our mandate. And it can be in normal times if you have a big divergence along certain dimensions, or it can be in crisis times where even fairly innocent-looking heterogeneities can suddenly matter, especially if there are no buffers. Or, in other words, it matters when there is some non-linearity working. Either the shock is very large, or the divergence is large, or there is where we are hitting some kind of a constraint, whether the governments or banks or firms are hitting some kind of constraints as a result of heterogeneity, and it might make our problem difficult. Ages ago, when I used, as a young advisor, I used to accompany our finance minister to Eurogroup meetings. We had Jean-Claude Trichet always turning up with a physical copy of this chart, showing a divergence in unit labor costs. And so at the time, the picture was cut somewhere around 2009, and you see that the FANG chart at the time, it was all about widening. In the meantime, there has been some convergence. The low inflation years obviously helped somehow bring countries together. I guess people from the Commission would also argue that the macroeconomic imbalances procedure also played its role in that. It is something that we don't talk about that much these days. It has clearly become less of a concern from a monetary policy perspective. The reason why Mr. Trichet was showing this was he was always reminding the governments, the ministers, that joining the euro area is also a commitment to align certain policies with the needs of monetary policy. And obviously there is still remnants of divergence there. Here, let me talk briefly about Slovakia, where you can see, especially in recent years, the divergence in unit labor costs from the euro area. So, and also if you plot the previous figure in not in per hour terms but per person terms, you can see a widening gap towards the end. So these high inflation years have kind of renewed this heterogeneity a little bit, and usually these ULC divergences, they're also a symptom of deeper problems. In the case of Slovakia, you could say something about public sector wages and sort of in a broader terms underlying fiscal problems. Private sector wages growing slower than public sector, and public sector deficits rising, but there is inevitably also they're in the same market, so the wage pressures influence the private market as well. At the same time, ULC has an important productivity dimension, and for the last decade we've had a problem with productivity growth. It's not too bad in the last few years, but again, when you look at it from a sectoral level, then some of the sectors most affected by divergent ULC development are the ones that stand at the heart of the Slovakian economy: industry, manufacturing, and so on. And obviously we are a catching up economy, so you would expect some convergence along these dimensions as well. But there is a threat of loss of competitiveness there, and this is currently, we don't have a plan B for the economy. This is sort of a low-cost manufacturing base is what we do. So if we continue along these lines, we may really end up being an unhappy member of the euro area, even if not threaten the coherence of the whole project. Let me now switch to a different element in the Phillips curve and talk a little bit about expectations. So there is considerable divergence or differences in expectations across countries. So the figure on the right-hand side shows you in percentage points the difference in inflation expectations relative to Germany and the unexplained element of that. So these are technically country fixed effects from an estimation which involves all kinds of control variables. So this is the differences in inflation expectations that we can't really explain, and they differ also in different time periods depending on when you do the estimation. Again, you could say, well, so what? I mean, people have different expectations also at the national level. We have clearly been able to deliver price stability even in these circumstances. So what's the interesting nonlinearity here, or a potential nonlinearity here? And that's in the left-hand side diagram. It shows you the thresholds at which people's behavior in response to inflation changes. So it's been a story in the recent inflation surge period that at some point people start paying more attention to inflation and start behaving differently. And there are in different countries this happens at different points in time. I also have to say that people switch off also at different points in time. So as inflation is coming down, in some countries it happens sooner, in some countries it happens later. Here in this picture you have the numbers for Italy. So attention is being measured by how much people Google the word inflation, and you can, so this is Germany, sorry. So Germany, you can see that on the way up, there was a clear break at around 4% when people started paying a lot more attention to inflation. Coming back down, they're still paying attention, even if the rate is now close to 2%, which is good in a way. We can talk about that as well. In Italy, the picture is somewhat different. Their inflation on the way down fell below 2%. People are still paying attention. Now that it kind of approaches 2%, they're kind of switching off. So these kind of non-linearities can again become a problem if they amplify heterogeneity, underlying heterogeneities in inflation expectation formation. Final two things, just very briefly been touched upon already. There is differential transmission of policy decisions into retail rates to mortgages. Colleagues have done some simple error correction estimations of the pass-through into mortgage rates. This is for 1 year, up to 1 year fixation. And the left-hand side, if you see -1, that's full transmission. And so in a lot of countries, it's less than full. Say, I don't know, Ireland famously, the transmission is incomplete, and it also takes a differential amount of time to reach that long run. Again, this need not be bad. There is the heterogeneity in the banking sector at the national level may serve a useful purpose as well. Life is not only about monetary policy. There are other things at play. Where it may be a problem if it reflects underlying weaknesses in the banking sector or indeed in the fiscal situation, and this is what is often being mentioned as a key area of vulnerability for euro area. We're a heterogeneous bunch, and again you could basically say that you have this at national level as well. You have sub-national units, and there is heterogeneity there, and yet we do not worry that much about it. So, and then we can enter the discussion about the institutional framework that makes it possible not to worry about fiscal heterogeneity. There have been some proposals, and maybe we get to that later. Thanks.
Okay. Great, thank you. Mariana.
Thank you very much. I'm coming from a little bit different perspective and angle. I think what unites us is that we all agree on crisis is the new normal, and what does this mean for each and everybody of us concerning our jobs. What's the good message is crisis is the new normal, but so far the Austrian financial system is not part of this crisis, and this is, I think, a good sign that macroprudential, macroprudential, as well as monetary and fiscal policy do their work, so to have a stable environment. But what needs to be clear for us is that monetary and fiscal policy affects then sometimes the financial stability of the sector indirect, and this is where we come in. So what changes the last years is that we have a lot of crises, and these crises are really they really differ on the aspects. We have geopolitical tensions, we have economic shocks, we have structural trends, and then we have the new aspects of dependency on technology, on less sovereignty of the European Union, and being totally dependent, if you only look at Mythos, Anthropic, and AI cybersecurity, on not European developments, where European institutions do not even have access to these instruments that then might create shocks and crises. So this is the new environment we are in. So Austria so far is stable. We're happy about that. The Austrian financial sector has no crisis. It's top tier in the European Union on relating to competitiveness, and of course security and stability is our focus. But this is then a prerequisite for growth and competitiveness, and this is then our common mandate. What I think unites us on that panel as well. But this stability we are proud of is not a stable one because of all these crises, so we need to work on that including maybe non-financial figures concerning, yes, we have capital and liquidity enough, but there are additional aspects we need to take care of. And one of these additional aspects we need to take care of is expectations on the one hand that have an effect in the second round as well, and as well on trust and reputation of the Austrian financial sector, but as well on the European one. And the tricky thing about trust is that you build it up, but you can lose it really fast, and you can build up reputation, and you can lose it really fast. And this reputation then can cost a lot of money, only having in mind the FATF assessment on anti-money laundering and sanction regime in Austria, where we are really happy that we are not grey listed, because this would then have cost potential 76 billion of reputational costs, because it has effects on refinancing and all these matters. So in total, you need to take care of the facts and figures, but then include in the stability perspective as well expectations, trust, and reputation as key elements. And this is not so easy to include then in financial stability aspects. So what are we doing? Of course, we have the macroprudential part that we are looking in on individual institutional level. There, liquidity and risk is one aspect, but of course, there are others, especially on the risk management. And then the supplementary aspect is the macroprudential view, looking at the overall sector and the overall sector development, and then identifying risk as early as possible. The financial institutions do not see that much risk than we do, but this is our perspective we need to take care of. And of course, as early as possible, and if they then develop into systemically risk. So the objective of financial market stability, and this is one of the disadvantages compared to ECB with a clear mandate, okay, inflation 2%, but what is financial stability? You cannot measure it as concrete as inflation target. So financial stability means the system works, but the system works means as well we have exits and entry in the system, but this can then should not danger the overall financial stability. And this is the system works, and it works enabling financing the Austrian and European economy, but as well offers enough products for customers. And not every company should be rescued, but the system as a whole needs to function. And so this stability needs to be created beforehand and not during the crisis. And that what we learned is the transition from crisis reaction to structural structural stability, because pure ad hoc interventions or targeted risk management is not sufficient, and therefore we need the macroprudential supervision, because the ad hoc intervention, this is what we need to avoid and what the market does not like neither. So this national level is then interconnected with everything that is centralized in ECB, especially on the decision making, and whatever happens on this monetary policy can then create stress in the financial markets, because for us the question is not how monetary policy is designed, but what then it triggers within the system, and these triggers can be huge, and there the heterogeneity is coming in, because the reaction within the systems can differ a lot between European countries. Because this change in interest rate, of course, has effects on asset pricing, meaning possibilities of bubbles, meaning speculation might come in, meaning financial conditions concerning cost and availability of credit can have an impact then, of course, on money in circulation, inflation, but the core issue is financial viability and affordability that can then have an overall impact on certain financial stability aspects. So it's not the conducting of the monetary policy, but rather monitoring the effects and the risks that are coming in from these decisions. And these differences can be then really different from country to country on credit loan. And so the fine-tuning of the cycles, this is one of the key aspects within this macroprudential oversize as well, because you always need to have in mind who is surprised with the decisions of the ECB level, who can meet still their commitments and sustainability on these commitments. And then, of course, you have totally different prerequisites in different countries. And this can trigger and amplify then crises. We saw that in Latin America a long time ago when the US increased their interest rates, but we saw this as well in Austria, for example, with the foreign currency loans when the Swiss decided on increasing their interest rates, and a lot of Austrians had loans in Swiss francs, and of course this then triggers certain effects we need to take care of. So this all means that there is actually a paradox situation that on the macroprudential part you look on the long-term effects, but of course financial sector participants are looking more on the profit of the next year, and so they don't like if we introduce buffers that then on their point of view enables less credits they can give out. So there we need to be always careful. What are we doing now in Austria? We have this financial market stability board where FMA is one vote. So we have the finance ministry, the Nationalbank, us, and of course fiscal experts as well. And what we saw in Austria is we do not use anti-cyclical buffers. We prefer systemic buffers combined with sectoral buffers, because this is what we experienced as well. Especially commercial property financing is something that worries us, because there the non-performing loan rates are much higher than in the average of the European Union. Of course, systemic risk buffer, we heard already, Austria is heavily invested in Central and Eastern Europe, and therefore at certain point in time after the financial crisis, of course, we added additional capital requirements, especially towards that region. But now this region is more stable than Austria concerning NPLs at least. So actually this is the growth engine for the Austrian financial sector rather than the risk driver anymore. So you see different buffers, different thoughts on how this monetary and fiscal policy is connected with then macroprudential supervision. And I think, yes, they are not all the same, but I think in general the system works well as long as we coordinate well together.
Great, thank you. Michael, I think we also need your slides. Yes? Mm-hmm. Okay.
Oh, that's the slides. All right, let me start with thanking the organizers very much for having me here on this panel and on this excellent conference. And let me first of all say the following. When you think of a heterogeneous currency area, in particular the euro area, then the first association about heterogeneity is, of course, about heterogeneity along the country dimension. Yeah? But actually the world is heterogeneous in many aspects, and I wanted to show you a slightly different perspective about the heterogeneity and monetary policy in a heterogeneous currency area along the dimension of heterogeneity of households. So households, it's not only that countries differ, it's also that households differ. Households differ in age, in wealth, in labor market status, probably many other things. And as a result, monetary policy might affect them might affect them differently. And that's actually the main point I want to make today, is that monetary policy not only affects households in a different way, but also that, in fact, it is pretty redistributive. Monetary policy is pretty redistributive. Something that central bankers know intuitively, but these days we can try to calculate these things, and they are calculated here. So what I show you in this picture is comes from, by the way, with all possible disclaimers, comes just from a model that I constructed with a colleague of mine, Rodolfo Rigato from the ECB, but shows the consequences of a monetary policy tightening. On the left picture is the super standard part of this. It's the reaction of inflation, the impulse response to inflation. Inflation goes down, returns to baseline after a few years. The model is annual, so that's nothing new here. But the original part, let's call it this way, and the one I want to talk about is on the right one. So that's the reaction of household welfare by deciles of wealth distribution of the household. So on the left-hand side, you have the poorest decile. On the right end, you have the richest guy. And ignore for a moment the bars, just concentrate on this line. The line shows you how, for a particular decile of the wealth distribution, welfare is affected by monetary policy tightening. And you see, when you start from the left, it's not so super surprising. You see negative numbers, okay? Forget about the numbers, just the sign matters here. So welfare is affected negatively. It's monetary contraction, the economic output goes down, consumption goes down, the labor market goes down. So probably not very surprising what's going on here. But if we move to the right, to the richer part of the society, then we see this line starts to go up, go up, go up. And somewhere between decile 7 and 8, actually it moves into positive territory. What does it mean? It means that like 30% the richest 30% of the society, they actually gain from may even gain from a monetary policy tightening. Where does the difference come from? It comes mainly from the sources of income that the poorer and the richer part of the society derives. So the poorer part derives income mainly from the labor market. And as I said, the labor market naturally goes down after a monetary policy tightening. The richer part gets a bigger part of their income from capital. And of course, especially if you hold nominal assets, you gain on a monetary policy tightening. You even gain twice in a sense, because first of all, interest rates go up, and then inflation drops. So in real terms, you gain twice, and that's the reason. What are the consequences for monetary policy? Well, the consequence for monetary policy can be that, for instance, in the face of some shocks, in particular, I will show you in a moment, supply-side shocks, which cost push shocks, which are bad anyway. We don't like rising energy prices. We don't like the consequences. The inflation picks up. Then the economy goes down. It may be that the central bank will face actually a kind of new extra trade-off related to this heterogeneity, which means people are affected anyway badly by the shock. And then the central bank thinks, well, I should do something about inflation. But if I act too strongly about inflation, then I will hurt especially the poorer part of the society even more. And if I didn't make a disclaimer yet, let me do it now. All I show you now has a purely positive aspect, nothing normative about it. So I don't say it's good, it's bad. I will just show you what happened in completely positive terms. So let me give you an example of a very practical application of the maybe somewhat theoretical introduction that I made. This is the example of the post-COVID inflation surge. So after COVID, as you remember, due to several things, inflation started to pick up somewhere in early 2021. Peaked somewhere in mid-2022, as I said, due to many different shocks, in particular supply-side shocks. And on the left picture, you have, just look at this dashed line for a moment. On the left picture, you have how these macroeconomic shocks, forgetting for a moment about monetary policy, affected welfare of households against the wealth distribution on the horizontal axis. And you see that actually even these macroeconomic shocks, they had this strongly redistributive profile. So they affected in particularly badly the poorer part of the society, and actually they might have even been relatively good for the richer because of, for instance, because of increasing profits. So that's exactly the moment when the central banks sees this trade-off. Okay, inflation goes up, but if I squeeze the economy more, I may make the things even worse. What the ECB did, as you remember, it decided to act in a relatively accommodative way. So it, in the way that central banks pretty often react to supply-side shocks, it's at least partly seeing through the shocks. And actually, this can be seen. This monetary policy accommodation does what you have seen on the previous slide, but upside down. So it benefits, it boosts the labor market and benefits especially the wage earners. And now, if you look at the solid line on the left picture, then actually that's the redistribution profile with monetary policy reaction, with the monetary policy reaction accounted for, and you see it's much flatter than the one without the monetary policy accommodation. So in a sense, the central bank, by being relatively accommodative, partly prevented, to a large extent, prevented a large redistribution that would have been caused by the macroeconomic shocks. Why did I say I don't want to say it's good, it's bad, it's purely descriptive? Because there's the other side of the coin, of course. The other side of the coin is on the right picture. That's inflation. The blue line is the inflation rate, inflation that happened. The orange dashed line is the inflation that we would have without the monetary policy accommodations. Of course, the monetary policy accommodation, with not acting very strongly against this inflation increase, makes inflation a little bit, possibly a little bit higher, and that's the cost. And I don't want to take a stance on weighting these costs on the right and the let's call it benefits on the left. I'll just leave it like that. Thank you.
Okay, thank you. Okay, thank you very much. I think we actually got 4 different perspectives on the topic, and I want to give now one round where you can react to each other, but where we can maybe also pick up things that we didn't talk about yet. So I think actually, despite you giving all very different perspectives, some themes were common. So there was a lot of talk about buffers, there was a lot of talk about expectations and surprises. We had a lot of trade-offs, linkages, non-linearities, and also the challenges or benefits of medium-term and long-term orientation of policy in all different dimensions. But I would start again with Christoph. As I said, the chance to react to each other or to talk about fiscal, because you said monetary policy makers always think about fiscal.
Thanks, Wolf. Yeah, very, very interesting perspectives. And maybe just to also react to what Michael said, I can also vividly remember all the work on unit labor costs and educating the Eurogroup at the time in the mid-2000s. And actually, maybe that's an interesting episode, because that was a time when also the Governing Council of the ECB was worried about the divergences we were seeing. We had credit booms in some parts of the euro area. And when those unwound, not necessarily triggered by developments in those countries, but more of the subprime crisis that emerged in the US, but when that spilled over, it exposed a lot of fragilities in the euro area. And that is also one reason why macroprudential policy was strengthened, why the SSM was set up. And basically what we see now in terms, for example, of credit growth is that we haven't seen these big credit booms that we have had in the early years of monetary union. So in that sense, the system has become more stable, and that's thanks to the work of the macroprudential authorities, of microprudential authorities. And I think that's a big plus. It explains why the financial system has been so resilient over recent years. If you think about the COVID shock and everything that happened afterwards, there have really been major episodes of, let's say, worldwide stress where one could have thought that also the euro area financial system would get under much more stress than it actually was. And I think that's partly a reflection of the lessons drawn in the earlier years of EMU. And maybe just on Michal, on the last presentation, in a sense, I talked about that at the beginning. I mean, I wouldn't draw too closely a link to the monetary policy reaction of the ECB in 2021, 22, and this particular aspect of household heterogeneity. What certainly happened in 21, 22, and we've worked on that extensively in the latest strategy review, is that we came out of a period of low inflation that had lasted almost 10 years. So we were at the lower bound, and actually in the initial phase of the inflation surge in 21, 22, it was not yet clear, in a sense, how durable this would be. And so unwinding the policies set in place in the 2010s and into the COVID period, that took some time, and we have assessed that in detail. What we have done also in the strategy a lot is working on channels that matter for whether the medium-term orientation would speak in favor of looking through supply shocks, yes or no. And household heterogeneity is actually one of those factors. So some of the channels you mentioned here echo what we found as well. And then, of course, what you have in practice is that many other factors happen at the same time. And so if we look back at 21, 22, one reason why then the monetary policy reaction in the end was very forceful was that protecting the anchoring of inflation expectations was particularly important. And at the same time, we also saw nonlinearities kicking in. So the frequency of price changes increased, and that is actually then an environment where it's important for monetary policy to react then also with force. And so you have all these factors that come together at the same time. But just to say that this channel that you also emphasized is certainly one that we also looked into, and qualitatively we found the same.
Great, thank you. Yeah, I forgot also to say that the goal would be 3 to 4 minutes. So, Michael.
Okay, we'll try. Yeah, also a reflection on what colleagues have talked about. We talked about different episodes from the recent past, different shocks and crises and whatever. And so if the topic is fiscal, monetary, macroprudential coordination, I think an interesting dimension is its state dependence. A lot depends on what kind of shock you're dealing with, and in different shock environments, the trade-offs that you have to resolve may be more or less difficult. And so the COVID episode, at least its start was we thought about it as a large demand shock, and in that environment, it's especially coming out of a low inflation period, it was. In many ways, coordination was easy. I mean, we had to go loose. That obviously, helped governments fund themselves and deliver the stimulus. That also helps at the same time. Also, low interest rates make funding in the financial sector easier, and so the balance sheets. It's good for the balance sheets and so on. So in that case, it was obviously it's important not to overdo things, but everything seems to go in one direction at the time, and we kind of naturally helping each other, if there are sufficient buffers, obviously. The supply shocks, they tend to be a completely different situation, where we face the need to respond to rising inflation and threats of second round effects and the anchoring of inflation expectations. And it comes at a time when again, governments may feel the need to respond to the crisis through support measures to various groups, but mainly across the board. They may not have the space. From a monetary policy perspective, a lot of those interventions may be counterproductive. Also, in terms of macro-pru, it's a situation where funding costs for banks go up, and if there is, for whatever reason, uneven transmission, it might affect their net income and that might affect their lending behavior. So that may be, again, I mean, in a way, it amplifies the monetary policy message, but maybe not in a way we would exactly want. So and it seems that we are entering a world where, at least so far, we've had quite a few of these supply shocks with the tariffs, with the two rounds of energy shocks, and if you think further ahead, I mean, just the things that we know about, climate events and things like that. So we should get ready for a world where probably we have to think about these trade-offs more and more often.
Okay. Thank you. Mariana, we have to think of the trade-offs more often, and the financial system is much more resilient. You also talked about the buffers and what we learned after the crisis. So yeah, feel free to also react to that or go more into detail, maybe also about what do we need looking forward.
I think what we need looking forward is like keeping the system, making it more even better in coordination. But what was mentioned as well at the panel, but as well at the fireside chat before, I think the independence is one of the key issues as well, because populists are getting more and more votes, so there will be more and more short-term political cycles, and then of course all of us are feeling more pressure on maybe special goals on national level. And I think there to have a robust system where you can really concentrate on consistent long-term stability focus, this is, I think, one of the key issues we all need together really fight for, because this independence and as well this long-term perspective, I think, is in our all interest, because yes, there was no crisis and this enables stability, but it can cost a lot of money, and then this stability can be lost as well really, really soon or really fast. And I think this is one of the key aspects we need to look at. The core challenge, and I think this was mentioned as well on this heterogeneous union, of course, is unified monetary policies meets different realities. And I think one of the examples that was mentioned as well, especially in this low interest rate environment, especially the mortgage loans, were one of the examples where this was a measure nobody liked in Austria, but this was a measure actually that stabilized the system again, and especially where we saw a clear decoupling of real estate prices and income. And so this systemic risk in Austria could have arisen, especially in the real estate market. And you saw in Italy, this enabled strengthening the lending, and in Austria and in Germany, it was exactly the opposite. And so these clear decoupling of the real estate prices and the income, there could have had systemic risk, and I think this was the case in some of the other countries, maybe as well. So this monetary policy can be economically sensitive overall, but creates local risk. I think this we need to take care into account. And yes, we have ESRB with a lot of recommendations, but then the differences in the countries need macroprudential reaction really on the local level. And I think they're local level, but not uncoordinated. And there, from the supervisory point of view, of course, supervisory colleges where we have home and host supervisors, where we really need to work close together, that we do not surprise any home supervisor with actions that then might have impact on their countries as well. This is one additional aspect that was not mentioned so far.
Great. Thank you. Michael, You also talked about the type of shocks and how important it is, and you did the same. Maybe you can go into that a bit, especially talking about the other type of shock, and then also for you the question of what do we need in terms of looking forward.
All right, so yeah, maybe one, maybe two things. Both are actually related to the slides that Michał has shown. One about these memories of inflation. I remember my studies in Germany many years ago and asked my German professors, why are Germans so risk averse to inflation? Why is the Bundesbank such an inflation nutter? And he said, because we had this inflation 50 years ago after World War II, and people remember and people don't like inflation. That is I think that's exactly what you have shown in one of the slides. And this brings me to what you asked about the way forward. For me, a super important question is how many times can you see through a supply shock? You can see through it once, and inflation are quite well anchored. Can you see it through it twice, and inflation still remain anchored? Or the second time you need to be much tougher on inflation. So ultimately, it comes down to the question: what do inflation do, and what do expectations do? And what you have shown is probably not so super positive on this. And then maybe one short, quick question to Michał, what you have shown about ULC development in Slovakia, because I think that's super interesting, because ULC has stayed relatively low for a pretty long time. I always thought that's maybe because you entered at a relatively strong exchange rate, but then started to pick up. And my question would be, do you think this is in spite of the two, because you don't have, of course, your monetary policy instrument, but you have still macropru and you have fiscal policy. So is it in spite of these two instruments being appropriately and countercyclically used, or is it because they have not been used well enough because fiscal policy, for instance, is too expansionary?
Do you want to react to that, David?
Yes, I kind of hinted at it in the slide. I mean, we get this question quite often, and obviously, I mean, we haven't done formal analysis on that, and I don't know if it's always difficult in these when answering this question. You know, what the counterfactual would be in our situation, but you know, if we just look at it from a bottom-up perspective, look at individual policies. I mean, there hasn't been much progress on the structural front in the last 15 years, and when you look at when you look at fiscal, you know, we've never had a significant primary surplus after the financial crisis, and with the latest shocks, it just. I mean, the response is a part of the problem is what I also mentioned, that the fiscal response to some of these shocks has been, well, all of these shocks has been basically towards expansion. It has, there's a kind of a deficit bias there, and we basically tend to respond to everything with sort of untargeted and permanent measures without the funding being there. And a big part of the ULC issue there is wage developments in the public sector. Obviously, you know, if you look at it at micro level, some of them may be justified, but we clearly for a long time we managed to keep the cost element reasonably under control. At the same time, there were underlying productivity developments as well that could justify those increases also in the public sector. Productivity developments increasingly not being there, and rising public sector wages, rising social transfers, pension system, whatever. I mean, that basically also, together with a bad demographic situation, increasing tightness in the labor market, it just leads to this erosion of a key competitive advantage that we used to have in the past. You could say that you could correct it through a national exchange rate, but you know, again, how many times you can correct that? Yeah, exactly. So that's not solving the problem, and the euro has benefits in so many other ways.
Okay, Christoph, I didn't ask you the question of the looking forward, what we would need for a more effective policy making in the euro area. I remember you said something about completion of the EMU, but if you want to add something.
Oh, clearly, I mean, in a sense, I think also in the first session, a lot of the important things were said. No, I mean, in the end, everything that fosters risk sharing in EMU will be helpful. And I think also the managing director mentioned also to deepen our capital markets. Probably there is a need to have a safe asset, which is also a discussion that is difficult, but would probably help a lot to increase the scale of what is possible at the European dimension. And other than that, I think also what Mariana mentioned, now the importance of really having this dialogue between the different areas, which is already established, but probably can be deepened. And also, as you said, now to preserve also the independence of institutions, which maybe is not so much on the threat in Europe, but at the world scale, we can clearly feel the heat is on.
Mariana?
Maybe to add on the forward-looking part, what we need, I think as a supervisor, I cannot leave the panel without saying completion of the banking union. This is one of the key areas we need, because especially this European Joint Deposit Insurance Guarantee Scheme, this is key, because there we cannot underestimate, there are, especially in an environment where you have neo-brokers and neo-banks with their headquarters in really small countries like Revolut that overcomes the GDP by far. So how this then can be transferred in financial stability if such a big player might then get in troubles. And I think this is one of the things where we need, besides of completion of CMU, because this is far away from completion, I think, banking union. There's only one aspect, but this is really controversial. But I think this deposit insurance guarantee scheme, this is one of the key things for real harmonization and real risk sharing then.
Great, we have almost 10 minutes, and I would want to give the floor to the audience, to questions, and I already see a raised hand there. Please quickly introduce yourself and then ask the question.
Thank you so much for this discussion, Jakob Lavrud, Handelsbanken. So the concept of anti-cyclical or counter-cyclical buffers were mentioned. It would be really interesting to understand sort of a little bit how you see sort of the roles they play. It was mentioned a little bit sort of, less role on them compared to sort of systemic buffers. And we have seen sort of different strategies among the regulator or supervisors on how the counter-cyclical buffers are used. For example, Sweden, where I come from, we favor sort of building them up during good times so that you have something to release. But in a lot of other European countries, you have rather kept them rather low. So any perspective on that would be super interesting. Thank you.
I'd say Mariana first, and then whoever wants to come in.
I think we have the same opinion that buffers needs to be built up in good times to be released then in bad times, but we do not see the only instrument in these anti-cyclical buffers, because systemic risk buffers you can lower as well, and sector buffers you can lower as well as soon as you see that there is not that much risk anymore. So for us, these are not two different diverging concepts, but these are just concepts from different angles with the same effects.
Anything to add? Then, next question. Yeah, in the front, second row here.
Thank you. Laurent Clerc from French Central Bank. So I have a question. If I look at the outcome of ICP inflation in the euro area since the inception of the ECB, the outcome is rather good, because it's around 1.7 or 1.8%. So that is fully in line with the ECB mandate. So in that context, is it the case that heterogeneity really matters? Is it really a source of concern? Is it because, as mentioned by Christoph, the ECB strategy is robust enough to account for this adjustment process. So what is your view? And since the issue is also about the coordination, so we all feel that perhaps there are still some progress to be made regarding the coordination among the various policies, but is it really a concern? What should be made to make it more effective? So I'd like to hear your views about that. Thank you.
I'd say we start with Christoph and then whoever.
Yeah. So thanks a lot for the question, Laurent. I mean, you're right. I think my latest figure is that average inflation since 1999 has been around 2.1%, so a bit above. But I would agree with you that if you take a long-term horizon, actually it's very, very remarkably close to target. It has not been in each and every sub-period. And so when you say heterogeneity really a matter, I think we have also there different periods in time. So we had this, if you want, phase in the early years, we talked about that, where you had an underlying credit boom, you had divergencies and vulnerabilities. All of that became exposed in the GFC. And so if we think back at 2011, 2012, the euro area was in deep crisis. And many American economists were saying, we told you so at the start of EMU. And so, of course, I mean, one foundational moment, but not the only one, was Mario Draghi's famous whatever it takes speech, which basically said, we take off the table that the euro is reversible. And that commitment has been a guiding principle. Also, Christine Lagarde has repeated that very often. So I think in that sense, it has contained, if you want, the centrifugal forces that heterogeneity could actually have unleashed if that commitment wasn't there. And I think a lot of what has been done to strengthen EMU, because it's not only about monetary policy, is actually establishing the SSM, reinforcing macroprudential policy and many other aspects that really say we want to make this EMU more stable, more robust, more resilient to shocks. And I think all of that together today puts us in a position where maybe, yes, you could conclude heterogeneity as less of a threat, but I think it's still there in the background, right? And so actually, we have had some stress tests of the system in the last few years, but as also the managing director said, it's always bad to be complacent. So basically, we need to be prepared also that we will undergo maybe again difficult shocks that will test the resilience of the system. But overall, I would agree with you that since over the last 10, 12 years, there has been remarkable resilience, and I think it has to do with the improvement in institutions and the whole architecture. And the message must be go further in that direction, yes.
Yeah, I would like to very much echo that. And I also think that I share the view that when you look back overall, the result is actually pretty remarkable. But it required a lot of work, and it required a lot of effort and magic at times. And the whole system would work better if there were some additional institutional changes. You mentioned the issue of the safe asset in Europe, and also briefly talked about TPI. I really like the wording of taming the centrifugal forces, and but in a way, we have to admit that there again, the ECB substituted for sort of measures that could have been taken elsewhere in a different form, and that would have been the safe asset. So in that case, we would be all a bit less concerned about fiscal divergence or the interaction with of that with the banking sector and ad hoc spillovers to other countries if we had a more robust institutional framework elsewhere. So I agree that work in that dimension is very important, and keeping an eye on various underlying heterogeneities is important going ahead as well, to be on alert. Yeah, thanks.
Yeah, maybe two things. Heterogeneity, in a sense, heterogeneity will always be there. Even if I don't know, even if Greece is like Germany in the sense of institutions, climate, and whatever, the Union will still face lots of heterogeneity along the dimension that I have shown. So how people will always different age, wealth, etc. Along another dimension, which is along the firm dimensions. I mean, there will be small, large firms, export-oriented, non-export-oriented, and so on. So heterogeneity will always be there, and monetary policy will always affect agents differently, even if not countries differently. So that's my point number one. And then point number two, maybe about you ask about coordination of policies, and maybe that's a little bit of my bias as a researcher and academic, but if you say coordination, I immediately start thinking about constructing a model where you have these policymakers and they coordinate together to achieve the best possible outcome, and then I thought that's gonna be a model with like 21 macroprudential policymakers, 21 fiscal policymakers, plus one monetary policy. That's 43 agents, even with the most best computer, most benevolent researcher or planner or whatever you call it, this coordination exercise is completely impossible. So that's my answer.
Okay, the advantage of being the first policy panel is that we can raise a lot of topics and then we have 2 days to discuss them. I saw a lot of other questions. We don't have time anymore because I want to finish on time. Thank you very much for this discussion. And as I said, I think we have enough time to discuss those things in more details in the next 2 days, and especially now also in the break. Which is set for half an hour, if I'm correct. So we meet again in 30 minutes here. Give them a hand of applause.
Okay, so welcome back, everybody. I'm very happy to introduce the first academic session of this conference, which will be on household heterogeneity and its macroeconomic impact. And I'm also very happy that we have 3 highly interesting talks today. So the first one will be given by Nastasia Henry from Aix-Marseille University. To my left, then we have Falk Marcelli from the ECB, and we have Alexandra Stevens from Heinrich Heine University in Düsseldorf. So what we will hear in the next hour is basically the most recent advances and findings in the literature about the topic household heterogeneity and its impact through monetary policy on the economy, and also how it affects this transmission channel. Each paper shows in its own way, in its own setting, how, for example, the age demographics, how the pension system actually impacts this effect, how households are heterogeneous in the sense that they hold different assets, how liquid are these assets, and also in the way what they consume, whether it's necessity goods or luxury goods. So before stealing too much time of the presenters, I would like to introduce the first presentation, which is given by Anastasia. You have 20 minutes, and we'll have 5 minutes for discussions. I will invite you all to ask questions, to engage in the discussion. And the paper is on quantitative easing in a heterogeneous monetary union. So Anastasia, the floor is yours.
Okay, so good morning, everyone. So before starting, I wanted to thank the organizer for organizing this wonderful event with amazing people. So thank you also for have selected my papers. So my name is Natasha Henry, so I'm a 4th-year PhD candidate. So it's quite an honor to be here, since we are only 2 PhD students, it's very nice. So this will be my job market papers. I'm doing the market next year, so I'm doing kind of my promotion today. So this paper is entitled Quantitative Easing in an Heterogeneous Monetary Union. Okay. So I wanted to start the presentation by just asking you to imagine 2 types of households, okay, in 2 different countries in the euro area. So let us think of an household that is in Greece and another in Germany, right? And at that period of time, so the European Central Bank started to implement a monetary policy. Let us think of an expansionary monetary policy. For instance, a large-scale asset purchase, right? So here the natural equation will be, do these two households in two different countries will benefit equally for the monetary policy? So the object of my talk and the object of my paper is to answer to this following question, and by saying no. So why households in different countries will not benefit equally for the same monetary policy? So in the paper, I advanced that the reason lies in the existence of different types of heterogeneity at two different layers. So the first layer is quite known in the macro literature for years now. So this is heterogeneity within country. So you may think of agents that do not have the same access to the financial market. That means that if they do not have the same access to the financial market, they will do not hold the same portfolio. So they will do not make the same choices. And on top of that, what I had in the paper is that we will have a cross-country heterogeneity. So in the paper, cross-country heterogeneity are in debt characteristic of the two countries that I will consider in the paper. So namely, debt to GDP ratio, liquidity of the bonds, and the maturity of the public debt. Okay. Oh, no, I skipped that. Okay. So in the paper, so I have two main exercises. So the first one is just look at projection on European data based on Altavilla database. And on top of that, I have a two-country tank model. So in this model, I have two countries, so core and peripheral country. So for the classification of the country, I follow the GROW in 2020. So you may think at the period of time of the quantitative easing, core country like France, Germany, Belgium, Austria, etc. And regarding the periphery, you may think of Spain, Italy, Greece, etc. So within each country, we will have two types of households. So the first part will be the optimizer, and the second one will be the hand-to-mouth household. So I'm going to go back to this later. And on top of that, what is key in my paper is the introduction of financial friction following Kiyotaki and Moore. So it's kind of resale constraints. So regarding the agent that I have in my model, so the optimizer and the hand-to-mouth household. So the hand-to-mouth, as you may know, they do not have any access to the financial markets, meaning that they do not smooth consumption. So any increase of wages will be translated into an increase of consumption, right? So turning to the optimizer, so it's pretty standard. So they will have a full access to the financial market. So they will have a portfolio that is composed by several assets with different degree of liquidity. So namely short-term bonds, long-term capital, and they will invest. So as I mentioned, the novelty of my paper is the introduction of financial friction, and this financial friction has a resale constraint. So this resale constraint is, the idea is very simple. So among the long-term bonds, there is a share of this bond that is considered as illiquid, meaning that, okay, I am an optimizer, I have this bond into my portfolio, and for any reason, if the yield of this bond declines and I want to reallocate my portfolio, I will not be able to fully reallocate my portfolio because these bonds are considered as illiquid, right? Okay, and this is what I'm going to present you today. So now you will ask me, okay, Nastasia, the story of the liquidity is nice, but how it may impact the transmission of the quantitative easing. So I'm going to be brief on the transmission of the quantitative easing and how the liquidity of the bonds may shape the transmission of the quantitative easing in my model. So in the model, what I do for modeling the quantitative easing, this is just the central bank that decides to increase the purchase of long-term bonds, right? So what will happen is that the price of the bond increase and the long-term yield will decline, okay? So I am an investor, I'm searching for yield, so I want to reallocate my portfolio so toward more attractive assets, okay? And now the liquidity constraint, the role of the liquidity constraint appear here because there is a share in my portfolio of illiquid bond. That means that if I want to sell this bond into the market, I will be constrained, okay? So here, as you can see, by introducing liquidity constraints will drive how much I can do my portfolio reallocation. Okay. So in the paper, I have, regarding the theoretical exercise, I have 3 different scenarios in order to clearly distinguish what are the impacts of these different layers of heterogeneity. So I started in the paper by a benchmark model where I do not have any differences across country and within country. After, in the scenario 2, I started to introduce the first layers of heterogeneity, so namely within country heterogeneity. So in core and in periphery, I will not have the same share of hand-to-mouth household. So these guys that do not have any access to the financial market. Then, in the last scenario, I shut down this in order to introduce the last layer of heterogeneity, so cross-country heterogeneity. So here, core and periphery will be different in the characteristic that I just mentioned you. So different debt structure, so different debt to GDP ratio, different maturity of the debt, short-term versus long-term debt. And then differences regarding the liquidity of the debt. So in core, the long-term bond will be much more liquid than in periphery. Okay, so sorry for the IRF study. I wanted to make things simple, but I will try my best. Okay. So regarding the scenario 2, so in this scenario, I have different share of hand-to-mouth household, just for clarification point. So based on European data, what you have is that in peripheral countries, so Italy, Greece, etc., you will have a share of hand-to-mouth household of 45%, while in core, this is 25%. So a difference of 20 percentage points. And here, as you can see, these differences of 20 percentage points is dramatically important. Because here, as you can see, so following the quantitative easing shock, so we have the same story, okay? So we have an increase of output, investment, capital, etc. But here, as you can see, the amplitudes of the increase are strongly different. So here, as you can see, the periphery will respond more following a quantitative easing shock. So more output, more investment, and more consumption. So now the question is to understand why do we have such differential impacts as soon as we introduce differences across households. So here the mechanism is quite simple. So following the quantitative easing, the wages and the labor supply increase for both types of agents, so for hand-to-mouth and for the optimizer, but the hand-to-mouth household, will respond more following the quantitative easing shock. So that means that they will experience a higher increase of wages and they will just increase their labor supply more. So what do we have? Is that in peripheral country, you have more hand-to-mouth households. So if you try to think of aggregate impacts, the aggregate demand is much more higher in periphery than in core because you have more hand-to-mouth households. So in fine, this is what we observe here. Outputs, investment, and capital just increase more in this type of country. Okay. So here, the key message is that as soon as you introduce different share of hand-to-mouth household, so this will matter a lot for aggregate output. Now, one natural question is to look at what is the impact on inequality when quantitative easing is implemented. So since I have a tank model, so I'm not fully able, to capture income inequality, I follow De Bortoli and Galli by taking the ratio of the two consumption. So here what you can see, sorry if this is not clear, but trust me. So what you have is that in periphery and in core, you will have a compression of income inequality, but this compression is more exacerbated in periphery versus core, because in periphery households, so the hand-to-mouth increase more consumption relative to the optimizer. Okay, this is exactly what I say. Okay. Now, turning to the impact of cross-country heterogeneity. So here, I think this is the most interesting part of the model, because the scenario 2, this is already what you have in the tank literature. This is exactly the same result. Now, here, I just shut down, the fact that in core and periphery, we do not have the same share of hand-to-mouth household, but I had another layers of heterogeneity, that is the debt structure. So here, based on European data, so I calibrate the model as follows. So the debt to GDP ratio is equal to 80% in core and 120% in periphery. So turning to the maturity of the debt, so when you look into the European data, this is what surprised me a lot. It seems that core countries rely more on long-term bonds rather than short-term bonds, meaning that the supply of the short-term bond is very low in core countries. So while in periphery, they tend to rely more on short-term bond rather than long-term bond. And in fine, so I tried to calibrate this bond liquidity. So I didn't have any access to the bid-ask spread. So I use another measure as liquidity. And here, what is important to notice is that in core, long-term bond is much more liquid. But now, what happened as soon as we introduced this? So here, interestingly, as you can see, so we still have, I will say, the same direction following the quantitative easing shock. But here we have the reverse. So as you can see, now this is the core that is experiencing from a larger expansion of the economy compared to the scenario 2. Okay. And when you look at so income inequality, so the consumption ratio, as you can see, we do not have huge difference between countries. So now the challenge is to understand, oh, I do not have the slide. Why do we have this? Okay. So here, I argue in the paper now that this is mainly due to two facts in the debt structure. So this is due to the maturity of the debt and the liquidity of the bond. So remember what happened when the quantitative easing is implemented. So the yield of the bond declined. Okay, so I am an optimizer, so I want to reallocate my portfolio. Okay, the role of liquidity appears here because in core, since we have strong home bias, what happened is that I want to reallocate my portfolio. Okay, I want to sell my long-term bond, my home long-term bond, in order to reshuffle my portfolio. Okay, but what happened is that in core, since the bonds are more liquid, I will be more able to sell my long-term bond into the market, okay? So here the liquidity will drive how much I'm able to reallocate my portfolio, so this is the amplitude. Now the question is to understand in which direction I will reallocate my portfolio. So here I show in the paper that this is mainly due to the maturity of the bond. Because when I sell my long-term bonds, I can either buy short-term bonds, I can just invest or buy capital. Now the challenge is to understand toward which assets. So since in core, the country rely not a lot on short-term bonds, so the supply of these bonds are low, all the optimizers that want to reallocate their portfolio, they will do it toward more capital investment. And this is exactly the reason why you can see here in the IRF that the investment and capital are much more pronounced for core compared to periphery. Okay. I have the time. Yes. Okay. So here, as you can see, by introducing different type of heterogeneity, we still have, I will say, the same direction following regarding the output expansion, capital investments, but depending on the heterogeneity, we do not have the same amplitude. So here, there is two different forces that's just pushing in opposite direction. So on the one hand, within country inequality, so with different share of hand-to-mouth, this is the periphery that will benefit more from the quantitative easing, so experiencing a larger increase of output and a stronger compression of income inequality in the short run, but in the opposite side, so in the other end, so when we introduce cross-country heterogeneity, so with different debt structure, now this is the core that will benefit more from the quantitative easing. And this is mainly due to the fact that the portfolio rebalancing channel will be altering by this. So now, if you think of the European Monetary Union at that period of time, so at the time of the global financial crisis, what happened is that we already had strong divergence between core and peripheral countries. You may think of differences in trade balances, on net foreign asset position, or just regarding the economic growth of these two types of countries. But here, as you can see with the cross-country heterogeneity case, this is the core countries that are benefiting more from the quantitative easing. So in fine, what we can have is that if this is the second force that's acting more, so meaning that the cross-country is the channel that is operating more. In fine, what we can have with the quantitative easing is just increasing the divergence between core and peripheral countries. But now you can tell me, okay, Anastasia, so which effect dominates? To be honest, I'm still working on that. I think it will be depending on the structural parameter of the model. But what the model makes clear is that both types of heterogeneity may have a strong impact on the transmission and the effect of the quantitative easing. So indeed, that means that they should not be ignored when the European Central Bank is implementing and designing the monetary policy in such cases. Okay, so this leads me to some policy implication regarding the monetary policy implemented by the central bank. So, of course, so here the policy implications are straightforward. Having a uniform quantitative easing may lead to asymmetric effects depending on the forces and depending on the channel that's operating. So here, any central bank that is concerned, about differences across country need to internalize this cross-country asymmetry to not just deepen the divergence between countries that already exist. So by targeted and calibrated more measure, that is what has been done recently, and maybe to coordinate with fiscal authorities. Okay. So this leads me to the conclusion of this presentation. To sum up, so in the paper I show that these two types of heterogeneity matter a lot for the transmission and the effect of the monetary policy in the currency union. So the within country heterogeneity amplify both types of effects, so the output reaction and the distribution effects, while the cross-country heterogeneity via the portfolio rebalancing channel just may deepen the divergence that pre-exists between countries. So the next step for me is to incorporate these differences type of imbalances between countries. You may think of imbalances as trade balances. So if you look into the European data, what you have is that before the global financial crisis, so core countries were running a surplus in trade balance, while peripheral were running deficits in trade balance. So it may be interesting to take into account this, the same for the net foreign asset position, to clearly understand what can be the impact of quantitative easing in such cases. And finally, I want to leave you with a last question. According to you, to what extent the central bank should internalize this cross-country heterogeneity when calibrating the monetary policy? So thank you all.
Thank you very much. I would now open the floor for questions, and maybe someone wants to answer the question. Here's the hand up here. Yeah, thanks.
Oh, which one?
Thank you so much for a very interesting presentation, Jakob Lahr from Handelsbanken. So in particular, what you mentioned is sort of, these optimizer households sort of reallocating the portfolios and bonds. So could you maybe set a bit of order of magnitude here, sort of the types of countries you have looked at, how large is sort of household participation in the bond market, and reversely, how large share of their investments is made up on bonds for this to be a significant enough effect? Thank you.
Okay. Okay, so thank you for the question. If I understand well, you told me that maybe it can be interesting to take into account how much household may participate to the bond market. So this is an excellent question. So I didn't have the time to mention it. So in the paper, what I have is that there is a share of the long-term bond that is purchased by the household and another by the central bank, okay? And in fact, what I have in the model is that the share of the bond that is held by the central bank follow an autoregressive process, and the quantitative easing shock, this is just the shock on this, okay? So in the model regarding the calibration, I think I have 30% that is held by the central bank. But maybe I can think of another calibration if you have other data. But of course, depending on how much household will hold long-term bonds, here, because the quantitative easing is a shock on long-term bonds, may be very important for the mechanism and the amplitude. Yeah. Thank you.
Thanks. We have two more questions. The first one here in the second row, and then in the back.
Thank you very much for this presentation. I have two questions. The first is that usually when central bank operates, they do not send liquidity to household directly, but through the banking sector. So that makes a huge difference. And the second question, is that, to my knowledge, when you do repurchase agreement, you take on board risky assets or illiquid assets and you inject cash. So in a way, shouldn't it work the other way around? I mean, you would favor illiquid assets or illiquid countries rather than core countries.
So I'm not sure that I have understand the first question, but related to the second question, so this is one of the limitations of the model. So if you consider the bonds from periphery as risky, maybe this is what you mean, yeah. So I know that regarding the capital key rule, the share of the long-term bond was not the same. But in the paper for simplification, I assume that the share of the long-term bond is exactly the same in core and periphery. But I'm working on that now. And I didn't get your first point, so sorry. But we can discuss later if you want.
Yeah, maybe you take that in a coffee break, and then we have a second, the last question actually. There.
Thank you. Thomas Wurl, WIFO. I wonder whether you have an assumption about the degree of liquidity of investments and capital, and whether this assumption has an impact on the results that you presented today.
Thanks. Okay. So in the paper, I introduced liquidity degree only for long-term bonds. So I do not have any assumption regarding capital investment. So I don't know if I answered your question, but of course, depending on the liquidity degree of both type of asset, of course, it may have strong impact. Because if, for instance, you have low degree of liquidity for capital investment, maybe optimizer will just increase consumption, maybe, or will just move to short-term bonds, depending on the country. But excellent question, I do not have this into the model.
Okay, thanks a lot. We are perfectly on time, so I would suggest we move on to the second speaker. Our second speaker is Falk Marcelli from the European Central Bank, and he will present his work on the battle of the ages, distributional and aggregate effects of monetary policy in a model with age demographics.
Yeah, thanks, Karin, for the introduction and chairing the session. Thanks for the organizers for inviting me. This is joint work with Wouter den Haan at LSE and two ECB co-authors, Alessandro Ferrari and Anouka Restiniemi. Because we're at the ECB, the standard disclaimer applies. These are our views and not necessarily those of the ECB. So first of all, I have to say, this is a fantastic program. Already just the sessions before connect so perfectly to what I'm going to discuss, including Nastasia's work actually in an interesting way. So we're going to start with essentially what IMF Managing Director Georgieva raised, namely demographics are one of the key issues nowadays. People live longer, societies age, and more resources are flowing into pensions. What we're going to be concerned with is how does this affect the monetary transmission mechanism, and in turn, how does monetary policy affect the decisions by savers and all the other cohorts. There's a quote by our previous president, Mario Draghi, on the effectiveness of monetary policy. He said that low rates may become an inducement to save more. And if that is indeed the case, then this might, of course, be a problem because we lower rates in order to stimulate consumption. But if some of the agents are going to flip the sign, then the monetary transmission mechanism is not working really well. So we're going to look at this in the context of a heterogeneous agent model. That literature has become very large. It's mainly concerned with income and wealth heterogeneity. So we're going to look at income and wealth heterogeneity. We're going to be interested in age heterogeneity and the pension system. At business cycle frequency, I should note that there are some prominent studies on this. In fact, Michal Brzoza-Brezina, who was at the previous talk, he actually has some famous work on that. And also, I guess, unlike his results, I'm not going to talk about welfare, I'm just going to talk about consumption. So in a standard textbook framework, we know that lowering interest rates can be decomposed into at least two different channels. One is the substitution effect, which means that if rates decrease, then it becomes more expensive to smooth consumption into the next period, so consumption today is going to increase. That's essentially what we want to drive. But if you are a saver, then there's also the income channel, which means that you're going to have less return on your savings. So this can then decrease your spending on consumption today and tomorrow. Now, there are agents in the economy, namely savers, and often they are middle-aged. They've already accrued a lot of wealth. And our main question, or one of our main questions, is going to be, does the income channel dominate the substitution channel in the case of those agents? We also have young agents. For them, we're going to have a bit of a different perspective. So they are at the beginning of the life cycle. They don't have retirement risk quite yet, but instead they face unemployment risk. So in their case, they don't yet have that many assets. They might even have debt. So for sure here, they actually have the right sign in terms of the income effect as debtors or as small savers. Now, we're going to set up the challenge between these two groups by having one safe asset that exists in fixed supply. And that's what we're going to call the battle of the ages between these groups. What we're then going to be interested in are the heterogeneous effects. I mean, this is what this conference is about. There are also implications for the heterogeneous currency union. And then at the aggregate, we're interested at the aggregate effects of monetary policy as well. Let me give you a brief overview of the model. So it's a new Keynesian model with a quarterly frequency. We have young, middle-aged, and retired agents. Young agents face unemployment risk, and that unemployment risk is cyclical because during booms, they will actually be able to find more employment. And then we have a pay-as-you-go system for pensioners. Then the main questions that we try to answer are, the first one, could middle-aged savers cut consumption after a rate cut? So does the negative income effect dominate? And our answer is clearly no. That's not the case. And we are also going to conduct several laboratory experiments where we really stack the odds in favor of the income effect dominating, and still we will find that that's not the case. Then, secondly, does the pension system matter for the aggregate power of monetary policy? And we find, yes, it does, quite a bit. If we lower the generosity of the pension system, then we find that monetary policy becomes about 50% stronger on the real economy. Then the question is why? And here we have two channels. One is that lower retirement savings or higher generosity means that agents don't have to self-insure against the consumption drop in retirement, which means there's more supply of the safe asset, and younger agents can self-insure better against unemployment. So there's a fundamental market incompleteness that is endogenous to the pension system. And then we have a rate level effect where we see that if there is higher demand for a safe asset, it means that the price is going to rise and the return on it is going to drop. So that's the real rate channel. And we see that that's going to increase consumption sensitivity. I'll show that to you. I'll first spend a couple of minutes on the model. I'll show you some key mechanisms and then the main findings. Maybe also to echo a little bit what my Deputy Director General Christoph Kamps had said. So we're not interested necessarily in what type of heterogeneity is good or bad for the economy, but we need to assess the workings of that heterogeneity. In this case, age heterogeneity and the generosity of the pension system. You could also do it for the unemployment system. So here we have a strictly positive assessment. It's not normative. So again, same disclaimer as Michael. Then for the model overview, so it's deliberately kept simple. We don't want it to be a black box. Several features are missing. What we do have is age dynamics. Young, middle-aged, and retired have a stochastic chance of dying, but in expectations they live for 20 years. Only the young face unemployment risk because, empirically speaking, they have a higher displacement rate. So they have a precautionary savings motive and they'll try to insure against it. The middle-aged have no job risk, but instead they face a consumption drop at retirement. So they're going to try to insure against that. And then the retirees, they, upon retirement, stochastically when they enter retirement, they're going to annuitize all of their wealth. And they're going to draw on an annuity for the rest of their life. And they're also are going to get a pension from the government that is governed by this pension generosity, mu-R, based on the after-tax wages until eternity or until they actually die, at which point newborns are going to take their place. There's one nominal liquid asset in fixed supply, and we're just going to assume this for tractability to keep it simple. And then we have a standard New Keynesian block. There are sticky prices a la Rothenberg. There's a Taylor rule. There's also a representative firm owner that runs production. Then for the solution, we follow the Lagrange-Rago algorithm to implement actually Michael Reiter's approach, who's also sitting here in the audience, who's going to speak tomorrow. I'm not going to spend too much time about this now, but maybe later. For the calibration, we follow the typical euro area, a typical euro area economy. We discipline via some moments that we care about. Pension generosity in the baseline is at 50%. We're going to lower that in an experiment. Unemployment benefits also at 50%. Unemployment is quite high, close to 11%, but unemployed only stay unemployed for less than a year in expectation. So maybe that gets us closer to the current euro area figures. I could imagine that David actually cares about this very much, what the unemployment is right now. Then for our Taylor rule, we have a calibration that follows an estimation, and the validation that we care about is after a year of unemployment, consumption drops by about 15% in the model. That's consistent with microevidence. In terms of our impulse response functions that I'll show you later, they are probably at the upper limit of what we see in empirics, but that's also deliberate because we want to give the mechanisms that we're looking at a fair chance of actually working. So before I jump into the full model, I'll just give you a couple of insights from a three-period overlapping generations model. We have the same young, middle-aged, and retiree populations, but now there's deterministic aging. The young and middle-aged receive an endowment Y, and the middle-aged receive a transfer from the other two groups. In the chart, what you're seeing is the consumption sensitivity based on the generosity of the pension system. And in blue, we have the young workers, and the black dashed line is the middle-aged workers. Both of these are negative, which means that after a rate cut, consumption is going to be positive. And you also see that this is stronger for young agents. Because this is an academic session, I can also show at least a couple of equations. So what you see here are the first-order equations, first-order conditions, and I differentiate them with respect to a change in the interest rate, unexpected, from the point of steady state, our bar. And what we can see here is that there are two effects that govern the consumption sensitivity. A direct effect, which is given by mu-R in both equations. So if we increase the generosity, it means that the magnitude of consumption sensitivity also increases. This is due to the net present value of savings. So if we go further to the right, we should actually see a larger magnitude. However, that's not what we see. There's an indirect effect as well. And that is the higher the generosity is, mu-R, the less middle-aged need to save for retirement themselves. There are more assets available for the young, and it becomes cheaper for them to self-insure, and our bar goes up. And our bar is in the denominator, so what you see is that this is actually the dominant effect in this three-equation, in this overlapping generations model. Some caveats: prices and quantities stay fixed here in the simple model, so these are notional demand responses. And we're going to look at the full model next, but just at comparative statics. So that's the mechanism from another perspective. On the left-hand side, we see asset holdings of the young, employed and unemployed, as well as the middle-aged. That's at the top, the middle-aged, the dash-dotted line. And we see that the more generous the pension system is, the less assets they hold. They still dominate the holdings, and the reason for that is just that they've had a longer time to actually accumulate savings, and they don't have any unemployment risk. But the more generous pensions are then also going to help them not have to accumulate as many assets, and therefore the young, so the two lower lines, employed and unemployed, they can actually self-insure more. On the right-hand side, you then see the impact of this, and we do, in fact, see an increase in the steady-state real rate up on a higher generosity. And in fact, if you look at the vertical bar, going from no state pension to full insurance actually has a difference of 9 percentage points. So this is really large. If you follow the natural rate debate in the euro area, we see variation, but 9 percentage points is at the upper level. Then let me go into the final mechanism now in the full model, but what I'm showing you here is an individual consumption profile. So look at the solid line. That's one single agent that we take who is employed at the beginning of the period. Then there's a consumption drop when they become unemployed. They go back into employment as a young agent, and then they become middle-aged. They have more returns from the safe asset, and then they have the consumption drop once they become pensioners. We compare this for two cases, the baseline case, as well as the dashed line shows you a lower generosity. Now, a lower pension generosity means that there are also less tax payments from the young and the middle-aged who are still working. So what you see is that consumption on average is also higher in the dashed line than in the solid line. But the drop in consumption upon unemployment is actually much larger in the dash case. So this is exactly this type of self-insurance motive that now takes over for the middle-aged in the case of the dashed line, that makes it harder for the young to also self-insure. So they lose more. This connects actually quite well to also something that the IMF managing director said on European debt. It's about debt supply. That's an old literature. Ayagari and McGrattan, who are looking at the bond supply. And this would be relevant for Europe. I'm not going to discuss this today, but we have it in one of the working paper versions. But instead, we're interested in lower bond supply just for the young agents, but this is endogenous to the pension system. So this is how market incompleteness actually is endogenous to fiscal choices. So then let me show a impulse response function. So this is for the baseline case. Just to orient you, the top line are some aggregate numbers. The second line are consumption of the different ages, the different age cohorts. And then the third line is asset holdings. In terms of the aggregate response, it's a standard monetary policy cut. That's what you see here, 25 basis points. Inflation goes up, output goes up, employment goes up, employment by about 0.85%, and that's what we'll compare later on. In terms of the distribution, the second line, we see that the young, especially unemployed, they gain a lot from a rate cut, as expected, as do the employed young. And then we look at the middle-aged, and they also increase. So this is one of the key findings that we have. Now, the majority of the increase comes from the young agents, and that's due to the fact that they do benefit more, and they endogenously, or during a boom, when there's the rate cut, they also find more employment because of the search and matching that we assume. Also, they're more rate sensitive, as I showed you in the first mechanism. And for those agents that are closer to their borrowing constraint, they also have a higher marginal propensity to consume. In terms of the assets, so the final line, we see that the middle-aged, they do not increase their risk-free asset once it once there's a rate cut. So we don't find that they actually want to increase their savings, or they might want to, but they lose the battle against the young agents who want to smooth their newly found income now after this easing. Now, these are just the baseline results. We also conduct a stress test. We still have the same baseline in black on the left-hand side. I zoom in on a couple of variables. Middle-aged are the big savers. They hold 140% of their annual income in savings. The young only 40%. So for them, this negative income effect should really be much larger. The stress test that we conduct here is that we isolate what comes from the interest rate itself. So for that, what we do is to turn off any effect on the wages, this general equilibrium effect that then also benefits the middle-aged. So the after-tax wages stay constant. And even in this case, we see that we have just that we still have a positive consumption reaction in this. So that's the red dashed line. In this case, these are quarters, so only for 12 quarters. So that's about 3 years, and then consumption does become negative. So here, the income effect does take over, but keep in mind, this is really for a partial equilibrium type of exercise, an experiment, and also the consumption drop here is quite mild. Some caveats on that. We look at middle-aged as a group. There's no heterogeneity within them. If we looked at middle-aged that are closer to retirement, we might get some different effects. Also within the middle-aged, of course, there could be different employment histories and other reasons for heterogeneity. We ignore all of that. But in terms of, in our model, really finding a case where consumption for the middle-aged flips, so the concern that Draghi had, that's just for some unreasonable calibrations. For example, if the risk aversion is especially high. So in terms of a punchline for policymakers, it's true that a reduction in the interest rate does take away from the return on safe assets for those that hold them. However, in terms of the monetary transmission mechanism working, we find that there's no serious concern here. Then my last slide is on the pension generosity and the power of monetary policy in general. So in this chart, again, the black line is the baseline, and the dashed line shows a lean pension system, about half as much. So instead of receiving 50% of after-tax wages as a pensioner, they only receive 25%. And what you see here is, I pointed out that under the baseline, employment increases after a rate cut. It increases by 0.85%. Now it increases by 1.3%. So it's about 50% stronger. Now this amplification doesn't come from these incomplete markets because there's more demand for the safe asset alone. We isolate that by having a different experiment where we just decrease the unemployment insurance. It's something that I don't show here, but we go from the 50% in the baseline just to 0, in which case we have the same consumption drop upon unemployment. It's not shown here, but what we then find is that employment goes up, so the power of monetary policy goes up by about the halfway point between the black line and the dashed line. So really, what's driving the power of monetary policy here is the fact that the real rates under a higher pension system are also going to be higher, or vice versa, that under lower pension systems, that's what I'm showing. If pension generosity goes down, the real rate also goes down, consumption sensitivity goes up, and that's what we see here. In terms of robustness, we check several different experiments, including the one where we hold after-tax wages fixed, also aging probabilities and other parameters, and we keep finding these results. So we're sure that the elasticity of the economy to fiscal parameters plays an important role. So essentially, also going back to what I think Governor Martin Kocher said earlier, We do have an uneven transmission. That's something that we would also see if we look at the European Union, where we have exactly the same monetary policy impulse, but because of the different pension systems, already because of that, there's going to be a different impact. So in that sense, it also connects nicely to Nastasia's paper, I think, where QE is not uniform across the euro area, but with a completely different mechanism, and something that also Slovakian Chief Economist Michael Horvath showed earlier, that we had the different impacts on euro area countries. So maybe this mechanism is part of the reason for explaining why that is among other reasons. So then, as a takeaway, we don't see that savers or middle-aged agents reduce their consumption upon a rate cut. And this is robust to a number of adjustments. We find that the generosity of the pension system does influence monetary transmission, and this is via the effect that agents have to self-insure more if they don't have a government pension. So this also connects nicely to what was said earlier about risk sharing in the euro area, that this generally helps to reduce the market incompleteness. We want to keep incentives high, but maybe this goes some way towards that. And yeah, maybe it also echoes a little bit Chief Economist Wolf Reuter's statement earlier that there are some heterogeneities that we want to monitor, and I would argue that the pension system is one of them. There are some natural extensions of this. We can look at more assets. Housing would be very important, as is equity. We could also look at finer age grids. As I mentioned earlier, closer towards retirement, your actions might change. We could estimate this model. We've started to look into that. We can look at different countries, again, similar to what Nastasia has shown you, and also connect the findings here, the non-linear findings that we get here, by connecting them to other interesting, occasionally binding constraints, like the effective lower bound. And I would like to stop here. Thanks a lot.
I'll take the time for one quick question. Yes, please.
Thank you so much for a very interesting presentation. So in particular, you mentioned the self-insurance of the sort of young for unemployment. Could you maybe briefly comment in the sort of economies that this model would be applicable for? Typically, what is the practical mechanism to that insurance? Is it through government? Is it through a worker union? Is it sort of private, or is it that it's your own savings? Thank you.
Yeah, good question. So we keep it very simple on the fiscal side. Both unemployment as well as pension payments are provided by taxes that are raised in the same period. So that's a simplification. In reality, of course, we have a different mix of short-term and long-term bonds that finance the government. We don't look at anything like private self-insurance. Importantly, we don't have something like pension funds or insurance funds, which for some euro area countries actually play a huge role. I'm sure we're actually going to hear more about that later. So we would actually have to provide a little bit more realism if we wanted to also have some clear implications for what should be public and what should be private. It's about risk sharing itself rather than who actually provides it.
Thank you very much. And with that, we would move on to our final speaker. So final speaker is Alexander Stevens from Heinrich Heine University Düsseldorf, and she will present subsistence consumption and inflation heterogeneity, implications for monetary policy transmission in a Henk model. The floor is yours.
Hello, thanks Karen for the introduction, and thanks to the organizers for putting this paper on the program. I'm very happy to be here. So this paper is joint work with Ulrike Nayer and Daniel Stempel, who is also sitting here today in the audience. So in recent years, there has been rising attention to inflation heterogeneity, as highlighted by these newspaper articles, For instance, it says why price rises are worse for some people than others, or newspaper from Germany, who is most affected by inflation. So we see in the data that households with lower income, they experience high inflation rates because they have a higher expenditure share on essential goods like food and housing, and these are the goods whose prices increased more recently. So for inflation heterogeneity to happen, two obvious conditions must be met. First, households must have different consumption baskets, and goods must have differing inflation rates. And building on this, we focus on the transmission of monetary policy. Specifically, we study the impact of different consumption baskets and different inflation rates for monetary policy transmission, and we focus on subsistence consumption, which reflects the basic needs of a household, and it mainly consists of food, housing, energy, as I mentioned now. And we show that subsistence consumption is a main determinant of household consumption patterns. Particularly, we show that low-income households spend 87% of their consumption expenditures to meet their subsistence needs, while the share decreases to 21% for high-income households. And we also show that the price index of subsistence consumption reacts strongest to monetary policy shocks. Then we develop a Hank model that includes these facts. It's a Hank model with subsistence consumption, which then implies different consumption basket, and it translates into different inflation rates after shocks along the income and wealth distribution. And we find a new transmission channel, namely the expenditure revaluation channel, that operates through the relative price of subsistence consumption, and we find that this transmission channel weakens monetary policy transmission. Let me skip the literature. So now on consumption baskets, we use data on the subsistence level of consumption of German single-person households, and the subsistence level is calculated to be 9,000 euros per year. And we consider 3 different consumption baskets and its 12 subcategories. So the subsistence consumption basket, this one consists of the goods and its shares required for a single-person household to meet its subsistence needs. Then the average consumption basket, this one reflects the average consumption patterns across all single-person households. And the high-income consumption basket, these are the consumption patterns of households with a monthly net income above 5,000 euros. And when we look at the composition of these consumption baskets, we see that the subsistence consumption basket consists mainly of essential goods. So it assigns a large weight to, for example, food with almost 20%, and also it assigns a large weight to housing and energy with almost 50%. And we see that the shares are much lower for the consumption baskets of the average household and the consumption basket of the high-income household. Next, we relate these consumption baskets to the income levels, which is this figure here. This shows the share of the subsistence level in overall consumption across different income levels. And we see clearly that the relevance of the subsistence level decreases with income. So low-income households, those with a monthly net income below 900 euros, their subsistence share is 87%. For households with an income of 900 to 1,300, the share decreases to around 70%, and the share is 21% for the high-income households, and on average it's 44%. So we see that the relevance of the subsistence level decreases in income. And this figure here, this is the income distribution, and what we see here is that A large share of the households we consider are allocated at the lower end of the income distribution. So we see that around 1/3 of the households, so 33%, have an income, monthly income below 1,300. So there's a large share of households that allocate a large share of their consumption expenditures to the subsistence level, which highlights the relevance of the subsistence level. In the next step, we construct the price indices of the subsistence consumption basket, the average and the high income consumption basket, and we run local projections to study the impact of monetary policy on the 3 different price indices. And what we see is that all responses are highly significant, denoted by the p-values in parentheses. And we see that after the shock, for instance, unemployment goes down, production goes up, prices goes up. So this is what we would expect after expansionary monetary policy. And we also see that the subsistence price index increases more strongly than the other 2 price indices. So here the subsistence price index increases more than the average consumption basket price index and the high income consumption basket price index. So what we see is that monetary policy increases the relative price of subsistence consumption, which then mainly affects low income households because, as I said, they have a higher subsistence share in their consumption basket. So these were the empirical effects. In the next step, we developed the Henk model to study the impact of these different consumption baskets and inflation rates on monetary policy transmission. As in the standard Henk model, households are first identical, and then after the idiosyncratic shock, they differ in income, wealth, and in their consumption baskets. So they face idiosyncratic labor productivity shocks denoted by eta, which affects their labor income, and at the same time, they face borrowing constraints, so it means that they cannot borrow and they cannot perfectly insure against these labor income shocks. Then we include a multi-good structure into the model. So households consume essential and non-essential goods denoted by C1 and C2. And we capture heterogeneous consumption baskets by adding a subsistence level in the utility function denoted by C star. And this one limits the consumption of essential goods downwards, and then only excess consumption above the subsistence level is relevant for household utility. Then the rest of the model, there's an intermediate good producer that hires labor and it sells output to the retail firm. And there are 2 retail firms. They repackage these intermediate goods and they sell them as essential and non-essential goods, and they face price adjustment costs, and essential good prices are more volatile. This is the main part of the model, the household sector. So households solve this dynamic optimization problem. This is current utility from consumption and labor, and this is the discounted expected value of future utility, and households maximize utility by choosing how much to consume and how much to work. And they also need to consider 2 state variables, namely their own productivity and last period assets. This is the budget constraint. It equates real expenditures to real income, and it consists of real consumption expenditures, which is also denoted by or shown in this equation. It consists of real expenditures on excess consumption, CTI, defined by this one, and real consumption expenditures on subsistence consumption. So households buy C star at a price of P1. This was the price of essential goods, and then this one becomes the relative price of subsistence consumption or the relative price of essential goods. This is savings income, labor income. Households, they receive the same wage rate, but they differ in their productivity, and therefore they differ in their labor income. And taxes and dividends are collected and distributed based on their own productivity. Again, this is the borrowing constraint. They cannot borrow, and therefore they cannot perfectly insure against the productivity shock. Then the consumption index, CTI, this one consists of consumption of non-essential goods, consumption of essential goods minus the subsistence level. So everything above the subsistence level, so excess consumption that is relevant for household utility. And here, again, real consumption expenditures. And here we already see that the subsistence level drives a wedge between consumption expenditures, so CEIT, and utility-relevant excess consumption, so CTI. And we see that the relative price of subsistence consumption, so this one determines the allocation of consumption expenditures to excess consumption and subsistence consumption. But I will come back to this equation when I talk about the results. Now I will jump to the steady-state results. What we see here are the income and wealth Lorentz curves, the model produces in comparison to the data reported for Germany and the euro area represented by the dots. And we see that the model produces a wealth Gini of around 0.77 and an income Gini of around 0.3. So we have quite high wealth inequality and income is more equally distributed. And also in comparison to the dots, we see that the model produces a realistic income and wealth distribution. Now these are the consumption baskets the model produces. On this side, this is the share of essential goods in oral consumption along the wealth distribution. So in addition to the necessary level of essential goods consumption, so the subsistence level, households consume essential goods based on their preferences, and this differs substantially across households and it decreases in wealth. So for low wealth households, the share of essential goods, it's almost 80%, while for high wealth households, the share decreases to around 30 to 30%. And on the other side, this is the subsistence level share in oral consumption. And here it follows a similar pattern. So it decreases in wealth. And so for low wealth households, it's around 70%. And for high wealth households, 20%. And these values are also close to the ones we find for Germany. So in the empirical part, I mentioned that the subsistence level share, it's 87% for the lowest income households and 21% for the highest income households. So the shares are very close to the ones we find for Germany. Next, we conduct a dynamic analysis. So we simulate an explanatory monetary policy shock to study monetary policy transmission. And now we have here 3 different model specifications. So just for clarification, Hank, we refer to a standard Hank model. So one sector, no subsistence level, homogeneous consumption baskets. T as Hank, we refer to 2 sectors, no subsistence level, homogeneous consumption baskets, and the HP Hank, this is the full model I presented here. It's 2 sectors with subsistence level and therefore heterogeneous consumption baskets. And we rely on 3 different model specifications to compare the monetary policy transmission. And what we see here is the output response after the shock. And when we compare the 3 different curves, we see that monetary policy transmission to output is weaker in the full model. So in the HP Hank model, 2 sectors with subsistence level, the green line. And there are 3 reasons why monetary policy transmission is weaker. The first one is due to differences in steady state. So in the full model, the HP Hank model, because of the subsistence level and the borrowing constraints, labor supply is higher, so they cannot borrow, but they need to fulfill the subsistence level, so they need to work more in order to fulfill it. So labor supply is larger and is higher in steady state. And then after the shock, they choose to forego additional consumption opportunities to decrease their working hours. And this lower marginal propensity to consume, especially at the lower end of the wealth distribution, then weakens monetary policy transmission, and it implies lower consumption and lower output. The second reason is the expenditure reevaluation channel I mentioned. This is shown on this slide. So here we see the responses in consumption expenditures. And when we first look at the Hank model and the TS Hank model, so these are the two models with homogeneous consumption baskets. And when we look at these lines, so the red line and the black line, and this was a change in consumption expenditures, and these two are the same as these two, where we look at the output response, which means that the change in consumption expenditures or the change in output or consumption is equal to the change in consumption expenditures. So expenditures are equal to consumption, or the difference is equal. However, when we look at the full model, the HB Hank model, this is not the case. Here we see that the increase in consumption expenditures, so the green line, is larger than the increase in excess consumption, the black line. And this difference, so this wedge, is driven by the fact that the real value of the subsistence consumption increases, which is denoted by this curve here. So the intuition behind it is that after the expansionary monetary policy shock, essential good prices increase more than the average price level because they are more price volatile. Therefore, low-income households, especially low-income households, they need to spend more to fulfill the subsistence level because the real value of the subsistence level increases. This means that the change in consumption expenditures is larger than the change in excess consumption. And this expenditure reevaluation then weakens monetary policy transmission. This effect can also be seen here. So when we look at a model with homogeneous consumption baskets, there's no subsistence level. So this part cancels out. And then after the shock, the increase in consumption expenditures mirrors the increase in excess consumption. But when we have the subsistence level, the relative price of subsistence consumption increases, and then consumption expenditures are larger than excess consumption, and this weakens monetary policy transmission. So now we have two forces that drive these effects. We have differences in steady state and the expenditure reevaluation channel. And what we do in the paper is we conduct further analysis to isolate these two effects. And we show that expenditure reevaluation explains half of the difference in the output and consumption responses between the model with homogeneous consumption baskets and the model with heterogeneous consumption baskets. And this effect is amplified by the fact that households experience different inflation rates, which is shown in this figure. So this shows the initial CPI inflation rate response along the wealth distribution. And as I said, low-income households consume relatively more essential goods, and they also have a higher subsistence share in their consumption basket than high-income households, and therefore low-income households are more affected by the stronger increase in essential good prices, and therefore low-income households experience high inflation rates, which is shown here, which then decreases their purchasing power, especially because these are the households with the highest marginal propensity to consume. In the paper, we also decompose the effects onto direct and indirect effects, and we also find larger indirect effects consistent with the existing Hank literature. So to conclude, we study the impact of different consumption baskets and inflation rates for monetary policy transmission, and thereby we specifically focus on subsistence consumption. Empirically, we find that subsistence consumption is a main determinant of household consumption baskets, and we find using local projection methods that the price index of the subsistence basket reacts strongest to monetary policy shocks. Then we develop a Hank model. It's a two-sector Hank model with subsistence consumption and heterogeneous consumption baskets and inflation rates after shocks. And we find a weaker monetary policy transmission due to the expenditure reevaluation channel that operates with the relative price of subsistence consumption. And we also find that monetary policy is mainly transmitted through low-income and low-wealth households. Thank you.
Thank you very much. I would open the floor for 1 or 2 questions. We have 2 there, 1 here and 1 there.
Thank you for an interesting presentation. So a short question is, you comment on sort of that, these essential goods are more inflation sensitive compared to other goods. Mm-hmm. Could you maybe just comment a little bit on what is it that underlying drives this added sensitivity?
Yeah, so it's Rothenberg price adjustment costs, and as you said, essential good prices are more volatile, and we calibrate 2 parameters such that we can such that the inflation difference is close to the ones we see in the German data, so that the difference between essential and non-essential good prices, or the price volatility, is close to the ones we see in the data.
Yeah, Winfried Königer, University of St. Gallen. I mean, if you go 1 slide back, do I read it correctly that 50% of the people are at the constraint, or more than 50% if I look at the wealth distribution? Mm-hmm. So this is high, right? I mean, so to some extent it would be interesting, so which kind of data do you match to some extent to get at this wealth distribution in the model? And the other thing is maybe in the Henk model, once you anticipate, right, that the inflation rate may react more strongly for the essential goods, to some extent there may be also precautionary motive in order to hold some buffer stock to fight this kind of inflation for the essentials, which then really bite, because if I don't have wealth. And I guess in how you numerically solve the Henk, maybe with the linearization you don't have that in there. Is that possible? I don't know. The question, clarification.
So on your first question, yeah, that's true. We have a high share of households that are credit constrained and hand-to-mouth, but we match the German data. So we look at the quantiles and we match data in Germany. We also see it like in the here in the wealth Lawrence curve that we closely match the data reported for Germany and the euro area. And regarding your second question, I think I guess I need to think about it, but I mean, there's the borrowing constraint, so they cannot borrow in the sense to ensure against the shock, but there's of course precautionary saving, yeah. This answers your question.
Okay, thank you very much. This is the end of this session. We have now the lunch break. We have 1 hour, so we will be back at 2 p.m. For the keynote. Thank you very much.
Ladies and gentlemen, welcome back. I hope you enjoyed interesting encounters and conversations during the lunch break. It is now my great pleasure to welcome Professor Bas Terwijl, member of the Executive Board at the Nationalbank. Bas is Director of Monetary Affairs at the Nationalbank, so at the core business area. And he has a rich career. Before that, you are also Professor of Economics at the University of Amsterdam. And in the past, in various institutions, very important institutions in the Netherlands, you helped to shape policy debates on social economic issues, innovation, and public finance. You are still, as far as I understand, a member of the Social and Economic Council, which sounds very closely, which resembles very much our Sozialpartnerschaft, a very similar model in Holland. Now, the title of your keynote could not be more timely. We heard a little bit already about this aspect in earlier discussions. Title is it just a phase, the monetary policy response to supply shocks? Let me give a few thoughts on this. Economies globally have been hit by serial supply shocks, and many researchers and policymakers regard supply shocks as the new normal also in the coming decades. There are also many voices, including from leading central bankers, including from the ECB, that major central banks were slow in responding to the combined COVID energy price shock in the early 2020s. In recent monetary policy strategy reviews, as we just heard, the insights from this experience were largely taken on board. including the impact of high inflation on price and wage setting, as well as nonlinear behavior of inflation and inflation expectations. As central banks just had finished their strategy reviews roughly a year ago or so, a new energy and supply shock hit, this time emanating from the Middle East conflict. Maybe it's over, we don't know, combined with what has become as chipflation, and this has hit Europe. So everybody, each of you who is trying to buy a laptop right now will have noticed that they are suddenly 20% more expensive because of scarcity of chips, because of AI. Now, Bas will shed light on these issues and what might be practical conclusions from the latest research and practical experience. Bas, over to you.
Thank you very much. Thanks for the kind introduction and thanks for the invitation. It's a great pleasure to be here. I also like the previous session with a lot of young people on the stage, and I will follow up on their impressive research. Talking about young people, let me start with something a bit more personal. I don't know how many of you have children, but I do, 3 of them. And they're 16, 18, and 21. And if there's one thing being a parent, it is letting go again and again. A central banker would say, looking through. It's a bit like sitting on your hands sometimes. You watch, you wait, and you let them figure out things for themselves. You give them trust and you hope for the best. Most of the time, this works. And a few weeks ago, we picked up my 18-year-old son from the airport, and he had just come back from a holiday with friends right after his exams, and he passed, by the way. But as you can probably imagine, it had been, you know, that kind of holiday. It was in Europe, but he still suffered from a jet lag, that kind of holiday. So he looked completely exhausted. Now, I didn't ask too many questions. As a parent, you learn not to. You trust that they're old enough to make sensible choices, most of the time at least. But every now and then you must step in. And that's the tricky part. Knowing when to let go and when to intervene. And to me, that judgment call is one of the hardest things in parenting. And in a way, it's not so different from what central banks do. Because in monetary policy, we face similar questions. Do we look through or do we step in? And today, I'd like to talk about that judgment, about how central banks should respond to supply shocks, and when doing nothing is in fact not an option. As you know, the ECB has a single mandate, which is to maintain price stability. Nevertheless, our strategy also recognizes that achieving this objective over the medium run helps to avoid unnecessary volatility in output and also employment. And this is particularly relevant in the case of short-lived supply shocks, because they push output and inflation in opposite directions. A forceful response to such temporary shocks may only affect inflation after the shock has faded, risking an inflation undershoot, which is a nightmare to central bankers, while adding an unnecessary slowdown in activity. And for this reason, the textbook prescription says that monetary policy should look through small and temporary supply shocks. And there are, however, limits to looking through. And the recent inflation surge in the euro area illustrates that when a shock becomes more persistent and broad-based, when there are indirect effects, a swift pivot of the policy stance may be necessary. And the important question, therefore, is when is looking through no longer appropriate? When do we have to intervene? And in the latest strategy review, the euro system concluded that the appropriate response to a deviation of inflation from its target is context specific. Of course. In this speech, I want to pick up on 3 factors that shape the optimal policy response to supply shocks, and which I think are relevant for our current situation. In particular, I will discuss how the policy response depends on the persistence of the shock, how it feeds into inflation, and whether it is amplified by the state of the economy. So do you recognize that moment when your kids suddenly start to change in ways you're not entirely comfortable with? Take something simple. One day your son is happily building little worlds with Lego, and the next he's completely absorbed with Call of Duty. And you find yourself thinking, what happened to the Lego? At first you shrug, you think, fine, it's just a phase, he'll get bored, but then you notice something. He starts spending more and more time behind that screen. And what seemed like a passing begins to stick. And you catch yourself thinking, well, this is becoming a bit more persistent than I hoped. And in the economy, that's the same. Supply shocks can be persistent. And how should monetary policy react? And I will start with the extreme case, a very persistent or even structural supply shock, demographic change. And Falk already told us something about the heterogeneous effects of this. My world here is much more simple. So let me start. According to the Eurostat's population projections, the EU working age population is expected to decline by about 4 percentage points in the coming decade. And this is because baby boomers gradually retire. Now, my colleagues at the central bank modeled the macroeconomic impact of such a structural supply shock depending on different responses by the central bank, the ECB in this case. And the shock is calibrated to deliver this 4 percentage points decline of the labor force by 2035, so in a period of 10 years. Now, in the model, like the model Falk presented, this leads to a fall in GDP, reflecting lower labor income as well as weaker investment. And inflation initially declines due to an excess capital stock relative to labor, but soon picks up when wages increase. Labor becomes more scarce. And in the baseline scenario, here depicted in blue curves, the central bank follows a standard policy rule. It responds to lower inflation and output by lowering the policy rate. But in the longer term, it increases the policy rate when inflationary pressure starts to mount. This is one response. In the alternative scenario, the central bank decides to look through by leaving rates unchanged. And as you can see from the chart, this comes at the cost of higher inflation and higher inflation volatility, while the benefits in terms of output are small, if they are there. And what's important here is that the demographic shock is structural. Potential output declines. This implies that the contraction in activity is efficient, and consequently monetary policy cannot offset this decline without generating excessive inflation. Now, for monetary policy, this means that the case for looking through to protect output weakens as shocks become more persistent. And of course, this is a ridiculously persistent shock. And in other words, if it's Call of Duty all day, perhaps it's time to switch off the Wi-Fi and move back to the Lego world. But that's not always possible. Because the problem, of course, is that the persistence of a shock is typically unknown beforehand. And the question is then, what information does the central bank have to assess the risk that the shock is not short-lived? If we move to the world of today, then energy prices are very high, and they are very important for the monetary policy decisions we have taken recently. And sometimes there's little we can do. Luckily, in the case of the current energy supply shock, financial markets provide us with an estimate. It's not a very precise estimate. I started as a microeconomist, and this estimate would probably not be the best one to give. I think, Martin, you recognize this. Yeah, we met, I think, 20 years ago when we were both in science, but we both don't know anymore, but our ways have had crossed. But as you can see on this slide, even though oil prices have recently come down in response to the prospect of further negotiations and are expected to decline towards the end of the year, that's the more solid line, the risks around these expectations are clearly tilted to the upside. So the part above the solid line is larger than the part below. And this tells us that scenarios where energy prices stay high for a longer period of time cannot be discounted. And practically, the Euro system deals with this uncertainty by using a number of scenarios. And our most recent projections include a severe and an adverse scenario. They also include a milder scenario, and given the stalemate of this weekend, well, it's very nice to have a milder scenario as well. And these scenarios, together with the Governing Council's data-dependent approach and the readiness to act, serve to make our policy choices robust against uncertainty. But understanding the nature of the shock itself is only part of the story. What ultimately matters for inflation and for monetary policy is how such shocks propagate through the economy. And this is the point of persistence. So suppose your daughter suddenly becomes close friends with someone who's really into the tattoo scene, and she's 15 years old. And of course, nothing wrong with that. Friendships at that age come and go. But if she comes home tomorrow with a beautifully done sleeve, the result is rather permanent. And translated to our world of economics, even temporary shocks, such as energy price shocks, can generate persistent effects. And this depends on how they feed through the production chain. And let me show you how this works. In a recently published analysis, my staff analyzes exactly this. And using the New York Fed's Global Supply Chain Pressure Index, they estimate an unexpected change to this index. And these unexpected changes are plotted in the yellow bar. So there are many unexpected changes here. And if you look at the very last observation, by the end of 2025, you can see a sizable and clearly positive shock. So we do not include the current crisis. It's up until 2025. Now, these are the unexpected shocks. And what is the result of this? The study shows that global supply chain shocks have a positive and persistent effect on core inflation. And that's the left figure here. When we look at the response of the different subcomponents of inflation on the right-hand side, then we find that energy responds more strongly and most strongly. And this reflects the high reliance on euro area energy consumption on imports and global supply chains. I don't have time to look at heterogeneity here, but Alexandra showed us that low-income households are more dependent on energy consumption. So you can imagine that if the effects on energy of these supply shocks are the largest, that these households are most vulnerable. Now, at the other end of the spectrum, we find that prices of services, they respond relatively mildly. So that's the part on the bottom of this graph. Now, importantly, as you can see on the left-hand side, in all cases, the response is hump-shaped, with the peak effect only coming months after the initial shock. And you say, okay, this is a very good message because it's only temporary. But for a central banker, this non-linearity is a pain in the you-know-what. So these results are based on broader supply chain disruptions, and the underlying mechanisms are relevant for energy supply shocks as well. So even in a benign scenario, where energy prices return to normal relatively quickly, their impact on broader inflation may last considerably longer. And policymakers are especially concerned with the lower income households. And this delayed but more persistent response may provide another limit to the extent to which monetary policy alone can safely look through such shocks. And in fact, last week's decision by the Governing Council to raise the key interest rate by 25 basis points was also underpinned by the assessment that higher energy prices are to some extent feeding into broader inflation, and the risk that these spillovers could be higher than expected. Now, I have so far focused on the persistence of shocks and their transmission to inflation, and I will now turn to the third dimension, which is probably the most important one, and that's the the amplification. And again, returning to children from the age of 12, they start to change enormously. And I've seen that happening to my own kids. They move to a new school, their interests begin to change, their bodies change, so do their brains. And it's a period full of uncertainty. They're still figuring out who they are and where they belong, and that can bring quite a bit of stress. And now imagine something dramatic happens during that already vulnerable period in life. That stress can deepen, turning into anxiety or even depression. And these are conditions that can have long-lasting effects. And that's exactly why young people were hit particularly hard during the COVID pandemic. It wasn't just the shock itself, but when it hit. And just as with stress or anxiety, when inflation is already high, the impact of supply shocks can be significantly stronger. And one key reason is that pricing behavior changes in such environments. When inflation is low and stable, firms typically don't adjust their prices very often. And that's what you see here. When inflation is low, price changes are not occurring that often. In contrast, when inflation rises, that's the gray shaded area, when inflation rises, firms adjust their prices much more often. And the magnitude of the shock plays an important role in this context. While a small shock might be absorbed by profits and wages and passed on gradually, larger shocks are more likely to trigger immediate and widespread price adjustments. And this is consistent with the evidence from the euro area. Eurosystem research documents substantial shifts in the frequency and nature of price adjustments in the euro area during the inflation surge of 2021 and 2023. That's what you see in these two pictures. I also show you what happened to food and other goods. And there you see that food prices again respond much more dramatically to this inflation peak than other goods and services. Now, what does this mean? You might know that the frequency of price adjustments plays an important role in modern macroeconomic models. And usually, however, it's treated as constant over time. And together with our colleagues from the Nationalbank of Austria, we have embedded this state-dependent pricing into a neo-Keynesian model, a very standard new Keynesian model, and estimate the model on data until the fourth quarter of 2024, so not incorporating the current crisis. And the results, which you can see on my slide, show that for a given supply shock, the effects on inflation and output are much higher when inflation is already high. In other words, non-linearities in price setting amplify the initial shock. And even though this is a stylized example, the message for policymakers is that linear models that we often use may underestimate the amplification of such supply-side shocks. And this is relevant in the current situation as well, where inflation has only recently declined from elevated levels. Now, these non-linearities in the price setting are a bone and a bane for monetary policy. On the one hand, a higher frequency of price adjustments implies faster pass-through from higher input cost onto consumer prices. And this leads inflation to accelerate much more rapidly. That's something we do not want. On the other hand, more flexible prices, as you know, also leads to a steepening of the Phillips curve. And that's good news, because this implies a lower sacrifice ratio. And as you can see on this slide, it makes it less costly in terms of output to reduce inflation or to step in. In other words, the risk of an acceleration of inflation are higher, but the tools to push back this threat are much more powerful. So non-linearities really matter, and it's really interesting that the Central Bank of the Netherlands and Austria have performed an analysis on these models. Now, I'm approaching the end of my remarks, and I've tried to argue that central banks are sometimes a bit like parents. When supply shocks hit, we have to make that judgment call. Is it just a phase, or is it something more worrying? And do we have to step in? Today, I discussed 3 factors that shape and also limit the extent to which central banks can look through supply shocks. The persistence of the shock itself, the extent to which it feeds into broader inflation dynamics, and the risk that these effects become amplified in a state-dependent manner. Now, what does that mean for policy in the current situation? As you know, last week, the Governing Council decided to raise the 3 key ECB interest rates by 25 basis points. And this decision reflects the assessment that upside risks to medium-term inflation have increased. And specifically, incoming information suggests that the recent energy shock may prove more persistent than previously expected, and that its effects are increasingly feeding through to broader inflation. And compared with our March analysis, energy prices, and oil prices in particular, have been revised upwards across the projection horizon. This implies that energy-related pressures are likely to remain present for longer. At the same time, core inflation has also been revised upwards, and it's expected to continue increasing gradually over the coming quarters. Its peak is only expected for early next year, according to the latest information. Finally, also the recent past matters. Research shows that lived experiences of inflation can have lasting effects on how people form expectations, and how the pass-through to inflation is higher when inflation is already elevated or elevated in the heads of consumers. And taken together, these developments underpinned the case for a measured adjustment of the monetary policy stance. At the same time, the Governing Council remains data-dependent and stands ready to adjust the policy rate to deliver 2% inflation over the medium term. And with that, let me wrap up. But let me reassure you, I wouldn't want to leave you with the impression that the ECB's Governing Council resembles a kind of parenting support group for worried moms and dads. There are, of course, some important differences between central bankers and parents, if only because children generally do not listen to speeches. At least my kids certainly don't. So all the more reason for me to appreciate the fact that you have stayed with me. So thank you very much for your attention.
Thank you very much, Bas, for this very clear and useful overview and for the valuable parenting and monetary policy advice. I think many of us can take this very well. So, Bas is open for 1 or 2 questions. I think we have time still. Yes, please.
Thank you for a very interesting talk. So my name is Jakob Blauer from Handelsbanken. So maybe sometimes you say that, for things to be really serious when we talk about inflation, you have to trigger on this sort of wage spiral. So could you maybe talk a little bit about that sort of element? So, you get sort of a shock. What does it really take for it to get into the sort of the wage side of the equation?
So there are 3 things which are important if you look at supply shocks. First, it's the shock itself. What's the nature of the shock? Then, if the shock is there for a longer period of time, we start to see indirect effects. For example, food prices to rise. And when the shock becomes more intense or lasts longer, then so-called second round effects come into play. And these second round effects are due to higher wage demands, for example, from unions. We do not see that in the data right now. So let me be clear about that.
I see no more question. I will ask one question myself, if I may. Now, you distinguish between persistent structural long-term shocks and short-term supply shocks. To what extent can the persistence of supply shocks become endogenous to the response of monetary policy?
Yeah, I think that's what worries us most. I think when we observe indirect effects, for example, higher food prices, and some people already talk about higher prices for fertilizers because of the conflict in the Middle East. And if that leads to higher food prices, then we face indirect effects which feed into the economy. And the most worrying thing, and that's what we saw with the war in Ukraine, is that we face second round effects. So then you get a spiral of higher wage demands, which lead to higher inflation, and again, higher wage demands. And that's something we do not want. And there, the prescription for monetary policymakers is to raise the interest rate and not be too late in the cycle.
So you want to signal firmness in order not to let expectations get out of hand.
Yeah, and that's a very thin line. So when are you too firm? It's like parenting. When do you step in and when do you let go?
Yes, Martin, please.
Thank you, Bas, for a very interesting keynote. You mentioned state dependence, and clearly this is an issue, these non-linearities, when we have whatever a strong demand or not so strong demand, that matters, of course. So state dependence matters. In terms of memory, it might go in both directions, at least a priori. It might lead to a quicker propagation of the shock in terms of the prices and second round effects. It might also lead to being more cautious. The wage demands could be subdued. It could be that firms are not willing to raise prices immediately. So I'm not so sure what of these 2 options or 2 stories is the one that I should believe in, and it perhaps also depends on the memory. So how far back is it? How strong was it? And other state-dependent variables. So I'm not sure that you can say anything on that two conclusions from memory effects.
Yeah. So let me refer to the data for the Netherlands. So we did this projection. When the ECB does a projection, we also do this for the Dutch economy. And what we saw is that consumer confidence really plummeted. And it is at levels which we also saw in 2022. So consumers are very worried. At the same time, we did a survey in which we asked them about inflation expectations. And what we see there is that they are about 3 percentage points above what the market of professionals expects. So in that sense, there seems to be some scarring. But of course, you're right, because people could also imagine that, well, inflation went up a couple of years ago, but it also came down very rapidly. And maybe this leads to unions to be a bit more cautious in terms of wage demands. And another difference is, I think, that the economy at that time was, that there was a very high demand because we came from the COVID crisis. And now the economy is a bit more is going down, is maybe too strong, but there is a mild cooling of economic demand.
Thank you very much. I think we have used up our time. I therefore refrain from summarizing what you said. You explained it so clearly anyway. Thank you, Bas, for being with us and for your insights, and also to the questions from the audience, I think, which were very useful. And with this, I would like to lead over to the panel and first give a hand to Bas. Thank you so much. So may I ask the panelists to come here, please? I think I'm sitting wrong. Yes, good. Okay. So the title of Policy Panel 2 is Labor Markets, Wage Setting and Employment Stability. At a first glance, Euro area labor markets appear remarkably successful. So what are we talking about at this panel? Everything is fine. Employment is high, unemployment is low, nominal wages reacted moderately in most countries, not in Austria, to the post-COVID and energy price shock in the early 2020s. And more recently, real wages have somehow recovered again, the losses that they have made during the inflation surge. Yet, presentations in this panel now, in this session now, will suggest a more nuanced picture. Behind the aggregate Euro area numbers lie important divergences across countries. I think we saw a chart before which was somehow, it gave a favorable picture, but I noticed that the retreat in convergence that Michael showed before was just because of Greece. And all the other countries actually did not converge. So I think we will get into much more detail here on cross-country differences, sectors and firms differences. Moreover, labor market resilience may have come at the cost of weaker productivity growth. We will also touch upon this. And what is more, aging and AI will likely create major additional challenges going forward and could create new sources and forms of divergence in the years ahead. Now, to shed more light on these developments and about suitable policy responses, we have 4 excellent experts with us today from the policy, academic, and private sector communities. Let me proceed in alphabetical order in my introduction. Sylvain Brouillet is Chief Economist Europe at Standard & Poor's Global. David Sondermann is Deputy Head of Division, Supply Side, Labor and Surveillance Division of the ECB. Eliana Viviano is Head of Labor Market Division of the Banca d'Italia. And Andrea Weber is Professor of Economics at Central European University. So I suggest we proceed not in alphabetical order, but I try to structure the presentations in a way that we go from the broader trends to the more detailed aspects. And against this background, I would invite first to speak to Eliana to start out. Eliana will set the scene with an overview of stylized facts regarding Euro area labor market developments and will also give us some thoughts of what the recent new energy and supply chain shock may imply for labor market developments and policy responses. Eliana, over to you.
Okay, so thank you. Let me start just with the broader context of the euro area labor market and wages in particular. This is the topic that I follow at Bank of Italy since 20 years, so I'm very happy to be here and thank you for the invitation. Of course, the usual disclaimers apply in this case. Well, the labor market in the euro area, I think that if the previous decade, the one that started with the sovereign debt crisis, can be defined as the decade of great moderation, great wage moderation. Sometimes we talked about subdued wage growth. Then this decade is turning into a decade of large shocks, but also unusually weak real wage dynamics, right? And we all know that the sequence of shocks since 2020 has been very, very peculiar, and they were extremely large. But I believe that they also changed substantially the way in which we were used to think about the euro area labor market, because employment proved to be extremely resilient, also because of strong policy actions in this direction, but also because we discovered that wages were not so reactive at the end of the day. For sure, nominal wages are downward rigid, but real wages were not. This is a standard. We all know this, this picture here. I have plotted energy prices, HICP, and negotiated wages normalized to the level that they had in 2021 Q2. And we all know that the energy shock propagated very quickly in our economy, that prices increased considerably, while negotiated wages reacted much more slowly. So that after 3 years and 3 years and a half, only now we can say that real wages have recovered, as Ernst mentioned before. Oh, sorry. Okay. Can you hear me? Okay. So, of course, this was good for monetary policy, because nominal wages started increasing when energy prices were already decelerating or declining, and this reduced the pressures on firm total costs, but it had also several consequences, especially on real wages. In the left-hand side, I report the evolution of real wages in the euro area countries, the gray line, whereas the red one is the average euro area. And in levels, the left-hand side, we can see what I mentioned before, that is that on average they declined, and then they returned to their pre-pandemic level just in 2026 Q1. But I believe that there is also a lot of heterogeneities, with some small countries having registered an increase in real wages, especially Eastern Europe countries, Ireland, and so on. So there is a lot of heterogeneity in real wage dynamics in this moment in the euro area, but there is another factor that typically we do not consider. In the right-hand panel, I plot the difference of real wage growth, that is the change of wages with respect to their pre-pandemic trend, the 20 years previous pre-pandemic trend. And what we see there, I would like to outline two main facts. The first one is that we, in the euro area, we are still below trend, and that heterogeneity is much less pronounced than we consider wages in level. This implies that there are households, the majority of households in the euro area have seen a worsening in their income growth prospects. And this matters for macroeconomics. So even if the level, again, has turned to its pre-pandemic level, the trend has not. And it produces, at the end of the day, a rather persistent slowdown in expected growth rates. And it's a source of another source of persistence that I believe is relevant, especially when we talk about scars and when we talk about what could be the possible effects of a crisis. But this kind of demand-side hysteresis is not the only source that we have about. You don't need it. You have the market. Okay, so thank you. It is not the only potential source of hysteresis that we have here, because we also have a supply-side potential hysteresis that depends upon the fact that with real wages going down, then firms in the euro area find it convenient to substitute intermediate input energy with labor. The left-hand side graph plot investments per hour work. Again, the red line is the average euro area. It refers only to machinery and equipments. And again, what we can see is that the difference in trend is negative. With respect to trend is negative, and it is not so distant from the drop that we have during the sovereign debt crisis. And if we look at net capital stock, total capital stock, estimated only for the 4 major euro area countries, again, in difference with respect to their trends, we are far below. We are also far below from zero. Again, also this can create persistence, especially in productivity. Here again, the distance with respect to the long-term pre-COVID trend. And again, here we are in a situation in which we are below trend in the euro area and in most part of the euro area. And so I believe that this is another additional potential source of hysteresis determined by the supply side, determined by the fact that employment in the euro area is heavily protected. And when large shocks occur, then employment, there are several instruments to protect employment. I'm not saying that they are bad, but of course, employment protection has a cost, and in this case, with very low real wage dynamics, this implies labor hoarding and affect negatively productivity. I'm going to end my presentation just by reporting the macroeconomic projections that have been discussed a few minutes ago by our keynote speaker, just to recall what are the macro projections published last week. And in the baseline scenario for 2026, we all know that we are around 3% inflation. With all the uncertainty that is surrounding energy price dynamics in the coming months. But yesterday, we have also published the wage tracker that signaled a 2.6% increase in 2026 for nominal wages, and again, a drop in real wages. And so the wages are expected to drop, and their recovery with respect to their trend is further delayed. So I believe that we have a lot of policy challenges ahead, because employment resilience has been achieved partly through labor hoarding, but it has impacted on capital-labor ratio, capital deepening, that may stay below trend for longer, affecting productivity growth and then also wage growth. So I really believe that there are risks that a cyclical response at the end of the day becomes a supply-side scar. And moreover, I really believe that it's extremely difficult to find a unique instrument to try to solve this situation, especially because of the very high heterogeneity that we have seen in our countries. And then there is AI. I think that some of the colleagues here will mention this topic. AI could become a force of convergence if countries with low productivity growth decide to adopt more intensively AI. But in my view, it's not so clear to me why firms facing very convenient labor costs could decide to invest in AI at the end of the day. So there is also the risk that AI becomes an additional source of divergence. Here I'm going to stop. Sorry for the mic, and thank you.
Thank you, Eliana. Let's now turn to David. David will zoom in a bit on how tight the European labor market is, how the link or the lack thereof between employment and economic growth can be explained, and how aging and AI what aging and AI might imply for European labor markets.
Good. Thanks a lot, and thanks so much for the invitation. A perfectly organized conference with a lot of insights already. Thanks a lot. It's a pleasure to be here. I'll remain seated. It's a bit more comfortable, so I hope that's okay. So I think at the beginning I already summarized so well what I will say in this key message slide, so I'll be very short on that. I think the key message that I want to deliver today is that the labor market, especially at the current juncture, requires to look beyond the traditional key metrics to understand the developments that we had and that we will have going ahead. And this is especially the case because we have an unemployment rate that signals, as I said, very, very tight labor market and an employment growth that is relatively strong. So I'll try to make 4 points rather quickly. One is that the unemployment rate needs to be complemented by quite a lot of many complementary indicators to understand where we are in the labor market. That employment growth, as resilient as it might seem, was driven by a lot of temporary factors that at least partly are likely to fade going forward. And then connecting very much also to what Bas said in the keynote, that when we look at those headline indicators, and we're used to the fact that usually on a year-to-year basis, it's when they change, we think it's cyclical developments, that we see more and more structural trends driving those indicators as well. So we need to dissect this very carefully. And of course, also understand what kind of heterogeneity are there and whether those stories in the labor market are different. And I close with some remarks on monetary policy and structural policies, picking up on what colleagues said earlier. So on the left-hand side in this chart, you see two things. You see an unemployment rate. Arguably, the scale is not perfect because I want to also show the convergence across countries with a gray scale. But the unemployment rate has been declining significantly over the last number of years and has reached basically historical lows, close to historical lows. And as I just said, a significant convergence among member states' unemployment rate. So that hides actually two important things. One is where we stand currently in the labor market. And there you see on the right-hand side sort of set of indicators that suggest that the labor market compared to the unemployment rate would suggest have cooled significantly. And especially the labor demand is something which we realize, especially in the current context, is something that has deteriorated quite a bit. So vacancy rates declined, vacancy to unemployment rates, unemployment expectation of firms, labor shortages as perceived by firms, without passing through the unemployment rate. So firms basically stopped hiring without laying off people. Then we have the whole dimension that is more on the right-hand side, that is the supply dimension, where in an environment of less labor demand, we've seen a significant increase in labor supply. So participation rates increased with inward migration. And these are, of course, all factors that have made the labor market comparatively less resilient. But there's a second point, of course, and I come to that in a second, on the unemployment rate, that it hides to some extent structural drivers at play. When you move from the unemployment rate to the employment growth, it is a similar, although slightly different picture. We've seen in the last 3-4 years that the employment rate has been remarkably strong, although declining, but remarkably strong given the GDP deceleration that we've seen. And what we found at the central bank, having looked at this in more detail, were that there were a couple of temporary factors at play that explain this. And one of the factors Ilyana already mentioned, and that was a very important one, that the real wages declined very significantly while productivity, although not high, remained relatively insulated, so that for firms, it was an incentive to hire labor. It was relatively cheaper. And at the same time, even more importantly, profits of firms were significantly stronger, significantly higher, and therefore, of course, giving more room for firms to hire additional labor. And then on top, we had an environment where we had a significant inflow of migration, additional supply coming in, and therefore helping to map an additional labor demand that we've heard, also I think Bas mentioned, during COVID was basically an environment of very strong pent-up demand, strong labor demand, and it helped to solve that situation, let's say. But many of those factors are less prevalent now. Real wages have increased, and I see the point of here and there being gaps, but if you especially compare productivity growth, this gap is not as large as it has been in 22. The profits of firms are definitely not as big as they have been. So the whole situation is significantly different. Also, labor supply be not as strong anymore as before. So when we now see a deceleration as GDP grows, we should not expect that employment will react as strongly and be as resilient as before, most likely. The second point on the right-hand side is that if we look at GDP contributions, we see that growth, economic growth, has been to a significant part a labor market story. Productivity was relatively muted. Ilyana also mentioned it. But the labor market has driven this GDP growth. In some countries, it was an increase in population and of employment rates of both the national and the foreign workers. So Spain is a good example, to some extent also France and Italy. In other countries like Germany, it was more of a different view. We had the national population already shrinking quite significantly, negatively adding to GDP growth. Incidentally, the Bundesbank today released a special monthly report on that, so I invite you to read that. Whereas immigration helped to counter that effect and basically increased growth, right? So here the questions, and now we come to the more structural factors, are those factors likely to stay? Are participation rates going to stay as high? Can migration be sustained? And I guess there are some question marks to that for sure going forward. Now moving to the structural factors, when we look at an aging society, on the left-hand side we see that there are very different behaviors of the older worker than the younger or the prime-aged worker. If we see that older workers tend to be relatively long in a job. They have a high tenure staying in a job. They are not moving jobs anymore so often as the young or prime-aged. And of course, also because of the social security system in Europe, they are more insulated to layoffs. So the unemployment rate of older workers is significantly lower. And this is something that we have seen in the last couple of years, effectively moving the unemployment rate. These compositional effects are responsible for, let's say, a 0.1, 0.2 decline at least of the unemployment rate in the euro area. So it's important when we monitor those factors to see what extent is the cyclical and structural. The part of this effect is already structural. And we see on the right-hand side, and Bas mentioned this already, that obviously this is a trend that will go on and quite differently so across countries. So this is the old age dependency now and 25 years from now. Another structural trend that I think is less clear than the aging is the artificial intelligence. And here what we have done at the ECB, we've surveyed firms about the use and investment in AI, and we find quite some heterogeneity across countries at the very beginning now of AI, right? So both firms across the euro area are investing to a different extent, and they're also using it to a different extent. And on the right-hand side, you see that they also do this for different reasons. So they were asked, why do you invest in AI? And some of the firms, these are the ones with higher blue bars, I said, I want to save labor costs. And then on the yellow bars, these are more the firms that say, I want to use it to grow, to innovate. So these are, the yellow bars are, if you want, the labor augmenting firms, and the blue bars are the ones that will substitute labor, right? And this is also, although on average, firms increased employment that use AI and invest in AI. Obviously, we are in a process of building AI into the production system of firms. There is quite some difference. And my main point here is that depending on how you use AI, there is a likelihood that, of course, these structural trends will impact economies a bit differently. A last very short point on monetary policy versus structural policy. On monetary policy, I think I can be super short because both Governor Kocher but also Christoph was very clear on what's the role of monetary policy. I just cite here again what we said in the 25 strategy review, and that is namely that we should monitor as part of economic analysis those structural trends and heterogeneities. And there are various ways we do this. Also, again, here, I think Governor Kochner mentioned the GEM network. We had another task force where we published a report, and various models that we also have seen today embody this heterogeneity and sectoral details to monitor that. But of course, the key point, I guess, is that when you look at different outcomes of labor markets, if you look at different heterogeneities of labor markets, it's mainly national structural policies that can impact that, maybe helped here and there by the European level. And I close here. Thanks.
Thank you very much, David. Let's now turn to Sylvain to shed some more light on divergence among Euro area countries and EU countries, including the development of unit labor costs and productivity, the link between nominal wages and employment, and the nexus between AI wages and unemployment going forward. Sylvain, over to you.
Thanks, Ernest. So maybe just to start with, I don't feel like an expert on labor markets sitting next to my distinguished panelists. But let me give a couple of thoughts we have at S&P. So first of all, maybe starting with a remark on the reasons given to explain the resilience of the European labor market. It's structural, definitively. It's linked to demographic. It's linked to labor hoarding. These factors might be fading quickly now, but this is also, the resilience is also linked to structural reforms of the labor market that have been taken in some countries, and I think especially of Spain. These reforms were financed by the Next Generation EU plan. So sometimes Europe works, just to underscore this, this point. And another factor, which we will discuss probably later, but another factor of resilience of the European labor market is the digital transition. Forget about what's in the newspapers about the link between AI and unemployment. Out of the 8 to 9 million of jobs created across the European Union since in the past 6 years, and despite these supply shocks, almost 2 million have been created within the ICT sector, the tech sector, both manufacturing and services. So that's important. Europe is not that bad on the tech also. But let me do 3 points on the what you asked me to prepare. So first of all, my 3 points are: there is a growing heterogeneity in terms of unit labor cost across Europe, and this is not good. This is not good for the real convergence of the European Union, and this is also not good because we cannot, in some countries where the unit labor costs are growing quickly, we cannot use the full advantage of the European Union compared to China or to the US because of this heterogeneity. And 3, to come back to the question of the adoption of European companies of AI technologies. It's ongoing, but the way it's ongoing, AI adoption may be more a factor of further heterogeneity rather than a factor of convergence within Europe. So let me just develop this point. So first of all, heterogeneity in unit labor cost is growing. I think it's obvious on the chart. It's not the divergence, it's not the, if I may say, the Trichet-like divergence. It's not coming from southern European countries. The divergence is definitively coming from Eastern European countries. It's not related to productivity, as you can see by comparison of the two charts between the nominal unit labor cost and labor productivity. It's really a question of wage setting. But these wage settings in Eastern European countries should also be considered not only under the framework of the wage settings framework in these countries. It has also something to do with inflation, which was higher in these countries under the different shock we have had in Europe in the past couple of years. And inflation was higher, especially the energy component, because there was no fiscal shield. So this is not only the divergence is not only due to the labor market structures in Eastern European countries. There is one exception to this pattern. This is Ireland. The reason why Ireland is departing from the trend in terms of unit labor cost comes from productivity, not from wage setting. No wonder, this is Ireland, after all. And this has to do with the rapid transformation, digital transformation of the Irish economy. Maybe one point of comparison with the US, I mean, the dispersion of unit labor costs in the US, the cycle in unit labor costs is not the same as in Europe. It has indeed wages in the US have increased strongly, especially on COVID, because of a different policy approach of COVID there. But it has only led to a transitory increase in unit labor cost. Different thing in Europe. And the reason why is that since COVID, in the US, the strong rise in unit labor cost has been offset by productivity repair. Very strong productivity repair, by the way. Second point, divergence in unit labor cost is not good for an economy, definitely not. I think the chart is clear. The scatter is quite tight, so the form is clear. There is a trend in the Eurozone, in the European Union between job creation and unit labor cost. In countries where unit labor costs have increased the less, over the past 6 years, job creation has been stronger, and conversely. And this is an important factor, as mentioned, especially so not only for the lack of convergence of the member states, real convergence, but also this is not good in terms of competitiveness vis-à-vis the US or vis-à-vis China. Look, for instance, at well, I just see we don't see the point here on the chart, but I would take the example of Ireland versus Poland. Two countries that are quite good in the global race of the tech race, attracting a lot of computer engineers on their territory. But Poland is attractive because the level of wage is relatively lower than elsewhere. But Poland is limited, especially compared to Ireland, another territory attracting a lot of computer engineers in Europe. Poland is limited because of this very strong rise in unit labor costs. So this dynamics we cannot take full advantage of the territory of the European Union. We cannot take full advantage of regions where labor costs are low compared to others in attracting activity. Third point on the AI adoption. Couple of things. So first of all, if you look at the chart on the left hand, you would see the scatter is not tight, definitely not. So you see almost no correlation between the change in AI adoption by companies and the change in unit labor costs. So unit labor costs are not a factor of AI adoption. And this, back to what has been just said, companies are adopting AI technologies for other reasons. The main reasons, there have been a survey done by my colleagues at you probably know the PMI survey from S&P Market Intelligence, and they did a very interesting survey on the reasons why companies are adopting AI technologies, and this is first of all to deliver productivity gains, more than to save on the payroll. And for that reason, I think that if at some point AI deliver productivity gains, and I don't know about you, but my use of AI is highly productive for my activities. So at some point it will probably be seen in the figures. So if AI adoption increases productivity, it will not help to reduce the unit labor cost divergence we have in Europe right now, because the countries where unit labor costs are rising the most are the one where AI is adopted the less. So it might become, AI might become a factor of further heterogeneity for the European labor market. And I stop there.
Thank you, Sylvain. So the question arises naturally, how much AI helps you with these excellent charts?
For this one, I must say I rely on my intern. Because I was busy with AI doing something else.
So the question is, how much did the intern use AI?
A lot.
So indirectly you used AI. That's brilliant, good. So let me now turn to Andrea. We have so far mainly dealt with nominal wage and productivity developments as a cause of economic divergence, or as an equilibrating mechanism within the euro area. An important additional mechanism to deal with asymmetric shocks is labor mobility, if we look at the optimal currency area literature, for instance. And against this background, Andrea will now present to us first results from her ongoing research on labor migration between euro area countries and also between euro area and non-euro area countries. Andrea, over to you.
Thank you very much, Ernest, for this nice introduction, and thanks for coming to our panel. So I will take you now from the world of macroeconomic big picture evidence to the world of microeconomics. So we look at the returns to migration for individual migrants. So we take in our research, we take the perspective of an individual migrant and ask ourselves, how much can they gain from migrating in or within the European Union? This is also deviating a bit from the typical labor economics migration literature, which looks at spillover effects from migrants on the host economy. So this is a series of projects I've been doing with Rudolf Winterebner first and foremost, but then also teams in other countries. So if you think about migration flows between developed countries, it's typically relatively unrestricted for highly skilled workers. Yeah? So we probably all know about this. Yeah? The European Union differs from this setup because it is built on this principle of the free mobility of labor. We've talked about this already in the morning today. And in this context, a much larger group of people might benefit from these additional labor market opportunities they get. Yeah? So in this context, we can ask ourselves, how important are these unrestricted migration opportunities? Can people benefit? Do they gain, or do some people also lose by taking risks that were unnecessary? And of course, we can also ask ourselves, how do these migration decisions within the European Union interact with the social insurance systems? Yeah? I will talk about each of these questions a little bit, at least of the, or most speculatively on the last one. But I'll show you how we set up this type of research. So we got access to linked register data. So this is social security data at the individual level, where we can follow individuals across countries. Yeah? So we can see individuals in their home country, and then we can see them in their host country, and then if they return, we can also see them back at home. And so in these results I'll show you here, we study a special group of migrants, so those who have a job in their home country before they move to a destination country. And so this setup is useful because we can not only compare these migrants, what happened to them before they migrate and after they migrate, so take a difference, say, in the earnings before and after migration, but also we have a natural comparison group, which tells us the counterfactual, what would have happened if they just stayed at home. And these are the co-workers in these jobs they had in the home country before moving. Yeah? So we have a kind of difference in difference comparison, where the migrants moving to another country, we can compare their situation before and after migration, and then the co-workers are these counterfactual, which are the comparison group. So this design also naturally includes return migrants, so migrants who eventually come home. And of course, we would like to include these outcomes back at home also in the calculation. And this is very, very easily possible in our setup. I'll tell you about 2 case studies. So the first is where we look at migration between Germany and Austria. So these are 2 high-income countries, and we have symmetric migration flows. So there are people like Michael coming from Germany to Austria, and there's other people like me a few years ago going from Austria to Germany. And then we have the second case, which is still very much work in progress, where we look at one-way migration streams from Hungary to Austria. Yeah, so these are a different country context and different economic context. And so this is being studied in this kind of detail for the first time. Okay, so before I'll show you the returns to migration, I'll quickly answer the question of who is moving. Yeah, so these are voluntary migration choices. Nobody is forced to go anywhere, but these people choose to move. We find that in all these contexts, going from Germany to Austria, Austria to Germany, or Hungary to Austria, the migrants are predominantly male. Yeah, so something like 2/3 of these migrants are male. And we also see in all of these contexts that about 20% of the migrants, they were unemployed before coming to the other country. It seems to be that negative employment shocks trigger migration decisions. We also see that roughly half of these migrants come back within 5 years, so there is a lot of return migration. We also find a lot of circular migration. So now what is the difference in the 2 different scenarios? So we find that migrants are migrating between Austria and Germany, they are positively selected. Yeah? So they are the higher skilled types and the higher earning types. Yeah? So people who go to another high income country are those who are of higher ability. We also see that between Austria and Germany is a very special case where we have the same language and the transferability of educational degrees to a high extent. These migrants can transfer a lot of their skills at home also to the host country. Yeah? This is very different if we look at the situation of migration from Hungary to Austria. Hungarian migrants, they are negative selected compared to these non-migrating individuals. So these are those with the lowest earnings and the lowest education levels who come to Austria. But they also see less transferability of their skills, which is also evident because of the differences in language and so on and so forth. Yeah? So this is the setting, so we can see now about whom we are talking. Yeah? And now we look at what happens to these migrants. And here I show you some graphs for the case where Austrians move to Germany. Yeah? So we have this horizontal axis here in these graphs. It shows the timeline, and at time 0 is the point in time when they move. To the left of point 0 is when they are still in Austria, and to the right is when they are after they have migrated. Yeah? On the left graph we show the employment outcomes. On the right graph we show their wage outcomes. So what we can see very clearly is, so we restrict these migrants to have a job in the home country, so which is this here, yeah. And then here they show up in the other country. This is Germany in this case. And so what we see here in between is this negative employment shock. Yeah? So the migrants, they have these negative shocks. Then they move to the other country and their employment trajectories recover. These hollow circles are the co-workers. Yeah? So we compare them to the co-workers. Co-workers do not suffer these negative shocks. So they have relatively smooth employment profiles, similar to the migrants in the longer run. And then here on the right-hand graph, we show their wage trajectories. Yeah? So this is the wages before migration, and then this is their wages after migration. And so we measure their wages in whatever country they are. Yeah? So half of these migrants have already returned home, so this is their wages back in Austria. Yeah? So here we see that between the migrants and the co-workers, there is this gap in pre-migration wages. So they are, as I said before, positively selected compared to the co-workers. And then we see, if we compare the gap to the left and the gap of the right, this would be their return to migration. So we see that in the long run, these migrants are doing much better as their co-workers who stay at home. And even, they can even transport some of these returns back home if they return to Austria. Yeah? So if we put this into numbers, so here we show you the returns from Austrians moving to Germany in the short run and in the longer run. So this is years 1 and this is year 2 to 5 after migration. These returns are about 12 to 13 percentage points. Yeah? So it's quite substantial. For the Germans coming to Austria, the returns are somewhat lower, yeah, so there are some 4 percentage points. And so this is this super preliminary results for the Hungarians moving to Austria. So remember, they were negatively selected. They cannot transfer their skills, but they still had huge returns to migration. Yeah? So this is I say is 100%, but we find also groups for whom it's much more than 100%. Yeah? So first, so what we also find, if you look in more detail, there is a lot of heterogeneity across groups, not only across these country scenarios here. So in general, all these groups benefit, so everybody benefits from migration. Yeah? They go there voluntarily, but they also benefit. We also see that these gains or these returns from migration are positively correlated to the housing costs. So it's not so surprising that the Austrians going to the big German cities gain more. They also move to more expensive places versus the Germans coming to Austria, for instance. And yeah, this I said before, so the return migrants, they do really also benefit from the experience abroad when they come home. Okay. Yeah, so then my last points I would like to make is this interaction of the migration decision with the social security systems. These differ still a lot across European countries. And so here we find that migrants who lose their jobs abroad relatively shortly after migration, they come back into the home country and claim benefits in the home country. So it needs still to be explored what is the incentives triggering these decisions, or what is the regulations they face. In more general, it would be very, very interesting to find out how these unemployment insurance, but also pension insurance regulations drive migration decisions or drive decisions to return to the home country. And then an even bigger question is how we can simplify the procedures to transfer pension rights across European Union countries. This is still a big obstacle to migration, and it's still pretty complicated to perform. Yeah, thank you very much.
Thank you very much, Andrea. I now ask the panel if there are any immediate reactions to the other presentations. Is there anything you want to directly, David?
Yeah, I would have, if time allows, a few questions. If yes. That's okay. Maybe in the order of the presentation. So on the real wage gap compared to the COVID trend, we discussed it over lunch, and I thought about it again. I mean, ultimately, the 22 shock and also this shock now is a negative terms of trade shock. Now, so the economy, the euro economy as a whole is losing out, and we have to see how we distribute this across the agents in the economy, right? So is it surprising maybe that it is below the pre-COVID trend, this real wage gap that you've shown, also given that productivity is very subdued, no? And of course, that's relevant for firms and the total economy. Then I was wondering, I mean, this slide that you've shown on the employment growth, no, and you will see. I mean, of course, I made a bit of a similar point in the sense that I said, no, the real wages with the high profits enabled employment growth. But on this correlation chart, I was wondering whether we really control enough there for how different the countries were hit by the shock, no, whether the CEs and the strong decline in GDP, whether it's really only the nominal wage or I just up for discussion. And I wanted to ask you on the migration, when we look at this from a macro level at the ECB, of course, what we're sometimes wondering is to what extent is the higher labor supply from foreign workers supply or demand driven? No? And I was wondering whether you know, whether we worked a bit on this, because we know obviously that inward migration depends a lot on the economic situation in the country, and now that we see migration slowing down, it's probably also partly because of the lower labor demand. No, but when we think of shocks like that, the Ukraine refugees, obviously this is more supply driven. And relatedly, you conclude very much for all migrants together in the last slide, but I guess there must be differences for different kinds of skills. No, whether you're a high skilled migrant or a low skilled migrant.
So maybe Eliana, you want to start?
Yeah, thank you for your question. Yes, I definitely agree. When we have a terms of trade shock, somebody has to pay for this, and typically it occurs that they are the workers who pay for terms of trade shocks. But the point that I would like to stress here is that even if it can be useful, at least at the very beginning, that nominal wages react relatively slowly, in the euro area, there are still countries that are below that level, because of the heterogeneity that I have already shown. And we are talking about 3 years and a half. And even more if we think that indeed inflation started rising around 5% also at the end of 2021. It's a matter of how persistent has become that shock. And I believe that this is something that we should try to consider. Of course, it depends also on productivity, but the causal nexus between the two is not so clear, because productivity declines also because capital deepening declines, and capital deepening does not recover because wages are so low. So this is something that as a central bankers we cannot manage, of course, but we have to at least stimulate some debate, not on the wage sacking, of course, but on the conditions for which we can as a euro area relaunch investments, relaunch capital deepening, and productivity growth. And I fully agree with you and with you all that at the end of the day, structural reforms are a national business.
Sylvain, do you want to?
Sorry. Yes, we could do the same chart controlling by growth, but what kind of growth? Is this GDP or is this GDP per capita or GDP per... Because when you look at nominal unit labor cost, normally the metric is already deflated by growth in GDP per work. So would be interesting to do the same chart for comparing Europe and the US, for instance, for that. But I think if we do the correction, we won't see something very different.
Andrea, do you want to answer to the comments?
Sure. Thanks for the comments. Yeah, so we studied this migration flows over a relatively long time period. So for Austria and Germany, we can do this from the early 1980s onwards. So we have different policy regimes where there is different probably supply and demand driven causes. A lot of the migration is though supply driven. If you think about Germany in the early 2000s, they had these labor market problems and welfare reforms, which drove a large number of Germans across the border. So they found better job opportunities and also higher wages probably in the Austrian labor market. And then the same is for the Hungarian migrants coming to Austria. This happened mostly after 2011 when Austria opened the labor market to the members of the new EU countries. And there we see a huge inflow of these Hungarian workers, which was for sure also a supply shock. But we may be able to trace out also the demand shocks and compare the results is a good idea. Yeah. And the other thing, yeah, there's enormous amount of heterogeneity also within groups. So we see typically that the men benefit much more than women do. We see also that people who were unemployed before they move, they benefit less than those who move from jobs. Yeah. But we also see that lower income or people who had lower income prior to migration have the bigger gains, interestingly. Yeah.
Okay.
May I ask
yes, please.
something to
Absolutely.
Professor Weber? Congratulations. I cannot imagine how difficult it has been to find this data and match and follow workers across the states. I wonder whether you can also follow migrants, that is extra European workers that move from one country to another, because I believe that, we are an aging continent, right? And young people move, whereas people in 35, 40 years old typically do not move from one country to another one, do not move from one job to another. They typically stay where they are, probably because of family ties, or also simply because they have allocated efficiently. I don't know. But that is not a margin for absorbing shocks, whereas movements of migrants from one euro area country to another can become relevant in perspective, I think.
Yeah, sure. I mean, so this is exactly the case. So this is very, very, very difficult and time-consuming to match this kind of data. We would love to also have non-EU nationals, for instance, follow Turkish citizens across Austria, Germany, and probably Italy or something. So this will be all the subject of future research. I often compare this kind of data with international trade data. So in international trade, we know very well what is exported from which country to what country and at what price. So ideally, we would want to have the same kind of data for migration.
So, thank you very much. We have roughly a quarter of an hour for questions. Are there any questions? Yes, please.
Thank you for very interesting discussions and all of your presentations. I mean, when we talk about sort of, labor markets, wages, and employment stability in the context of heterogeneity, could you maybe comment a little bit on how much it makes a difference between the sort of labor union structures between the countries? So we have certain countries, Nordics that, for example, I come from, which is very highly sort of unionized. We have sort of countries which is much less unionized. To how much of a degree does this matter for when we look at sort of the shock resistance or changes in the wage setting process?
David?
I mean, we're just about to finalize an analytical piece where we see to what extent firms react to different kinds of shock surprises. It can be monetary policy, but it can be others. And we see that, in fact, looking in particular here at German data, where we compare different sort of collective bargaining coverages, minimum wage exposures, that the reaction of the firms that are more, for example, have a higher collective bargaining share, maybe a higher union density, they don't react so quickly in terms of employment expectation to a shock, to an adverse shock. So you can argue, especially for the German case, no, that unions sort of incorporate the need to preserve jobs at difficult times. Whereas on the other hand, when you see countries and sectors with a higher minimum wage share, that those react stronger actually on the employment expectations, because it's the main margin they can adjust, right? So it is visible in the micro data. It's just a question, of course, how much macro relevant that is.
Other further questions? Yes, please, Thomas.
Thank you. I have one question to Sylvain. You have shown us pictures where the Eastern European countries have a very high nominal wage growth rate, and I was asking myself whether this shouldn't be the case that way, because we know there are substantial differences in per capita income, and if those countries don't grow faster, they will never catch up. Maybe you can comment on this. And then I have a question to Andrea. I'm wondering why not all of us are jumping up and moving to Germany, snatching this 12% premium. And I was thinking, well, maybe there are some sort of transaction costs that are operating, and this might be search of job costs, search of a new home cost, moving costs, and things like this. Did you look for things like this, transaction cost-based barriers to migration?
Thank you very much. Maybe if I may add to Thomas's question, of course, and you mentioned it yourself, the cost of living, so sort of purchasing power adjusted. So, Sylvain, I think you the first.
Thank you. It's a fantastic question and a fair point. These economies are definitively catching up economies, like Spain was 10 years ago, for instance. And it could be felt normal that the price level, because this is what's happening, is converging toward the core countries. The issue is that this is a price level convergence. This is not a productivity convergence. It's not GDP per capita convergence, real one. If we look back at the charts, you could see that in some Eastern European countries where nominal unit labor costs have increased the most, productivity also has increased more than that. So the heterogeneity is really coming from the wage setting and then from the price level. So that might not be top in a union, especially considering that in the face of US and Chinese competitions, one of our advantages is definitively wage cost in some territories of the union.
Thank you. Andrea?
Yeah, thanks, Thomas. Great questions. I don't say that everybody who moves to Germany will for sure earn 12% higher wage. This is a bit. So these are voluntary migration decisions. So in the literature, the migration model typically say you move if you expect to earn more in the other country than you earn at home, plus the moving cost. Yeah? So you can also think of our estimate as the estimate of the moving cost. Yeah? So it is also costly to move away from home and to set up in Germany. So we don't have the cost of living or price adjustment right now. The only thing we have is these rental prices. Yeah? So we compare, which is probably a large share of the migrants' costs abroad. So we compare the rental price in the home region to the rental price in the destination region. And we see that these migrants who have the higher returns also move to the more expensive places. Yeah? So this is definitely the case. In terms of policy implications, we could ask ourselves, what could we do to reduce this migration cost? So if we reduce migration cost, this might make more people be able to afford moving and still gain something in earnings. Yeah? And we could do this by equalizing the social insurance systems or all kinds of other policy measures.
Please.
Yeah. I want I want to contribute. Austria is a very small market, especially for employees. So big companies would rather go to Germany and provide employment than in Austria because of policy, for example. So when Austrians move to Germany, over there are the better jobs than in Austria. For example, in chemistry. They are not the jobs in Austria, but they are in Germany. So I think there's also the possibility of having good jobs also to be concerned about.
Yeah, no, you're definitely correct. Yeah, so the large companies, they are not in Austria, they are in Germany. Yeah, so if you want to work for Siemens, Mercedes, you have to go to Germany. But this is again mostly the migration of higher skilled workers. Yeah, if you think about low skilled workers, it might look differently. And it seems to be the case that so in the early 2000s, lots of Germans. These were not high-skilled people, but they found better employment opportunities and higher wages in Austria.
Yes, please.
So I have more question for David and Eliana. I feel like Eliana had more interpretation of the decrease in unemployment, more like an hysteresis effect. And David was more interpreting it from the structural point of view. And I'm kind of wondering what's the interpretation or implication of those two interpretations for the NEO, for the non-accelerating rate of unemployment. Because in one case, it means that we will see some kind of mean reversion on the long term. On the other case, we kind of won the fight against wage inflation for a long time now.
Well, this is something that we are, of course, studying considerably because it's a relevant topic. Italy is one of the cases in which aging has depressed the unemployment rate, particularly. If we look at the data, we have the lowest unemployment rate since the 50s. It is around 5%, and it is almost entirely due to aging, together with other structural issues that involve mainly young people. Because in Italy we have seen this increase in education levels and in involvement in higher education by young people, and typically in Italy those who study tend to do not participate to the labor market, and when the labor market is weak, this reinforces the fact that they prefer to study and not to participate to the labor market. So at the end of the day, these structural forces are the main source that are leading the unemployment rate, and it's probably true that the NAIRU has changed as well, and is probably now lower than it was we believe in the past decade. It is not so easy to understand by how much you can imagine, and I believe that the same forces are at work also in other European countries in which we do not see this reaction of wages. But what is striking is that wages do react very slowly also to measures of tightness, that is vacancy to unemployment. The ECB has a study on that by Arce. We have also replicated the Blanchard blinder study that for Italy. And one of the things that emerges there is that the nominal wages tend to do not react much. They have some reactions when there are job-to-job flows, especially in 2022 and so on, but since the flows from one job to another are rather limited, this does not translate in higher wage dynamics at the aggregate level.
Just to complement that, I think pretty much on the same line, I think the unemployment rate shows both. So we should not forget that, and you've seen it in my chart, in 2014, we had an extremely high unemployment rate and the economy was not doing well at all. And from that moment on, interrupted by COVID, we had, I don't know, 8 or 10 years of an economic expansion, no? And employment, there was a strong employment creation. So obviously that helped to reduce the unemployment rate significantly. Someone mentioned there were reforms in many countries, especially, of course, those affected by the crisis, by the great financial crisis, reforms that also helped to reduce the unemployment rate, but also the NAIRU. And the NAIRU was reduced by in those countries by reforms, but of course also by structural factors that are taking effect to the same extent. Aging is one, but of course we also have structural skill shortages in the euro area and many advanced economies that drove down the unemployment rate as well.
Thank you very much. I have a last question to all of you. If you could recommend one policy priority to European policymakers to strengthen labor market performance while avoiding further divergence across countries, what would it be? Let's start with Sylvain.
It would be a bit more than one word, but I think the labor intensity of the European economy is already high. If we really want to help more job creations, we have to lower the capital costs.
Lower the capital costs.
Deepen the capital intensity of the economy, which will, by spillover, create more jobs. And to do that, I think I would repeat what has been said this morning, the Capital Markets Union. Please move on with the Capital Markets Union.
Okay, so
for the sake of our children.
Single market, priority, Capital Markets Union, Savings Investment Union. David.
I mean, let me stay, although fully agree on that, on the labor market reform side. And again, unfortunately, I have to say it depends, because very much the labor market in the euro area is extremely heterogeneous. They're very different models. You have more Anglo-Saxon models, you have more different kind of models. So you cannot prescribe one policy that fits across sector, across the countries, with very one exception or two. One is education policies. So I really think this is something, especially in the face of AI, the skill shortages that we see, that needs to be invested on across the board, across countries. And of course, aging is something that affects nearly all of us. So if we want to sustain the labor supply that we need, we have to think about how we deal with additional labor supply coming in. Can be additional participation of the nationals, can also be higher inward migration.
Okay. Eliana.
I agree with Sylvain, so I will not add much.
Okay. You don't want to make a mistake, give a wrong prescription, then comes disaster.
No, I really believe that capital intensity is crucial to recover productivity. So
since unemployment is low and people have a job, basically.
And we are aging, so we need to invest more in technologies.
Absolutely.
And so I believe that is extremely
Can I add something after, but just after, at the end?
Yes, Andrea.
Don't want to.
Yeah, so I would be all in favor of education. So
2 and 2.
I'm in line with David. So I think we cannot go wrong by investing much more in education, especially for the low-skilled and disadvantaged groups.
Just to complement on what we said on the capital intensity of Europe, which is key. The digital transition / AI boom is a global phenomenon. And there is a very clear division of labor between the American supply chain, the European supply chain, and the Asian supply chain. The American supply chain is the digital transition is a pure infrastructure boom. This is a capital deepening, this is data centers and things like that. In Asia, this is providing the tech goods that are necessary for building the infrastructure in the US, because they are highly productive. The part of Europe in that transition is to provide tech services. Almost 20% of the services we export are tech services. And why is that? This is the digital transition in Europe is very much labor intensive. This is because our labor costs are lower than in the US. It's cheaper to employ a software engineer in Dublin, in Warsaw, and even in Berlin than in the Silicon Valley. If we want to have more, we need to reduce the capital costs, 200 basis points higher than in the US to get the data centers. Otherwise, the division of labor will remain.
I mean, I fully agree. At the same time, I have to say, when we ask firms why you don't invest in AI, one of the key points is labor shortages, labor skill shortages. So the complementarity of labor and capital is essential. I mean, now the technology is more and more available, but if we ask around, especially we have also a worker level survey, those that never work with AI are super critical. Those that use it see the productivity benefits. So we need to sort of make clear and educate where are the benefits of it, and also for management, obviously, to roll it out to firms. No?
I think this was a very relevant concluding round. Thank you very much to Sylvain, David, Eliana, and Andrea for your valuable input and also for your readiness to discuss so vividly. To the questions from all of you. We adjourn now, and we reconvene, please, at 4:15 after a coffee break. Thank you.
Good point. I should have said the skills.
The striped in the middle, and then...
That's right.
All right, welcome. Good afternoon, everyone. Thank you for being with us for this last session of the conference today. My name is Killian Reeder. I'm working at the bank here, and I have the pleasure of moderating this last session. So the session is on housing markets, mortgages, and regional differences. And I thought I'm going to very briefly give you an idea of why we have this session in this conference. So why should you care about this session, essentially? And I think the easiest way to do that, based on also all the other contributions that we had this morning, is to give you an example. And the example I chose is monetary policy. More specifically, the question is, how and why does monetary policy affect household consumption? So we heard a lot about this morning, and we thought as central bankers we had a good answer to that for a while. Think about intertemporal substitution and we're fine, but actually it's much more complicated as we saw this morning, right? So empirics and theory, just think about Hank and all the fine-grained based research, fine-grained data-based research that we saw over the last decade just showed us that there's no real clear-cut answer to that question. And what does that mean now? It doesn't mean that we cannot provide insights on that. It just means that central banks, specifically policymakers, but also academics, have to really require a very, have to really look for a very deep grasp of the balance sheets of households, firms, etc., of the frictions that shape them, and of the regulations as well that manage them. So all this, as you can imagine, is super complex, as we saw this morning in a one-country setting already, and all this is, of course, much more compounded in a heterogeneous monetary union as, for example, the monetary area in the one that we are in the euro area. So we're going to look at this specific question, or not the specific question, but the specific problem of knowing more about the background, about the microdata, about the frictions, about the regulation from three specific key areas: housing markets, mortgages, and other structural regional differences. And for this, I have 4 panelists with me. One is online, so he's not invisible. He's here with us. He hears us. He will appear later on. And so together with them, the goal is really to understand, to discuss, and also to leverage these heterogeneities and differences across these topics, perhaps for better research in the future. All right. So let me briefly talk about our speakers today. So one thing that I should give you, heads up on is basically I asked them all to give me some information that I can promote for them to show their achievements and their talents essentially in front of you before we start the session. None of them came back to me. They're far too modest essentially to give me material to promote. So I basically looked for material to promote myself. And so this is what I'm going to present to you first. So Sophie Wadl is our first speaker here to my right. So this is going to be in the order of appearance for their presentations that you will see in a second. Sophie earned her doctorate at the University of Graz and then had a couple of academic positions at the Vienna University of Economics and Business and the Luxembourg Institute for Socioeconomic Research before joining the University of Cambridge in the Department of Land Economy a couple of years ago. So Sophie just recently won one of the best paper awards at the WU, specifically for a paper that is really relevant for our session, namely rent freezes in Berlin. And what is even more important, Sophie just got promoted to associate professor at the University of Cambridge. So I think we should give her a round of applause for that. So that was my first insight. So then we have Winfried with us. Winfried earned his PhD at the EUY, if I'm correct, and then had a series of academic positions at Queen Mary in London before joining the University of St. Gallen as a professor of economics in 2013, I think. And so what I found for Winfried is a bit more difficult to find facts, but I'll try to, or social media facts, so I tried to come up with two more hopefully interesting facts. So the one is Winfried is the co-founder of the multiple award-winning project Monitoring Consumption Switzerland, which basically tracks really on a very, very granular basis consumer spending based on transactional data. And for this reason, due to his work, Winfried also knows what Germans, Austrians, and Swiss people buy on Tuesdays versus Fridays. So you have to talk to him about that if you're interested. Then we have John Mühlbauer joining us online. John is earned his doctorate at the University of California, Berkeley. He had held various positions at Warwick and the University of London before becoming a professor of economics at the University of Oxford, where he's also a senior research fellow at Nuffield College. So John just recently gave, in September 2025, the British Academy Keynes lecture in economics on land, housing, and the British economy, so very much related to the topic of our session. And that's really an honor reserved to the most outstanding academics in the world, essentially. So that's, I think, really great to have John with us today. And second, another point that I found out about in his speech, actually, that he gave during the Keynes lecture, is that just before the oil shock hit, in this case 1973, not the recent one, John made a lucky escape from the London housing bubble by being gazumped by another buyer, which meant that another buyer actually trumped him with a better offer. So that's what I learned about him. So coming to Joan, our last speaker of the four, Joan is earned his PhD, I should notice, at the Goethe University in Frankfurt, of course, and then had a long career at the European Central Bank, and recently joined, and that's also my first point, the National Bank of Slovakia as the director of the Department of Economic and Monetary Analysis after apparently the really toughest selection process that I've heard about. So congratulations on that. And apparently also during his time at the ECB, he was not only a top performer in his job, but also one of the best football players in the team of the ECB, apparently. That's what people told me. And that I know from personal experience that this is a highly competitive team, so well done on that. So thanks for joining to all four of you. So the way we're going to do this is we're going to have now expert perspectives, short 5-minute presentations by each of them on their research. So even though this is a policy panel, each of them is very active in academic research. So I thought the best way to do this is by starting letting them speak a little bit about a recent piece, about recent insights. And so I'm going to hand over to Sophie, starting with the first presentation. Thank you so much.
Do I have to click them? Yes, okay. Okay, thank you very much. Also, thank you very much for the invitation, Kilian, and also for this very nice event here at the Austrian Central Bank, not only for the good coffee, but also, thank you very much. I'm going to talk about one thing that is actually fundamental to understanding housing markets in the first place, namely having the right data at hand. So what we actually measure becomes in some way policy, because what we measure is visible, can be analyzed, and will be analyzed. However, sometimes we also do not maybe measure the right things. Sometimes we also measure some things with some flaws, and this has probably implications. And sometimes it's also actually interesting when you can suddenly see effects of policies in what you measure. So that sounds a bit abstract, so I plan actually to give you 2 examples to make it a bit more clear what I actually mean with this kind of idea of bringing measurement, statistics are created, how they are created together with policy and analysis. So in general, so can official statistics shape the economy? They are actually designed to measure. So if you have statistics and then you have policy rules and you also have contracts, they may be bound to certain statistics. So particularly in this country, in Austria, we have one big example, and that is rent indexation and indexation of many other things, all bound to the CPI, so the Austrian CPI. That means, by the way, how we construct those measures actually has a direct implication on policy and what we actually observe then in the economy long term. So this is a quite important thing. Similar is also when it comes to rent controls. Very often rely on CPIs or measures alike as a benchmark to see how then the rental prices are actually going on. This is particularly tightly connected to each other here in Vienna, where most of the rental contracts are actually going up in line with CPI by construction. So in that sense, it's not neutral in what we actually measure, right? Because those numbers have impact and feedback into policy. So this is a bit the measure, and I would like to give you 2 examples where this actually matters from my recent research. So this is the first one. This is a long-standing problem of the Euro area HICP. So the Euro area HICP includes rental costs and rental spendings, like most other CPIs, but does not include the kind of equivalent costs that accrue to homeowners. So those people that at some point buy the house and live in their house. They also have costs, right, for acquisition of the property, but then also for maintaining the property and just to live in that property, right? That is per design excluded from the HICP and has always been. From the very beginning of the inception of the Europe, it was actually mandated that it should be included. But up until today, there has no solution been found how it should be done. And I think that is the main reason why we don't have it. There's no consensus on how to do that properly. But what if we had included it? So we did actually this exercise, not finished yet because I had no time to run the final analysis, but this is the first result. What you see here is actually the real HICP, that's the green line. But then you also see some other lines. So you see the 2% threshold in general, and you also see the HPI, so there's a house price index, so how did house prices on average on the Euro area level evolve? That's the dotted line. And you also see like the dashed line, which is the HIC plus, I call it. So it's the one where we sticked in owner-occupied housing. So we opened up the HICP and then on a country level inserted housing costs for all the different countries and then aggregated it up again. And you see quite a different development. So if you would have included housing costs, first of all, you would have seen the global financial crisis much more and much earlier. There would have been not certain periods where actually inflation was not negative, although we would have measured it as negative, but also vice versa, right? So some things may have been flipped. And probably most important for the recent period is that towards the end of COVID, inflation would not have been down to 0 because we had massive house price inflation during this period. And you would have had seen that and probably set very different incentives if you would have seen this measure from the very beginning onwards, simply because there would not have been this incentive to lower interest rates so much if that would have been visible from the very beginning onwards with potential, I mean, that's speculative, obviously, but maybe also better policy outcome. So in that sense, I would think that measuring statistics in different ways probably has different incentives and can actually then long-term affect policy. A second example is here from Vienna, given that we are in Vienna, is something we just started recently, also because the policy is very recent, and I got actually some new data yesterday, but I could not update the slides anymore. So you see only the very first quarters of what we have here. In Austria, there was the 4th and 5th MILG, which kind of is a kind of rent cap that was introduced with the purpose to make life for renters a bit easier in times of inflation. So you need to know that in Austria it's very typical that rental contracts are indexed with inflation. So that means when inflation goes up, the rent goes up automatically for many renters because it's indexed once per year according to inflation. So you have actually this very interesting feedback loop that it's spiraling up. We know that for wages and CPI and inflation, that's spiral, but the spiral also exists in markets like that in Austria, where there is this automatic linkage. Then there was this earlier last year, a policy that actually capped the transmission process when inflation gets too high. So the idea is actually, that's what I have here, is they implemented a rule that whenever inflation is more than 3% in Austria, not euro area, but Austria, it's not allowed to push that forwards to renters anymore in full, but only 50% of that excess, right? So up to 3% inflation, it goes in line, they walk together, so to say. When it's more, there's a break. And we just were in that situation where it was above 3%. And you actually see very nicely that this dampens Austrian inflation massively because it contributes quite a lot to inflation measure in Austria, how the rent was indexed. And that was an automatic process that was in the system, how it was there. However, when you break the loop there, you actually see that Austrian inflation was also going down and may also contribute to that not being such a spiral anymore. Rent inflation is really important in Austria because, as just said before, owner-occupied housing costs are not included, versus rental costs are included. Austria is a high renter country, meaning that housing costs and that period we just observed was much more important for Austria than for all the other countries, explaining potentially why Austria has such a higher inflation measure than many other euro area countries. Not because of other reasons, but mainly for these structural differences, how the markets work and how people choose to live in this country here and in other countries. So I think I'm talking too much. So Kilian tells me I should finish already, so I think I will not say anything about the last slide, which is kind of a summary for what I just before, namely that the measurement at the very beginning is utmost important to actually see what is happening because it feeds back into policy and outcomes. Thank you very much.
Okay. Thanks for putting me on the panel. Thanks, Kilian, for the really nice introduction and all the organization and giving this panel the structure it has. I want to do three things. No? There are going to be three slides. One slide, this is the first one, is motivating why it may be interesting to think about heterogeneity in the transmission of monetary policy in the euro area, which is related to housing markets. Then I want to show you on one slide how we have thought about this further in one empirical paper and then through the lens of a dynamic model. And then on the last slide, I want to relate this to a little bit to fiscal policy and macroprudential policy because that was also the interest, I guess, of the conference, and we have some research on that too. So on this table, I put together the 5 largest euro area countries plus Austria at the top in red. In the first column, you see the owner occupation rate. In the second column, you see the percentage of households that have a mortgage against their main residence. So HMR means that you have a house and that's your main residence. Then in the third column, you see the median value of that mortgage conditional on owning. And in the last in the third column, you see the value of the house, conditional on owning. And in the last column, you see the outstanding loan conditional on having a mortgage. And what you see looking at the first column is that the own occupation rate is drastically different in the euro area, right? So you have Italy and Spain, where really the large majority of people own the place in which they live, and then you have countries like Austria and Germany, where for the majority that's not the case, right? And so the biggest item then in the household's balance sheet is the house, and then you have a mortgage written against it, and then this heterogeneity also translates across these countries, whether the majority has actually fixed rate or flexible rate mortgages, and so you can see that this is going to be likely of first order importance for monetary policy transmission. Okay, so this data, by the way, it's a fantastic effort done by the ECB and many of the central banks, and the researchers are super grateful that you're doing this. So this is data taken from the Household Finance and Consumption Survey from a representative wave, and at this stage, from the researcher side, I really want to thank the central bank people who are involved in making this data available and working on this. Okay, so first point is made. I mean, why would you look at heterogeneity in transmission? Because households' balance sheets look very different across the euro area, okay? So what are insights which we have generated? So jointly with Benedikt Lennartz and Marc-Antoine Ramelet, in a paper, we have looked at the heterogeneous transmission in more detail of monetary policy to the housing market, and really looked at different steps. So the first step is, okay, how does monetary policy transmission translate to mortgage rates? And already this morning you saw on one slide by Michael how heterogeneous this transmission is. And in fact, that's also something we find that's partially also institutional because, I mean, trivially, I mean, the composition of mortgages is different. Some are flexible rates indexed to, say, the Euribor, or the Libor at some point when it still existed, or now the Saron in Switzerland and so on. And so then these mortgages clearly are mechanically immediately reacting, and the composition of these mortgages is different across countries. But also if you look at fixed rate mortgages, conditional on fixed rate mortgages, also then the transmission is different. And I think this is also per se an interesting research topic in this paper there, and we started documenting this in the first place. Then if you look at the home ownership decision, I think in that paper what we were finding out, it was interesting in the sense that monetary policy actually affects the home ownership decision. Now, you may at first think, okay, I mean, you have a couple of basis points monetary policy shock. How can that be that this actually affects the decision whether you buy a house or not? But think about it. You have a population in the economy, and they're the marginal guys. No? So maybe a change in the interest rate triggers them to anticipate, okay, the decision to transit from renting to owning, or vice versa, to delay that decision. Okay? And so in that paper, we showed that an unexpected policy rate cut by 1 standard deviation, so for the ECB monetary policy shocks, that would be around 7 basis points, increases the transition from renting to owning by roughly 10%. So if 4% of the renters transit to become owners per year, so this is then 0.4 percentage points, right? And that's a non-negligible effect. This is a small part of the population, but these people drastically change their spending decisions, right? So in the year when you purchase a house, as you can imagine, I mean, maybe you cut down on your non-housing consumption, okay? But also, I mean, empirically, when you look at durables, I mean, there's certain kind of durables which you purchase, which are complementary to purchasing a home. So, I mean, this really reshuffles the consumption basket a lot. And hence, for this small subpopulation, drastically changes the consumption response, which then also matters at the aggregate level. So then in the next paper, we looked, with Thomas Hintermeyer published in the QE, we look at this through the lens, this transmission of monetary policy through the lens of a dynamic model. So it's a dynamic life cycle model. It should be life cycle because if you think about, transition from renting to owning, it would be a huge omission not to think about the life cycle. Okay, so here, I mean, you have unexpected changes in real interest rates, and we look at, okay, how does this trigger transitions from renting to owning, and how does this affect the consumption response? And so if you look at the aggregate response, think about Spain. You remember, I mean, this was a country with a very high home ownership rate, and think about Germany. So they would differ in terms of the aggregate response to a 25 basis point change with, say, 0.34 for Germany, percentage points consumption response to 0.45, right? So it's a 10 basis point difference, but it's a quarter of the total response in terms of once you think about the response in Germany. So that's a big difference, right? I mean, so quantitatively, in this paper, we established that it matters, okay, whether you have balance sheets like in Spain or whether you have balance sheets like you have in Germany for the monetary policy transmission. And in terms of the mechanisms, okay, what is really key are three things, okay? One is the unhedged interest rate exposure. So some of you may remember the paper by Auclair who brought this up, but this was around already earlier. So what does this mean? So if you're a homeowner and you have a mortgage, you're exposed to interest rate risk, right? So if the central bank changes the interest rate and say you have a variable rate mortgage, I mean, you directly feel the change in the interest rate in terms of how much you have to pay for your mortgage. And so instead, a renter, so think about a renter with approximately very little savings, as you see, for example, for renters in Germany in the data, they have close to no interest rate risk. Okay, so renters may have a high MPC, but they essentially have no interest rate risk, unhedged interest rate exposure. So actually they respond very little to monetary policy. Instead, what we find is, I mean, so strong effects in terms of consumption responses of indebted homeowners, okay, who are not adjusting their liquid wealth, so they also have a reasonably high MPC, okay? So it's the combination of these effects, and so unhedged interest rate exposure, MPCs, and also the decision, which is endogenous to the monetary policy decision or endogenous in the monetary policy transmission, the decision whether to rent or to own, no? Okay, good. Last slide, Kilian is giving me signs. So how can you also relate this to macroprudential and fiscal policy? Of course, when monetary policy was constrained by the zero lower bound, I mean, so people got very interested in unconventional fiscal policy, so temporary VAT changes. So we have some research there for the large VAT cut in Germany during the COVID period. And what we show there is essentially if you target it to durables, that's where you really get large effects. If you give VAT or you lower the VAT rates on non-durables, I mean, you're not triggering a lot of intertemporal substitution as you would expect. These are non-durables, right? And so in some sense, you can get much more bang for the buck if you target the durables when you do the temporary VAT changes. Last thing, and then I close. Maybe on macroprudential regulation, once you look at macroprudential regulations through the lens of the household sector, of course, macroprudential regulations, I mean, you do it because you want to have increased financial stability in the banking sector and so on and so forth. But typically, when you look at who bears the cost of this regulation, people say, okay, these are the young households who are priced out of the housing market because you have stricter lending requirements and you look at empirical evidence in terms of the effects on the delayed home ownership decision. So the age of the first-time home buyers goes up if you tighter in terms of credit. Well, if you look at Germany, for example, okay, you may see these effects in the data, but this doesn't mean in the next step that these are actually large welfare effects for these young households. Okay, if you're in a country like Germany and in Austria, the share of renters is also very high. Okay, renting may not be such a bad deal. So delaying home ownership for 1 year is maybe not such a big cost. Instead, I mean, you have house price effects which are triggered through these macroprudential tightening. And so the welfare cost is much more on the existing owners. Okay, so when you think about the trade-offs, I think you need to also think about the price adjustments which are triggered in the housing market. And the existing owners, when prices of housing markets cool, prices come down, they are also affected in terms of welfare. And that's something to keep in mind when you think about economies like Germany or Austria, that the trade-offs may be different. Thanks.
So now we have John. It's up to you to show us your presentation and walk us through it. Thank you so much.
Thank you very much. Thanks very much for having me. I'm in Oslo at the moment. Of course, I would have liked to have been in Vienna, but there we are. Next slide, please. I actually wrote about this a long time ago when monetary union was first being discussed and when the issue of Britain's joining was a big issue. And pointed out that institutional differences were huge and made a very big difference and posed serious risks for the UK joining. Some of the mechanisms are really important to explain the institutional differences that they result in. So are housing loans collateralized or covered by collective insurance? France being an example of the latter. Fixed versus floating, we've already discussed. Is there mortgage interest tax relief? That's quite important. In Holland, it's extreme. Is there home equity withdrawal? Is there market value linked property tax with stabilization properties? Own occupation, rent regulation, we've discussed. The quality and setting of macroprudential policy. The structure of the banking system, its complexity, interconnectedness, maturity, mismatch, and other financial regulation and bank supervision. All these things matter a lot for the ways in which housing interacts with the credit system, the tax system, the land use, and labour markets. Given these differences, one point that's worth making is that in the international evidence that examines the effects of buyer policies, the fixed effects cannot capture the structural differences when these structural differences are so large. Next slide. So 2 points. First, on extrapolative expectations. So one of the big issues is amplification in the business cycle, and housing and credit markets potentially can play a big role in that amplification. So a key component of amplification is extrapolative expectations. So housing market participants often extrapolate past appreciation, and then that makes the shocks correlated and amplifies shocks. Now, what drives the degree of extrapolation? Well, market-related property tax, for example, stabilizes the whole thing. So that cuts prospective returns and reduces this impact of expectations. High gearing increases the role of extrapolative expectations because gearing amplifies returns. Mortgage interest tax relief, like in Netherlands, incentivizes high levels of debt, high gearing. And there's path dependence. The history of large amplitude house price swings is something that then generates the expectation based on history. So that's one point. The second point is about floating rates versus fixed rates. On the right-hand side, you can see the defaults, both in foreclosures and in arrears in the UK of 2 crises. So one was the crisis in the early 90s, which was triggered by a large, pretty much exogenous interest rate shock. And the second was the global financial crisis, when the UK was able to cut interest rates very rapidly in order to respond to that shock. So it wasn't an interest rate shock. Instead, it came from the international credit markets, and the UK was able to stabilize. Contrast that with the US on the left-hand side, where the global financial crisis in a fixed rate mortgage market could not be dealt with by quickly cutting interest rates. Cutting interest rates had very little short-run effect on indebted households. And so we saw extreme levels of foreclosures in the US. Next slide. So macroprudential policy should manage the credit cycle with lending standards interacting with non-performing loans and housing. There's an important connection, obviously, between lending standards and the credit cycle. So lending standards are an important driver of real estate prices, of credit growth, of consumer expenditure and residential investment, and hence of economic activity, and indeed of non-performing loans. So a large jump in interest rates among given other things, is likely to increase non-performing loans, and then non-performing loans feed back onto tightening lending standards, which then can potentially amplify the downturn in the economy. So interest rates through NPLs can affect lending standards. So there's a close connection between monetary policy and macroprudential policy in the real estate context. And my view is that there's been insufficient attention in modeling and policy making. And visiting different central banks and working with central banks, I've realized that there's a more sophisticated appreciation of real estate in the credit cycle at the ESRB and at central banks in the financial stability teams, and a comparative underemphasis in the monetary policy bonding teams. Next slide. So the European, in the EMU, given that monetary policy is made in Frankfurt, it's important that there's devolved management of the macroprudential side, given these idiosyncratic differences between countries. So potentially, diversity poses a risk for a common monetary policy, and therefore having decentralized macroprudential policy is really important. But nevertheless, the supranational bodies have to play a role in coordination because there are spillover effects between countries. And of course, the issue also democratic control and subsidiarity that makes it important to have country control of macroprudential policy. So there have been very good developments from the supranational bodies, better data, new instruments, minimum standards. So the current system, in my view, where the ESRB issues warnings of risk buildup, recommendations for tightening, and then follow-up checks on implementation is working pretty well. It could work even better if we had better data. As Winfried pointed out, macroprudential policy, especially using borrower-related policy measures, raises distributional issues. Next slide. And he actually made a very good point, which I very much agree with on exactly this issue. Politicians and the media worry that tighter borrower-based measures, like lower ceilings on loan-to-value or debt service-to-income ratios, or higher amortization requirements, cuts under-occupation and increase inequality and so on. But it seems to me that if those are your concerns, there are other things that can be done, other policy measures that address those concerns. So, for example, limits the mortgage interest tax deduction, which is very regressive, would be one good thing. Making property taxes proportional linked to market values, that stabilizes the system. Using split rate taxes that tax land, which is more volatile, more heavily than buildings, would be good. Reforming the land use or planning system to increase housing supply, reducing transfer taxes, or, of course, softening the short-term impact of borrower-based measures through escape clauses. Having granular data is really important. And with granular data, there's the potential of using a systems approach, which involves the complete capture of the dynamic interactions, which are very complex between households, renters and owner-occupiers, investors, landlords, banks, firms, fiscal authority, central bank, and financial regulators. And there are now ABM models, agent-based models that do exactly that. And there's a lovely new book by a very good collaborator of mine, Jagoda Kozłowska-Moja, that does exactly this and shows how the distribution implications can be demonstrated. And finally, thank you. Right, thank you very much. Those are the main points I wanted to make.
Okay. Thank you so much, Jean. I'm going to be sitting. Okay, of course.
So I feel like at home. So thank you so much for the invitation. Here's the slides. Actually, for me, it was a little bit shocking at the beginning to say that I will be in a session with housing and mortgages, and then I continue to read it. reading, and I say, okay, regional differences, maybe I can say something. So I'm super happy, and what I try to do is to convince you that despite today we have been discussing if heterogeneity is an issue or not an issue in general, I'm going to try to convince you that actually I think it's great because actually allows us to learn things that maybe we cannot learn with macro data. And I have been, for all my life working with macro data. And only when now, suddenly, at a certain point, I enter into the Phillips curve world, which has been around for 50 years. As an economist, I think you cannot die without trying one paper of the Phillips curve, because, we're still discussing about the Phillips curve, and we have been discussing today. Then is when I understood that there is some potential going to the, in this case, regional data, okay? So I'm gonna try to convince you and that, what are the channels that can be used that make us think about different, controls that we can do in the data, using regional data that allow us to maybe then think about what is the consequences to the aggregate, okay? These are my views, not the Nationalbank of Slovakia, because of course I'm working there now. So, I told you already the motivation. So, in the literature of the Phillips curve, we have been discussing there is an issue of identification. In simple words, we try to capture the relationship between, inflation and in this case is slack in the economy. In the structural world is, marginal costs, of course, but now, in an empirical world, this is much difficult, so there is an approximation, and then there are different measures of slack that are used. So you have unemployment, you have the VU ratio that has been spoken before, so many times. But these are imperfect proxies, right? So one thing that the regional data is going to bring you already is that you have a greater variability. Okay, so you have more data points, and more data points are good because you can maybe learn more, because you can find some patterns that maybe you don't find at the aggregate level. So there are patterns or channels that can be identified at the micro level, and maybe they are not to be seen in the aggregate, right? So think about that the big issue to identify there are, as we said this morning, and we have been discussing, cost push shocks, but there are also variabilities of, different things that we can control with fixed effects, which are national inflation expectations, variations in fiscal policy, differential effects of monetary policy through, the different countries. So until now, this has been done, there has been studies of the Phillips curve using heterogeneity at a country level. So I'm going to show you that actually, maybe we can do a little bit more, and this is what is this paper about. It will also, this thing of having actually more data also allows to maybe discuss a little bit about the nonlinearity. I think the keynote speaker today said a lot about this nonlinearity, and actually I want to discuss with you, maybe I have some points to make now here, and maybe it's good to discuss later. So we find a Phillips curve, it exists, it's there, okay? But it's quite flat. Okay, and then we can discuss the results. But okay, I'm not going to discuss a lot the paper. I want to just discuss with you the possibilities of this data, what is bringing to us, and then I'm going back to the housing. I dare to do one slide of housing, okay, or two slides. Okay, so labor that we have spoken before. This is data on NATS2 by regions. So actually you can see that in different countries, these are differences to the, I think is the dispersion to unemployment rate at the country level. So a natural thing that you see is that there are some regions that, over the long term have had structurally higher unemployment rates than others. And you can see maybe that, Italy, south of Italy, south of Spain, East Germany, they might share some characteristics, right? And if we don't look at this, if we look at the country data, we're missing this variability within the countries, but variability comparison across countries might give us information, okay? So this is the idea of this, okay? So I think it's great to have regional data, and because we can learn from that. 4 channels that you can think about how to think about fixed effects. The first one, and this is the typical one, is the country fixed effects, right? So you are gonna control for any time invariant characteristics. In this case, I'm talking about the labor. you know, it's about, for example, a national natural rate of unemployment in the country, okay? But that might not be too relevant. You could maybe think that regional fixed effects, and only you can do it if you have regional data, is something that is better to control. So it's basically taking out, you know, the difference to your time variance, so regional natural unemployment rate. So there are regions that are naturally having a higher unemployment rate, right? And you may want to control this. When we think about time fixed effects, the general time fixed effects, okay, now we're moving from time variation, right? And you can think about capturing aggregate shocks at the euro area level. Imagine monetary policy. If you assume that monetary policy transmits to everyone at the same way, this is a way to control, okay? But you can think about oil prices that we were talking before today, okay? So this is also a way of thinking. But you can also think, and there are some papers, that actually monetary policy transmits differently in different countries. We have been discussing this, right? And then country time fixed effects with regions will also allow this, okay? And actually, in different regions, there might be even different transmissions. Of course, finally, controlling for cost push shocks at the regional level might be much more powerful. There's one more. Inflation expectations. And this is the one I want to talk later on the Phillips curve. Inflation expectations, basically, you know, when you do time fixed effects, you can control for inflation expectation long term at the euro area level. But is this really the inflation expectations that people, when forming expectations or forming pricing, you know, are carrying, or is more the national one? What are firms considering? For example, there are some surveys that tell you what are the prices. Actually, today there was a very nice chart about the frequency, right? The frequency increase in prices, how it went up in a non-linear way, okay? Actually, you can see this also in the surveys. In the surveys, there is an increase. They are telling the firms, are telling you, in the next 3 months, I'm going to increase my prices. And this was also non-linearly increasing. So that is something that maybe we can think that where is the non-linearity? Is it really in the slack, or is via price information? Because we don't capture the real marginal cost, so you can actually capture it via the, you know, what firms are telling that they're going to price. So this is one of the ideas that I had in mind. This one. Fixed effect, that's great. If you look at the left-hand side, you see the residualized inflation against residualized unemployment. It's a way to see what is the relationship between the two. Okay? See, if you don't do fixed effects, without fixed effects, you clearly see in the data that you might think there's a nonlinearity. When unemployment is low, you know, inflation is going to have it high. Okay, you can see in the left-hand side. When you start playing with region, time fixed effects, these things are really maybe disappearing a little bit, right? So it's a way of, you know, I don't claim victory that this is what happens, but, you know, it allows you to think about this. Okay, so let me finish. Of course, it has some implications. Actually, you know, controlling properly for inflation expectations, okay, might be the right way to do. This is what, you know, because at the end of the day, the non-linearity might be there, right? So, you know, important, very important to take this into account. And I promise you that I wanted to say something about housing. So I'm very modern, so I went to AI, okay? And I created a chart with AI, okay? And I wanted to look if there was actually housing prices at the regional level. And I found some papers, but in regions, but concentrated on one country or 2 countries, you know, but not comparing across, right? And I think that's the future. We should do it. We should learn about this. Why not? So we have to make this data happening. Why? Voila. We can have, and I also ask AI for the right time because I'm not an expert. What can I control with country, region, time, or country time fixed effects? You know, maybe things like national macroprudential cycles, fiscal housing interventions, the ECB cycle, amenity on endowment. Maybe there's potential there. If someone wants to, I'm happy to join the project. Thank you so much.
Okay, so Can you hear me? Yes, fine. So thanks so much for the presentations. So if I learned one thing today is that not only central bankers have an issue with time inconsistency, so we might have one now. So we have like 10 minutes left. So I think what we're going to do is open the floor to questions from the public for now, and then see whether if we don't have enough, we can do one of the rounds that we discussed earlier, right? So there are, I think, a couple of questions already.
Well, my name is Kira. I'm a real estate investment broker. So those questions are everyday questions in my life. And I want to refer to Sophie. She was speaking about rents in Austria. They are inflated, and they have been inflated too much. So there were politics in Austria. They decided that the inflation won't be counting 100% anymore. This was about your papers you were presenting before. What I'm missing is those rents are only the rents for old houses, not only in Vienna, but also in whole Austria. And we do also have rents in new built houses. And those rents in new built houses, they can be inflated still 100%. What was happening? People, especially in Germany and Switzerland, they heard about the politics in Austria. And they said, well, this is not a good decision. And probably when we invest in Austria, we are buying big houses, like 300 apartments, and the politicians will decide not only for the old rents, for the old houses, but also for the new houses, that the rents can't be inflated 100% anymore. So this is a highly risky investment in Austria. So this is daily business in my life. A lot of funds, like private equity funds and institutional funds, so decided not to invest anymore in Austria. So what has happened? We do have a lack of private equity. We do have a lack of institutional capital. So all the companies building new houses do have a lack of capital. So what are they doing? They go to the banks and want to have loans. Of course, mortgage loans. Mariana, before in the morning, she said, oh, we are happy because of the interest rates have increased. Well, we are not happy because mortgage loans are much more expensive. Okay? What has happened? We are not building apartments anymore. There are no apartments built. Like we built before 30,000 apartments in Vienna a year. Now we are building this year 8,000, next year 4,000. So the people are going to rent again, and the prices are increasing.
Could you
so what you are showing is rent with the politics, the inflation was decreasing, yes, but we do have much more higher rentals in Austria. And this leads to, I think, a really uncertain politician situation in Austria. And my question now finally is, what are you going to do on the EZB level, on the central bank level in Austria, to help people living in Austria to get normal living costs?
So this is a question to ECB policymakers, but I only have like academics here, right? So this was a misplaced question, unfortunately. But maybe, Sophie, you still want to react?
Yeah, I think a couple of things you said, like, and a vast, many different aspects, right? I think in terms of it's not worth it building anymore. That if you, that the way that you told the story a bit, right? Oh, sorry. Thank you. Okay, then you hear me. So that supply is going down, and people aren't willing to invest into new builds and so on, and developing projects in general. I mean, we see that worldwide, right? I've just seen this data for Germany, how actually new construction is dropping so massively, right? Mainly in Berlin, true, because they had also interventions that are a bit problematic in the past, but it's everywhere, although they didn't have that, right? So I would say you can build some counterfactual that this is not necessarily totally clear that this is due to this one policy. So I would say this is a bit probably too much. Also, if you're a smart investor and you look at the data and you see that over the history, we have triggered 3 times. Over a very long period, we have the euro now, that threshold when this policy would actually be in place. That's not rational, right? So I don't believe that this one policy is going to have this effect for a long-lasting period. What is probably more the problem is that construction materials are currently far too expensive. That is a real problem, that land is very scarce, right? And that there's not enough demand from private people to actually buy those houses because of affordability concerns. I think these are much more important one. This policy, I don't think so. I really don't think so, because it's capping at such a high level that this should have almost no behavioral impact, I would say.
Thanks.
Can I
yes, please.
quickly also say, so I think these are all very relevant questions, no? I mean, living costs and so on. I mean, how is the population affected? But as an academic, I mean, I also think we need to be careful as a public to not overload the central bank with responsibilities. No, they have a clear mandate, price stability, and maybe also take the kind of employment into account and so on and so forth. It's written in the mandate. But if there are any kind of relative price changes, or the price of gas goes up, people ask, okay, put a cap on or give like a rebate on the gas prices. I mean, these are price signals. I mean, they tell us something about the scarcity, and we want the factors to efficiently reallocate in the economy. If there are distributional concerns, then that's an issue of fiscal policy, right? I mean, you can vote the parties which then sustain these people who or support more the people who have trouble with their living expenses. And I think there one needs to, it's a personal point of view, but I think we need to distinguish clearly what are distributional issues, fiscal policy, and then they also get the legitimation in parliament. And, the central bank, we should not overload them because they're also an independent institution, right? I mean, that's just in terms of, given that you asked this question.
Thank you for very nice discussions on, I mean, if we look at the mortgage products, I mean, one of the very fascinating things, so that you see if you work sort of, within banking, is that the mortgage product is sort of in its core, it's very similar, but how it's really developed and the actual conditions of it is actually very diverse over Europe. In particular, the question if you have sort of, these sort of floating mortgages or fixed mortgages. So it would be interesting to hear a little bit on your sort of, views of what you have seen from research. What really determines, because sort of whole countries tend to get stuck in either, okay, this country do sort of fixed mortgages, this country have a large preference for floating mortgages. Any sort of color on like what determines if a country ends up in either of these states would be really interesting. Thank you.
John, do you want to add something like that?
Yes. One of the big differences between floating rate countries and fixed rate countries is history. So countries with a more volatile inflation history seem to have got stuck into a floating rate regime. And then that has, there's path dependence. So in floating rate regimes, home equity withdrawal is very easy to manage and is also very profitable for banks. So in countries like Norway, Finland, Sweden, the UK, home equity withdrawals is big business. And as I say, it's much easier when you have floating rate mortgages. So the banks there tend to support the maintenance of a regime where there's a large floating or short-term fixed regime.
Thank you. Anyone, if you want to?
Yeah, I think it's a very interesting question, also academically super interesting. I think many of the differences, not only in the mortgage market, also in the housing market. I mean, if you think about country fixed effects and then the time variation, in terms of looking at economic determinants, so interest rate levels, or the spread between fixed and flexible rate mortgages, we can explain the time variation, okay? Relatively better. The fixed effects are very hard to explain. I mean, so there's anecdotal evidence, there's some kind of historical episode. So why, I mean, why is the rental rate, for example, in Germany so high? I mean, it has been associated with the destruction of the housing stock in the Second World War and then the quick reconstruction and a lot of public housing where people were quickly able to rent flats. But yeah, I mean, I think if you look at mortgage markets and housing markets, one of the interesting bits of it is that each country is very idiosyncratic. And there's a lot of institutional detail. Concerning the mortgages, coming back to your question, I think there one interesting aspect is also to look at how the banks actually finance. So look at the banks' balance sheets. No? So how do they finance these kind of mortgages? And there are different models, right? And this is then also associated how they hedge the risks. And so, of course, this can change. This is endogenous. And the question then is just one step further. Why do they use different type of financing models?
Do we have any more questions from the audience? Yes, there's one here. Thank you so much.
Thank you. Question to Yuan. I wonder whether it's really useful to move into regional disaggregation when we want to estimate the Phillips curve, because the smaller you define the region, the more you get into the problem of regional labor mobility. So either be daily commuting or weekly commuting, or as Andrea has shown, moving into another region. And what do you think does this regional labor mobility cause to your estimations? And then a question to Sophie. Conceptually, we distinguish between houses as an investment, it's an asset, and, for example, long-run durable goods like cars as consumption goods. And we don't want to have assets in a consumption price indicator, but we want to have consumption in a consumption price indicator. And what's, so to say, the sort of consumption that's associated with owner-occupied housing, it's the service of rental, of use of the house. So what do you think? Is this a political decision, or is this a conceptual difference between having houses out of the consumer price index?
So thank you for the question. Actually, the concern that you have is a concern that we also have in the paper. But actually, we have found, so we are controlling for it, trying to control for it. We have also found data on migration in and out of the regions, okay, every day in the working relationship. So in order to control for this fact that it could be an issue, right, when the estimation. So it's a concern, but that does not, it's called avoid to exploit other channels that we have seen that can be all exploited with the regional data. So I think this is a concern that, of course, when you open up, to smaller units, you have other issues that you have to control. The wall is bigger, right? On the other hand, when you have macro, you are losing a lot of. We are asking also what is the channel that dominates, right? Because it could be 3, 4 channels at play in the micro data, but when you aggregate, there is one channel that dominates. But still, you want to learn about the channels that are behind what is happening, right? So that is how we think about now.
Yeah, maybe this question about the houses having like the service component and also the investment component, right? So these two aspects, and that is true for investments in real estate, right? But again, the CPI wants to measure the use component. So how much does it cost you on a regular basis to actually own an apartment or a house and live in it, pay for the upkeep or renovations, something like that, running costs, maintenance costs, and all these things. So there is a flow of payments also when you live in your own house. You also have the costs of mortgages, that would be the interest component. That would also be very often put into the ongoing cost of ownership, right? That is not the investment part, that is the service part. And then it depends a bit on which method you use. Like for instance, the user cost formula is one approach to actually separate the two, where we really want to look at the service components a house delivers to the person who lives in it, versus the investment component that would look at the increasing prices over time, right? So there are methods to distinguish the two, but saying it doesn't produce any costs that are changing over time, which is relevant for the CPI, is just not really fair. And I think that's why it has been included. And another reason why it is probably essential to either kick out rents from the CPI, which is radical, I wouldn't do that, or to put in owner-occupied housing into the CPI, is that we have this massive heterogeneity within Europe, right? We have those countries that are only owning. When you look at, for example, Slovakia, right, where pretty much everyone is owning an apartment or a house. Also Southern Europe, the vast majority is owning, right? However, when you look at Austria or Germany, roughly half of the people are not, right? So that means the CPI, the HICP, represents Austria and Germany in that sense more than other countries, simply because the housing costs of all the renters are included, and we have large shares in this country here, but we have tiny shares in others. So there, actually, the housing cost of a large group of people is not included. So in that sense, in terms of equity perspective, to treating all equal, you want to include both or none. And I think most people would agree we don't want to get rid of the rent, so rather including unoccupied housing. And again, there are methods that would allow you to distinguish between the investment component and the service component. And I think it's not that is not the problem. Also, in terms of wouldn't it be enough to include rents, that would be true if the user costs were perfectly true and housing markets are always in equilibrium, right? If prices would always reflect the future streams of rents, that would be the user cost framework would impose that equilibrium condition. If that would hold, that's fine. However, we actually see that this only holds in a very long run. Then it's true. In the short run, it's usually deviating from this equilibrium condition. Hence, they are no substitute. You cannot say we have rents in there, so we control for housing costs, don't need owner-occupied housing. No, they have two different price paths. So we have to actually include both of them separately because they produce different streams of consumption. And that's why it's probably accurate to include both. And there are solutions to this ways of how to measure that. Actually, we use in what I showed you a user cost approach. Yeah.
Okay, so let's take one more very brief question, and then we do a final round with a homework that I gave you regarding your research streams, right?
Jacob Short from the Bank of Canada. I'll be very brief. It's really just about the recent literature from like McKay and co-authors on whether monetary policy should even respond to rent inflation, given that their view is it's a supply-driven and sort of rationing happening in that market, and monetary policy can't really do much to react to that. So really your take on that.
Thank you. I mean, my response would be if you have countries like Austria in that group of members of the Monetary Union that then use that inflation that is measured for indexing the rents, then I would say, so, well, that's a problem, right? So if you have these mechanisms that they're both intertwined, then either you exclude it and then don't measure it and don't take it into account for monetary policy purposes, but then you also have to stop indexing rents because the feedback loop is not fair, right? So I think either or, but you want to cut that loop in some way. And if you want to measure a full consumption basket, then I would say the housing cost, given that this is the largest expenditure for the normal household, needs to be included. That's my perspective. But I think it would be cleaner to either exclude both or include both. I think this situation where we are right now, where we have the rents, but we do not have owner-occupied housing costs, is just, I don't find any argument that would justify such an approach. And it's just awkward to include some, but not all, right? Getting rid of rents is one approach. It's radical. I would rather be for like including OOH.
Winfried, you want to add something to that, or I'm good. Oh, you're good. Okay.
I think then it's a discussion for the next strategy.
Yeah, exactly.
Right?
Okay, great.
So we can close it here. Then we hope that the next strategy review maybe it is taken up again. So.
Okay, so let's.
You will not be doing it this time.
So let's do one quick last round about. So I gave you the homework. Think about basically one question, one issue that you would like to research that you haven't had the time or the means or the possibility to do. so far. I mean, Joan, you kind of delved a little bit into that direction already, but maybe you want to expand a little. So really take like 1-2 minutes max per person, and I want to start with John in this case because he's online with us.
Yes, I think one of the most interesting questions is the connection between what happens in the housing market and what happens in labour markets. So obviously, a transmission through rents is one important phenomenon, but it could well be that when house prices rise, firms find it more difficult in a particular location to attract workers, and therefore the pay that they have to offer has to rise linked to the increase in house prices. So if that is true, that would be a link between monetary policy, the asset price, the price of housing, and the impact on wages. So that is a mechanism which I think is under-researched, and I'd really like to see some research on that.
Maybe Winfried, you go next.
Yeah. Twofold answer. One is, I think, much more detail looking into the mortgage market. I mean, this came up today. I mean, I think the academic literature, much of the literature is really focused on the US institutional detail with a 30-year fixed rate mortgage, which is very peculiar. It's really an outlier in terms of other countries. And I think much more needs to be done to understand really the optimal mortgage choice and integrate this into dynamic decision models, then pairing this with disciplining this with the detailed data which has become available. That's the one side. The other side is exploiting the high-frequency transactional data and bring this to bear to understand better the fast transmission of monetary policy really within the first quarter. Because I think this opens up also interesting new trade-offs, because some of the effects which you see maybe with long lags through the labor markets, something John brought up, are complemented by other effects through changes in the mortgage rates, which can be passed through relatively quickly in some countries versus others, and also in some small open economies with exchange rate changes, right? And this is something we have been looking into in Switzerland, because these exchange rate changes trigger really fast relative price changes, which are very salient to consumers and trigger real income effects, which are super interesting.
Thanks so much. John?
So, of course, now that I started with regional differences and regional heterogeneity, of course, this can be applied if the data, because this is the effort that we have to do, is there, I think, the potential to be applied at different topics, and I think John just mentioned one. For example, on our case, it could be, on the wage Phillips curve, but I put forward a proposal in terms of house pricing, and you put on the right-hand side GDP per capita, and then you look for all kind of institutional effects that you can control, and then I would like to learn so that this difference between regions across countries. So that could be an idea that I think I will not mind to pursue further in the future. Thanks.
And you're looking for co-authors, right? So.
I'm always happy to.
Sophie, please.
Yes, several things. So, I mean, there are always many things I would like to do, but there's no time, like always. But there are also a couple of things like I always wanted to do, and finally it seems to be able to do some, so I thought I would share that. So kind of a success story. So I came across last year, the very interesting housing market in Saudi Arabia. I don't know how familiar with the Saudi Arabian housing market. It's absolutely crazy. It's so turbulent, so many things are happening there. Over the last decade, roughly, and they have tried pretty much everything the Western countries have experimented with over the last century in 1 decade, just one after the other policy, and you see it also condensed now in this market. And it took me now more than a year to find a PhD student who reads and writes Arabic, and is able to get also the data from there, because he comes from there. And I'm super excited that he will start in September. So we're going to look at like what stream of policies actually happened there to see how that. But it has the same effects as it has over history in Europe, when it all comes at the same time, and to a totally unregulated market before. Both rental market controls in many ways, but also lots of fiscal policies and restrictions to mortgage lending and so on, to see whether things are exactly the same as we have experienced in our countries over roughly a century. So that's quite exciting.
Great.
And obviously more to Austria, because Austria is also experimenting so much with its housing market all the time. Very nice to analyze.
Especially historically, I guess.
Also, yeah.
So yeah, thank you so much. I want to thank all four of you, John, Sophie, Joanne, Winfried, for being part of this panel, for giving us really insightful presentations, for answering the questions of the public, and I hope discussions are not over here, so we can continue those over dinner, over drinks, and yeah, thanks again. Please join me in applauding our panelists.
Thank you.